This story that it's said to have explored a merger with Bristol Myers to increase its exposure to the US market. Will investors believe it'll go ahead? Because analysts at the moment are very sceptical, so keep an eye on that. Also on Italian banks, you've had banker Monte de Paschi weighing a possible takeover of Banco BPM to ward off a hostile takeover from Intesa Sanpaolo. Watch all of those names. And then, as I say, energy stocks potentially lower, most likely lower on the lower oil price, but also individual moves maybe from Total looking to sell its Europe and renewables stake to KKR, Anna.
Yeah, lots of individual names to watch out for then. But overall, as you rightly said, Lizzie, last hour, the big move in oil prices is surely going to be the thing that stands out to us when we look at where energy names trade and other markets around Europe this morning. That's going to be the backdrop. Of course, we layer in there on top the latest news flow around the yen. That might be harder to see asserting itself across European equities, but that is certainly in our minds. As we look at these European markets then opening up on the front foot, and actually the FTSE 100 a little stronger than had been anticipated, perhaps up by 0.3%, so much more positive picture than the futures were painting for us. The IBEX up by 0.7%, the CAC 40 up by 0.7%. So broadly speaking then, we are seeing positivity. Perhaps there are other stories on the FTSE 100 that are offsetting any weakness around energy names, and there would be plenty of companies that would benefit from a lower oil price, of course. Lizzie, what are you seeing in the sectors?
Well, immediately I scrolled to AstraZeneca because, of course, this is the second biggest company on the LSE, but we haven't started trading there yet. So let's take a look at the broader sectoral picture. You've got about half, just over, maybe three-quarters of sectors in positive territory this morning. Travel and leisure leading the gains, up 1.8%. Construction, industrial goods and services not far behind, but bottom of the basket, as we expected, energy down 1.8% off the back of the lower oil price. Brent currently trading, let me find it, at $83 a barrel, so down 5.5%. As you say, that meaning that the FTSE's gains are held back somewhat this morning. But just some of those individual energy names that we had flagged as well. Total Energies down 2.5% in Paris on this news, perhaps, that it's going to sell its European renewables energy stake to KKR. Also keeping an eye on Shell, which is down more than 2%. That's selling its renewable energies portfolio in Europe to Total. So it's all a bit of musical chairs when it comes to the energy names. And then just going back to the Italian banks that we'd flagged, well, Paschi's down 0.8%, BPM up 0.4%, and Intesa Sanpaolo up 0.8%. So again, the musical chairs for Italian banking M&A playing out across those three stocks.
Yes, and we've mentioned the energy names on the back foot. Travel and leisure and things related to it seem to be doing well. So you've got Airbus, one of the best performers in terms of the Europe stocks 50 this morning, and Safran, the engine maker. So both of those, you could put those together, perhaps. And the airlines, of course, part of that trade as well. So TUI, Ryanair, IAG, all up by more than 1.9%. Let's take a step back, perhaps, from the daily moves and talk about where we go on these markets. Gautam Samath joins us, a multi-asset fund manager at M&G Investments. Gautam, nice to have you with us. Thank you for joining us. How do you keep track of the oil price moves? Because we're down another 5% this morning, and on other days we've been sitting here, we've been up 5%. It seems like this kind of percentage move is nothing unusual right now. Real volatility in energy markets. Do you just have to construct portfolios that withstand a lot of volatility and a broadly higher energy price? Is that the landscape?
You do. The volatility in the oil price is something that we've got used to. Certainly, I mean, let's say over the past 6 months, but even if you cast your mind back to the breakout of first conflict over here, which was over a year ago. Ultimately, what the market worries about is what are the inflation pass-through effects of oil, and therefore what are policy response functions to this. And looking through all of this, there are some big picture things that we've learned over the last year. We've learned that the world's pretty resilient. It can deal with supply shocks in a way that we didn't think was possible pre-COVID. And if that can happen, then we can start to fade some of the impacts of the day-to-day news announcements. When is this conflict going to resolve? How it's going to resolve? How long it's going to take? We have no idea. But what we can say is that the system is dealing with supply shocks in a much more resilient fashion.
Okay, so the global economy can deal with those supply shocks, and it has been dealing with what's coming out of the Middle East quite, really well, considering expectations. Can the AI theme deal with higher rates, and is that what we should prepare ourselves for? And I guess I mean this in the context of whether the Fed has to put up rates, or whether the markets just decide they need a higher premium to hold US debt.
Yeah. So the two big surprises this year have been, one, the resilience to the oil price shock, and the second one has been the upgrade of CapEx spend and investments going towards the AI theme. That, if you think about the counterfactual, whereby you actually had a world where you didn't have these supply shocks, you might be in a disinflationary boom right now. You've got productivity gains, potential productivity gains coming through from the benefits of AI. And you've got rapid build-out of infrastructure that is stemming up. Certainly, if you look at the U.S. economy, a lot of the investment spending coming from that sector. So, absolutely, it's got legs to go, and there isn't that much froth behind it. There's pockets of froth, but in aggregate, you don't see what you've seen in prior investment.
And you don't think it's vulnerable to higher rates then, that AI build-out?
It will be. You're pushing up against sort of limits of cost of capital right now as you move from equity financing to debt financing. That will matter, and you're starting to see that in the difference in terms of, certainly if you look at CDS of companies that can build out with cash flow internal versus having to raise debt for it, you're seeing the impacts of it at the margin. But I think there's plenty of capital willing to chase this theme in the different pockets in which it evolves.
Well, yeah, you want to know when that inflection point will be, when you get the disinflationary boom, how big it will be, and whether really you have to wait for oil to fall and for deficits to shrink to be a boom, as you're calling it.
You do, and that'll be difficult to call. So if you can cut through into sort of look beyond 12 plus months, I think a lot of the conditions are in place for that to happen. If you think of what might have been the case had we not had a supply-side shock and sort of a potential inflation flare-up, you'd have rates that were possibly stable. I mean, we could argue there was no need for central banks to cut rates where we were in the growth cycle where the labor market is. But you'd have lower cost of capital, a theme that was accelerating, and meanwhile, all the underlying service level inflation that we were worried about, that seems to be coming off. So certainly if you look at the core inflation numbers, the last few prints have actually been surprising to the downside. So you would have had upside surprises to growth and downside surprises to inflation.
Can we also just talk about the Fed? Because I am wondering how much of a problem... We've talked a lot about Fed credibility already and the impact on the bond market so far this show, but I do wonder about the impact on stocks as well, because you had the worst Fed day for the S&P since, I think, 2024 last week. How much of a problem could Fed credibility create more broadly in these markets, given your multi-asset?
It is. It's one where they're finding the balance between saying nothing and saying too much. After all, not saying anything is a form of communication. And when you leave open a potential interpretation of reaction function, you increase the range of outcomes and therefore the potential volatility. Now, you've just been through a phase where you had pretty spectacular returns. Certainly, if you go back to the start of April onwards, you had a pretty spectacular bounce in equity markets, especially in the pockets of the equity market that you're talking about. And then when you create uncertainty as to what the trajectory of rates might be, that's always vulnerable to a reset. I think what we've seen is a bit of a reset rather than any meaningful change in equity market trend.
Gautam, can I ask you about the pharmaceutical sector, whether you see that as an area to maybe broaden out from, I don't know if it's AI benefits, but certainly if we're looking for things that are broader than just AI benefits in equity markets right now. And of course, the news of day around the pharmaceutical sector is AstraZeneca. And we've got reporting that suggests that they could be in talks for a possible merger with Bristol Myers Squibb. Now, the investor community doesn't seem to be thrilled by that prospect, and as you might expect, the stock is down by more than 6% today on nervousness, perhaps that they go and make such a big deal. And it would be a really big deal within the pharma landscape. Is pharmaceuticals an area of interest to you right now?
So pharmaceuticals, into healthcare more generally, there's been a rotation under sort of. It's interesting. We've seen a steady sort of rise in equity markets, but within that, we've seen quite a lot of rotation this year already. Within that, a rotation towards healthcare was already underway. What we're seeing in terms of M&A activity, large cap M&A activity, tends to happen later on in cycles. I'm not going to profess to know what the merits to a merger over here would look like, but it's something that you tend to see later on in the cycle. Probably talks to a bit of confidence at the corporate level, something that we haven't really seen mega deals like this so far.
And in terms of dispersion, what are the best opportunities to take advantage of that dispersion trade right now, Gautam?
Sure. So if you look globally, I do think Asian equities are still an attractive place. Certainly, if you think about...
In Korea or elsewhere?
Well, Korea is a great trading opportunity. If you optically look at it, it's one of the cheapest markets, although we know that those earnings are they're potentially very elevated. They're clearly very volatile. But you've just had a significant reset in a market that's trading up or down 10+% in a day. So it's a great trading opportunity, which speaks to a broader macro environment whereby this volatility creates trading opportunities across asset classes.
Yeah.
But if you look at valuations, EM equities more generally, the LATAM complex, Asian equities, and then the debt side, some of the LATAM sovereign debt looks pretty attractive. Yeah,
are there certain EM bonds that are more attractive to you than treasuries?
Well, I'd say a Brazilian bond yielding about 14.8, 15%, a 10-year bond with a duration of less than 5. Those yields have to rise about 300 basis points for you to lose money over 12 months. That's pretty attractive.
And are you thinking, Gautam, about this market as being sort of providing tactical trading opportunities, or is this still a good opportunity to get in and buy any dips, or is that not where we are right now?
Both, but I think the tactical opportunities are significant. The volatility being created, what we've spoken about the yen on the show earlier on, the volatility in FX markets, the volatility that you're seeing in rates right now, especially at the long end of government bond markets, and even now in equities, intra-sector, and most recently across the tech sector, those are big trading opportunities. Now, if you are a big believer in this long-term trend, that's a tactical entry point. Otherwise, you can just trade the ranges. And so as a macro investor, it's a great time to be around.
156 per dollar is where we trade on the yen right now. Gautam, great to see you. Gautam Samath, multi-asset fund manager at M&G Investments. Well, let's turn over to the core six now. Where are they shaping? How are they shaping up this morning? We have all of them except for ASML in the green this morning. ASML down 0.25%, but boosts across most of the board. Now a great big unch for Nestle. Novo up, flat to the upside. The biggest move there is LVMH up 1.1%. Now let's get to some of the individual stocks we're watching this morning with Chloe Melly. Chloe, starting with Astra.
Yes, good morning, Lizzie. We are seeing AstraZeneca take quite the hit this morning on all of this talk of M&A. So AstraZeneca is said to have explored a merger with Bristol Myers Squibb, and this would be a major deal, creating one of the largest drug makers in the world. And we are seeing investors be not quite thrilled at that prospect, because maybe a deal of this magnitude might be quite hard to pull off. And so we're down almost 7% this morning for that pharmaceutical company. We are also in the red this morning for oil because of this optimism that we could see US and Iran find a peace deal. They are set to restart talks today to try and find an agreement to reopen the Strait of Hormuz. And of course, this is the kind of thing that sends those oil major shares tumbling. And so we are seeing in particular, actually, Eni is down the most this morning, down more than 2.7%. The flip side of that, of course, is that the travel sector, airline sector, is doing much better at the prospect of those fuel costs coming down. We are seeing IAG, which owns British Airways, TUI, Ryanair, and Lufthansa, all in the green and quite strongly in the green this morning on this optimism about a potential peace deal. We are also in the green for Siltronic, which makes a semiconductor equipment. It has been raised to a buy rating at UBS. This follows a string of buy ratings from last week, with a lot of analysts saying that this is a company that is seeing a lot of very strong short-term and medium-term demand, and so that is driving the stock this morning. And staying within this AI theme, we also have Legrand, which is a French maker of electrical equipment to data centers, being upgraded by RBC analysts, with the analysts saying that the recent pullback in the shares offers a very compelling opportunity to gain exposure to a very high margin company. And so we are seeing the shares up about 1.7% this morning for Legrand.
Thanks, Chloe. Chloe Melly with the latest on those stocks that are on the move. One of those is AstraZeneca, of course. Shares in the pharmaceutical business falling this morning. In fact, that move in AstraZeneca taking 55 points off the FTSE 100. We will dive into what a potential takeover of Bristol Myers Squibb could mean for the pharma giant. That story next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television. Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. To the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. Earnings season is here.
There are earnings galore.
Some areas have done well. Equity trading has been an area of resilience.
Bloomberg is first to break the numbers.
Diving through the details of these earnings.
That is the weakest growth in more than 3 years.
With the smartest insights.
Are we seeing dislocations that point to something a little bit more severe?
If you look at where global growth expectations are, compare them to the start of the year, they're actually pretty similar.
But there is this uncertainty, and we haven't seen it in the results.
Continuing coverage on Bloomberg.
Welcome back to the opening trade. We are 18 minutes into our session this Monday, and we've got a fairly positive picture across European equity markets. We have a considerably weaker oil price. We'll get to that narrative, though, because that seems to be developing. We'll get to that a little bit later on in this part of the programme. Let's go to the AstraZeneca story, though, because AstraZeneca shares are considerably weaker this morning. They are down by 6.4%. This comes as Bloomberg learns that the UK drug maker is set to have explored the acquisition of Bristol-Myers Squibb. A deal between the two would create one of the world's largest drug makers. Let's get more details with Bloomberg Health reporter Ashley Furlong, who's with us on set this morning. So, Ashley, what do we know about the proposed deal, the extent to which there is a deal to really discuss here?
Not very much right now. We know that there were preliminary talks. We don't know if those talks are still ongoing. We don't know if they have ended. I think the context that this comes in is that for the past year or so, there's been a lot of rumours about a mega merger between two large pharmaceutical companies. A lot of pushback against that as well, because in the past we've seen mergers have led to reduced R&D spending. We've seen, potentially increased drug pricing. The reason for why potentially now this might be the moment for such a deal is that the US administration is seen as more open potentially to such a merger and less likely to push back on some of the antitrust concerns that there might be in such a deal.
When you look at what these two companies do well, does it look like a good deal to you? Because investors don't seem to be very impressed with the idea.
Investors don't seem to think so for AstraZeneca. AstraZeneca is a high-growth company. They have a really big pipeline that seems to, people think will sort of bring them into the next decade. Bristol-Myers Squibb, on the other hand, is having more sort of concerns with patent cliffs. There's the lower sort of PE levels. So we're seeing a very different picture, and there's less guarantee for investors that this will be a good deal for AstraZeneca.
I mean, you mentioned one of the motivations could be that if you're going to do a big deal, maybe the regulatory backdrop in the US would look favourably on this kind of thing at this time with the current US leadership. That might be one motivating factor. Might they also want to increase presence in the US? I mean, we've seen a lot of pressure on global pharmaceutical companies to produce more stateside.
That is the other potential reason that Pascal Soriot, AstraZeneca CEO, might be pushing for this. Increasingly, AstraZeneca has made a larger presence in the US. We've seen an upgraded listing on the New York Stock Exchange. We've seen increased investments in manufacturing and research in the US. And we've seen, increasingly the company position itself as a global company, but also an American company. So that could potentially be a reason. But as we've seen this morning, investors are not exactly keen on this proposition.
Yeah, not getting the thumbs up right now. Thank you very much, Ashley. Bloomberg's Ashley Furlong with the latest on the pharmaceutical sector. Now, sticking with European equities, it's a busy week ahead for earnings, but let's first take a look back at how the region has fared so far this season. To discuss, we're joined now by Bloomberg Intelligence Equity Research Director Tim Craighead. So, Tim, we started this earnings season with really high expectations, would it be fair to say? Now we're some way through the earnings story. We've got quite a bit of clarity on where it's taking us. How does it look to you?
Yeah, so we're roughly 3/4 of the way through. If you think about it from a market cap exposure perspective, more than 200 companies have reported. And it is interesting. It's been a pretty broad-based positive earnings cycle, notwithstanding a lot of the concerns that we went in with, high oil prices, consumer confidence, et cetera. You think so far it's roughly 55% beat versus 25% miss, which from a European context, that's a really good earnings report.
I feel like often things are, ready to beat.
Well, they are, but you think the U.S., if you look at those sort of stats, quite often is 75 or 80% beat.
Right.
Europe doesn't play it that well. The companies don't play it. They don't game the system. So this is actually very handily constructive. And more importantly, maybe for the market, we're tracking at about 14% earnings growth right now versus coming in, as you had said, at about 11% before the results had started.
So they're the broad strokes. Which are the sectors that are doing well and which are the detractors?
Yeah, and this is part of that constructive story because it is pretty broad-based. Pharmaceuticals, notwithstanding the AstraZeneca news this morning, several have reported quite good numbers. Semi-equipment in technology, industrials on the sort of broader tech play in Europe with a lot of the electrical equipment companies that play into the data center build-out thesis have reported good numbers, and the financials with high interest rates that plays through into a higher net interest income.
Yes, yeah, we were talking about AI adjacent things like cable makers, Prysmian doing some M&A, has been doing quite a bit of M&A. Tim, what about the forward-looking story then? Because as you say, we're 75% through. Yep. That's not 100. We've still got some more discovery on earnings.
So I suppose there are a couple of things that come to mind here. Number one, we are seeing positive estimate revisions on 2026 numbers. It's not like we're just beating and the 2026 estimate is static. It's up. But more importantly, the 2027 estimates are also revising positively in a like manner. So it is carrying into next year. Secondly, you look right now, we're about 15 times earnings for the stock 600. That's essentially a 10-year average PE, so we're not stressed on the valuation front. And this week will be interesting looking ahead. We've got HSBC, which is going to give us a pulse check on China wealth management flows. We've got Novo Nordisk, which, again, speaking about pharmaceuticals, we're quite constructive in terms of the prescription trends that we think will be better than expected for the Wegovy pill. BP is going to be interesting here in the UK because of what they say about the North Sea. And I think Diageo is going to be quite interesting. New CEO, how is the U.S. business going? Can they get this to start to accelerate?
Which of them do you think will be the biggest surprise to the market?
I'm thinking Wegovy, we're going to see. I hope we have a focus idea, one of our high conviction ideas on this, where the prescription survey we do with doctors, not the patients, but the doctors, we're leaning quite favorably towards Wegovy versus the competing pill from Lilly. We don't think that's reflected in numbers yet.
Okay, Tim, thank you very much. Tim Craighead from Bloomberg Intelligence, thank you very much for joining us. Just a quick word on what we're seeing on the oil price. We'll put up the session chart. You can see where this has been moving. We are still substantially weaker on the oil price, but it has ticked up just in the last sort of half hour or so. And we've got some interesting lines out of Iran saying, for example, we currently have no negotiations with the US. This is the foreign ministry spokesman from Iran speaking. It's interesting, though, Lizzie, isn't it? Because and this can contrast perhaps to President Trump, who said that talks will start today. But we've seen it in the past where people have different interpretations of what talks mean, and sometimes people are talking about the US and Iran getting around a table together. Other times they're talking about messages being exchanged via intermediaries. So difficult to say whether everyone's talking about exactly the same thing, but interesting to see the oil price on the move as a result.
Yeah, and I mean, it's similar to when you talk about the Iran-Oman negotiations, saying that they don't include whether or not the strait will be open or closed, but President Trump saying that this has to be part of any deal that happens. But yes, in this latest statement, US-Iran issues should be addressed in a later stage, so we'll continue to watch the oil price. $83 a barrel is where we are right now. And indeed, we will be discussing all of the geopolitical impact on the oil market next with Carol Nackley. She is the founder and CEO of Crystal Energy. We'll also be discussing that OPEC Plus meeting over the weekend and the decision to hike, even if it is only symbolic. So that conversation coming up next. This is Bloomberg.
We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
more science.
We're pushing the envelope of technology in multiple directions: software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romain Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg. Welcome back, everybody. Monday morning, and the opening trade here in Europe looks really quite positive. We have a weaker oil price to thank for that, perhaps. So the oil price goes lower and the DAX goes higher, up by 1.3%. The CAC 40 also getting some pretty decent gains. Autos and auto parts, the best performing sector across Europe today, and that plays well for both of those markets. The FTSE 100 is being weighed down by, yes, energy stocks because of the weaker oil price, but also AstraZeneca and the perhaps fear amongst investors that maybe AstraZeneca tempted into a big deal. A big merger. So we will certainly keep an eye on that one. So the FTSE 100 standing out for the wrong reasons today. But broadly speaking, we are a lot stronger than Lizzie, and we're up by 0.3% on the stock 600.
Yeah, that's the geographical breakdown. Let me show you another way how much sentiment is being boosted this morning. Volume up nearly 30%. And then when you look at the ratio of stocks higher and lower on the stock 600, we are significantly to the upside. So let's pick out some of the individual leaders this morning. Airlines, as you would expect, are up on oil being down. Ryanair shares in particular up 3% right now. Then we've talked a lot about the M&A action happening today, not just Astra, but also in the Italian banking space. Monte dei Paschi weighing a possible takeover of Banco BPM. So those shares in focus too. And if we turn to the laggards, Astra down 7% off the story that it's said to have been exploring a merger with Bristol Myers. We've also got any shares down on the broader oil theme, down 2.5%. Shell is similar, but it's also got to factor in this story that it's selling its renewables portfolio to Total Energies. So that stock only down 1.3%. Compare that to Eniana.
Let's get an update then, Lizzie, on other stories we need to keep in focus this morning. Alibaba shares have jumped in Hong Kong after it released its latest flagship AI model, with performance claims putting it alongside global leaders like Anthropic's Fable. The debut comes after Moonshot's Kimi K3 sent ripples through stock markets and Silicon Valley last month, as Chinese developers showed they could quickly catch up with the top models from the United States. The yen is advancing for a fourth day after the against the dollar, after the US and Japan warned jittery currency markets of further coordinated action after confirming their first joint intervention in 15 years. And oil prices have been tumbling as much as 7% this morning after President Trump said that new Iran talks would begin this afternoon. The planned negotiations come after he called off a planned attack on Iran, partially in response to pleas from US allies in the Middle East, including Saudi Arabia. Just in the last few minutes, as we were saying in the last part of the program, Iran's foreign ministry spokesman has said that the country is not currently in negotiations with the US, but is in talks with Oman about the Strait of Hormuz and passage there. Lizzie.
Well, off the back of that, we are seeing oil pairing some of the earlier losses, down 4.9% now for Brent Anna at $83.64 the barrel. Let's get some analysis with Carol Nackley, CEO at Crystal Energy. Welcome back, Carol. Great to have you on the show. Does this just show that oil traders are too optimistic? Every time we get some of these developments, that diplomacy is going to restore oil flows back through the Strait of Hormuz. Good morning.
Good morning. Well, look, we are on a verbal roller coaster in terms of statements coming from the White House and from Tehran. But throughout this conflict, especially in the last few weeks, I know many lost hope that the Strait will not resume operations and the traffic will not go back entirely to normal, and therefore conflict is going to escalate further. But actually, these were the headline news. We all along, despite, for example, what President Trump said when he said, for example, that the deal was dead and the ceasefire was dead. Yes, we saw some very targeted escalation, but behind closed doors, both parties did not abandon the diplomatic route. And that by itself continued to give me hope. I'm cautiously optimistic that negotiations are still ongoing. Both parties would like to see an end to that. And not just both parties, the countries in the region, the GCC countries and other countries in the region would like to see this reaching an end very quickly. But of course, we have to continue to expect the kind of volatility because we're still sailing to a certain extent in the fog. But at this stage, the market is telling us also there is some cautious optimism to expect in the current situation.
Okay, so cautious optimism. How much is the war premium currently embedded in Brent? Like, how much would that premium unwind if there were to be a new credible deal? If you had the Strait of Hormuz reopening tomorrow, how much lower could Brent realistically go, Carol?
Look, so far throughout my career studying oil markets, I've never come across anyone able to put a very specific value to the oil premium because anyway, that varies from one party to the other. However, just to give you an example, when there were calls of ceasefire and the ceasefire was announced, we saw how much oil prices dropped, I think around $20 or $25 very quickly. Even the latest increase that we saw last week, we saw prices jumping, I don't know, maybe to $100. And then immediately dropped back to 80. So just to give a rough number, and I'm here being very careful because I don't think we can pinpoint a very specific figure, but I'm not excluding entirely $20 to $25 being a premium, geopolitical risk premium added. And that's what's justifying this sharp volatility that we are seeing on a daily basis, but does not reflect really market fundamentals.
Okay, and Carol, so if we want to move, so I hear what you're saying about optimism, we're on a verbal roller coaster, and you're cautiously optimistic about what happens in the Middle East. If we can put that to one side, if we get to a place where the Strait reopens, do we then have to worry about what's happening in Ukraine or Ukraine activity in Russia? Is that a market-relevant war when it comes to broader energy markets still at the margin, Carol? How are you thinking about that?
Absolutely. I mean, I'm seeing like a whole triangle of crises, although I use the word crisis carefully here, because you do have the war in Ukraine ongoing, and you are involving an important producer of not just crude oil, but also of products such as diesel, and that is Russia. And you have the Strait of Hormuz, and also we saw an extension of the conflict recently to the Red Sea. So you do have a very, very tense triangle of geopolitical developments affecting key producing countries, regions, and trading areas for exports. So as long as you have this kind of fluid situation, I would remain concerned. But even if there is a peace deal today or tomorrow between Iran and the US, which is going to be lasting, that is the key point here, a sustained ceasefire, then we still have to continue to worry about what's going on in Ukraine, what's going on with Russia, primarily on the products front, because Russia is an important exporter, and also because it's still happening at Europe's doorsteps. That said, you can see how the market kind of factored in a maintained conflict in Russia, between Russia and Ukraine. The key is not to look at one conflict in isolation, but rather see it as a souffle, one conflict on top of the other, on top of the other. But if you remove the major conflict in the Middle East, I think that will take away a lot of the pressure that we are currently seeing in oil market, both for crude and also for oil product, but will not eliminate it entirely.
Yes, so then we'd be able to focus more on fundamentals, perhaps, Carol. Let me ask you about refined products, because even if we see some relief in crude markets, often refined products seem less able to take a leg down in terms of pricing, and all kinds of reasons for this. I wonder how concerned are you about the supply of refined products, and which specifically? Because actually we've seen refineries working pretty hard.
Definitely, if you look at the production capacity of different refineries, you can see they are operating, especially in North America, at almost maximum capacity. And that is by itself a reason for concern, because you do have sometimes breakdowns. You can delay maintenance, but the risk of something wrong happening when you're running refineries at such a full capacity is there. But I'm more concerned as we head towards the autumn season and the hurricane season that historically did cause disruption to refinery operations in the US. That said, we have to also be careful that we are now in a high demand season for different oil products, particularly gasoline and jet fuels, because it's the holiday season, the driving season. So maybe that is currently more of a concern today. But again, the risk remains high, especially as we go into the hurricane season. But hopefully by then, we're going to see a resolution of the Hormuz Strait conflict, and there will be less pressure on refineries around the world in terms of availability of oil products. Because at the end, the Hormuz crisis is not a loss of refining capacity or damage to serious infrastructure. It's a logistical problem. Take that away and you will see supplies being restored quite rapidly.
Okay, Carol, I also want to just take you to the BP story. It's put its North Sea oil business up for sale, as we know. What does that say to you about confidence in the energy policy of the new Andy Burnham administration here in the UK, and confidence in the UK continental shelf as well?
Well, the UK North Sea is a mature declining province, but we have to distinguish between a declining province and a dead province. So I always believe that there's always a potential there, because yes, the discoveries can be smaller, but the technology is also improving. However, the main problem in the North Sea, if you ask me, I would say has been the government policy. I have seen more changes in fiscal policies from the British government, irrespective of who was in power, whether Labour or Conservative. I have seen more changes in fiscal policies, and perhaps I have recorded annual changes in oil prices. And yes, the North Sea from the UK perspective comes with many advantages, such as lots of cooperation between companies and government. But really, to have a government fiscal take of more than 78% in a very declining, mature province, that is not really common around the world. So if the UK government would like to do something for the North Sea to extend its life further, the first thing they should look at is their fiscal terms. I'm not surprised that BP said goodbye to the North Sea after decades of operation, because there isn't much for large players in the North Sea. Maybe the smaller players, the independent players, but at the end, they need to see a better supportive policy for the government. Though let's see how the new government under the new leadership in the UK, whether they will be able to balance between their ambitious climate targets and really the realistic facts of the North Sea, and extend its life by encouraging further investment.
Yeah, so far there seems to have been quite a bit of ambiguity about policy in the North Sea from the new government. Carol, so if we are able to step away from geopolitical concerns, whether that's here in Europe or crucially, of course, within the Middle East, and we go back to fundamentals, are you looking at a market that is very well supplied? How are you assessing the underlying fundamentals of this market right now?
To answer the question, just look at what happened, or what were the expectations before the conflict in the Middle East. Everybody was talking about, almost everybody was talking about an expected surplus in the market, and that's why we saw prices trading between 60 and 70. And therefore you had the conflict in the Middle East, which is more a geopolitical development that has affected the logistics and the transport, among others, primarily, I would say. Now, restore those operations, plus add to that you have an important country that used to be a member of OPEC, is now outside OPEC, that is the UAE. Add to that the strong growth we are witnessing from North America and from Latin America, such as Argentina and other countries around the world. And also add to that the demand destruction that we have seen because of the conflict, and some of that demand destruction is unlikely to come back once the conflict is resolved and prices go back to normal. So on balance, I don't see why we would expect to see a deficit in the market if everything goes back to the pre-conflict situation.
Carol, thank you very much. Thanks so much for joining us. Carol Nackley, the CEO of Crystal Energy. Now, sticking with the energy theme, Europe's biggest rivers are drying up after a series of heat waves. That's starting to disrupt the transport of chemicals, oil products and other goods. Soaring temperatures are also curbing power generation, with Hungary shutting down its sole nuclear power plant. Energy prices are rising, straining Eastern European economies. Let's bring into the conversation Bloomberg energy reporter Eva Brendel, who joins us now. Eva, good morning. So Europe's river levels then are lower. How significant is it that we're seeing these lower river levels, and what does that mean for the energy complex?
Good morning. So it was very significant because we have been seeing high temperatures, almost no rain during the last weeks, and water levels in a lot of big European rivers are now near record lows or are already hitting the record low. So, yeah, for example, at the Rhine, we can see how transport is impacted. Vessels cannot load as much goods as they used to be, so freight rates are going up, and this is impacting companies that have to get their goods through ships, basically.
Okay, so an impact on freight, but also, Eva, on power. How is the lower river levels impacting power generation across Europe when, of course, you need that water for cooling?
So we have been seeing quite severe impacts in Hungary. Hungary had to shut its only nuclear plant on Sunday, and we've also seen that Romania had to reduce output at at a nuclear plant, and same things are happening in France, where throughout the summer we already had record heat-related outages, and now we are seeing again some outages that happened due to warm river temperatures. And this all brings power prices up, obviously.
And, of course, a political challenge for Peter Magyar as well. Eva, thank you so much. That's our Bloomberg Energy reporter, Eva Brendel, with the latest on the heat waves impacts. Well, coming up on the opening trade, we've got a slate of key AI earnings to look forward to this week, not least from Palantir and SpaceX. So we'll discuss those next. This is Bloomberg.
Being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid? I don't think I was reading magazines until I was in them. You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise Ahead or Gattaca?
Maybe somewhere in the middle.
Welcome to Bloomberg This Weekend.
Breaking news today from Wall Street to Washington.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything.
Welcome back to the opening trade. 48 minutes into today's session, and here is the picture in the European market. We are up 0.4% for the Stock 600, following gains in France and Germany, but weakness here in London by comparison, given that we have got oil lower. That's what's boosting sentiment elsewhere, but of course we have that exposure to energy here in London. So the Brent price now down 4.8% to $83 a barrel, on President Trump saying that talks are restarting between the US and Iran, but Tehran in just the past few minutes disputing whether that's actually going ahead. So oil pairing some of those earlier losses, Anna.
Yeah, so oil majors and AstraZeneca, that share down 6%, weighing on the London market. Let's pivot to some of the earnings stories that we're going to be focused on later in the trading day. The US software and analytics company Palantir is set to report second quarter earnings today, with expectations of a rebound following a disappointing first quarter. The earnings also come as Europe seeks to move away from US technology, with France saying in June that it would replace Palantir with a domestic provider. We're joined now by Bloomberg tech reporter Mark Bergen, who's been deep diving into Palantir and in particular can talk to us about the international dimension here. Good to see you, Mark. So how much of a negative dynamic is the landscape internationally for Palantir? Because yes, we talked about France, but here in London, the Met Police, the NHS, all kinds of questions raised about those contracts.
Yeah, I think a lot of it is questions. I mean, the France contract was a big contract with the intelligence agency. That is, to be clear, it's a 3-year contract they signed in December, so it's not going to be immediate hit to their revenue. But if you look at their business, if you just type in a terminal, look at their U.S. business is now close to 80%. Just a few years ago, it was around 60%. So some of that is because of the growth they've seen from the Pentagon and kind of U.S. commercial. There's a lot of attention from investors. But some of that is because, particularly in Europe, they have not had as much traction. And Alex Karp, the CEO, has spoken about that and very willing to tell investors his honest opinions about what he thinks about Europe.
Yeah, not backward on coming forward with that, but that's the kind of government side, the government contract side. What about the commercial side when you've got so much competition from the likes of OpenAI and Anthropic?
Yeah, I think that's investors are looking very closely at that, on the U.S. commercial in particular, but also rest of the world. So Anthropic and OpenAI are basically coming after Palantir's business of these forward deployed engineers, which looks a lot like AI consultancies, basically. And I think the argument from Palantir's side is that they've been doing this for a very long time. They have experience. I think the counterpoint to that is, what are they bringing to the table if this is something that OpenAI and Anthropic are going to compete with them very directly on?
We also have, in terms of tech earnings this week then, Mark, we've also got SpaceX, and the share price has dropped below the listing price, of course. And we also, it says space in the title, and we think of this as a company that is all about space. It is, but it's increasingly about putting data centers in space, and all of that means that AI is very much at the front and center of the earnings story here. So what should we expect?
Yeah, I mean, I think we don't know what to expect, given this is the first and given that it's Elon Musk. But AI is certainly a critical part of this, the XAI merger. Now we're seeing both the grand moonshot of data centers in space, but also Grok and its competition with Google, Anthropic, OpenAI. Probably there'll be some questions, I would hope, about some of the pressure from the Chinese open source competitors and how Musk is responding to that. And then obviously the Wall Street Journal had that recent report about plans for Tesla to perhaps be merging with SpaceX. We saw Elon obviously denied that, but that the grander Elon Inc. vision, I think we'll hopefully see a bit more of the pieces of the puzzle coming together.
Okay, Mark, thank you very much. That's Bloomberg's Mark Bergen with a preview of some of the tech earnings that we'll be getting later this week. And staying with that tech theme, Matt Garman, the Chief Executive of Amazon Web Services, will be joining Bloomberg Tech at 4:30 p.m. London time.
It seemed like cloud was the place to be last week, wasn't it? And that puts the focus onto that AWS interview coming up later on in programming. Let's look ahead to what else we're watching throughout the week then. We have, as we've just been discussing, US earnings from Palantir today. Tomorrow we get some data out of the US in the form of JOLTS job openings, but also some more earnings from SpaceX, crucially, as mentioned, and also AMD. On Wednesday, we get some European data. We also get earnings from Novo Nordisk, and in the US, earnings from Disney. On Thursday, we get Euro area retail sales, US initial jobless claims, some earnings out from Europe, some big German companies, and we move over to the US on Friday, where we get the US jobs report. And we talked about that with Mark Cudmore earlier on, about how there could be heightened volatility around that number. Let's talk to Bloomberg's Skylar Montgomery-Koenig, who is with us this morning to talk about, everything markets. And Skylar, let's start with the oil price, shall we? Because this is the big driver of a lot of moves in Europe this morning. The oil price is down by 5%. Absent the fact that we don't really know who's talking to whom, but at least the US has called off some big attacks, so they say, and say that some talks will take place. That at least tells us something about where their priorities are at right now when the oil price responds.
Yes, and I mean, I think that very much is the bias of the oil market. It very much wants to sell off on this idea that the U.S. doesn't want to escalate. It wants to negotiate ahead of midterms. They don't want oil prices higher and that feeding negatively into inflation and consumer sentiment. I think the issue is we haven't really seen progress on the key issue, which is on the Strait itself, who controls it. So if you look at traffic through the Strait of Hormuz, that's still very, very low. It's well below levels that we saw in June when you had that ceasefire and really true hope around de-escalation and transit resuming. And it's very, very well below the levels that you had that were kind of more normal in 2025. You also have the Bab el-Mandab Strait with pressure on it in terms of not a lot of flow going through there. And so I think, the downside we've seen in the oil price is a little bit premature. Something that I've looked at as a leading indicator is risk reversals. So the amount that investors are willing to pay for calls versus puts, that led the downside that we had in June, and that's still very elevated today. So it tells you that investors are saying, I'm willing to pay more because I think the risk is higher that you get oil prices rising on supply issues than downside on that supply coming online quickly.
Okay, so oil obviously a massive factor in the inflation story, but we were just also talking to our reporter Eva Brendel about the droughts and the falling river levels here in Europe. How much of a stagflation risk is that?
I think this is very much the stories of the 2020s in that this in itself isn't huge for Europe. It's more negative for Germany, but it adds on to all these other risks that we've had. So yes, GDP in the second quarter for Europe was better than expected because Iran didn't hurt as much, but you have all of these things building. So estimates I've seen for Germany on third quarter growth show that the drought levels mean that the closure or partial closure, disrupted shipping through this key riverway will reduce GDP by 0.2%. Now, third quarter estimates are only for GDP in Germany to be 0.1%, so it's very significant there, as well as to the companies that are directly impacted, right? So they have to pay higher shipping costs, they have production that's been shut down, and it just means that margins are getting squeezed, and it's not just happening there, right? You've talked earlier in the show about Hungary and power plant closures, that key power plant in terms of nuclear does almost half of the electricity for Hungary, and you've had wildfires elsewhere. And so it's just kind of adding to this very stagflationary backdrop that's a negative for bonds and equities in the region.
Okay, Skylar, thank you very much. That's Skylar Montgomery-Koenig with the latest on the markets. And just checking in on how we're faring in the European session. The Stock 600 up 0.4%. We're flat to the upside here in London. The CAC 40 up nearly 1%, and the DAX in Frankfurt up 1.3%. So that boost off the geopolitics, good for everywhere seemingly but London, as we see oil lower more than 5% now, $83 the barrel on Brent. That's it for the opening trade. The Pulse is coming up next. Stay with us. This is Bloomberg.
weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Oil prices tumble as President Trump says that new talks with Iran will begin later today with the planned attack called off. The U.S. and Japan say they won't hesitate to move again after their first joint action on the yen in 15 years. Plus, AstraZeneca slides after reports that it's exploring an acquisition of Bristol-Myers Squibb in a potential mega deal that would rank as the largest ever in pharma. So happy Monday, everyone. It is a Monday in August, and yet the news keeps on coming in. Now I'm looking at U.S. equity futures, European stocks both rising after President Trump said fresh U.S.-Iran talks would begin. That's boosting, I guess, a little bit of optimism for a deal to reopen the Strait of Hormuz. And then the other big story, of course, is yen, 156.73 against dollar. The yen strengthening amid speculation of more intervention after support from the U.S. The Japanese currency really advancing, with traders remaining on alert for further interventions. This is the picture for the European map. A couple of earnings that we need to watch out for. We are on the back end of earnings, but we're just getting to, still grappling with actually what we've heard from in AI. And then remember, it was only Friday that China's DeepSeek also rolled out a public beta application programming interface, or API, and that could still have repercussions this week. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Japan and the U.S. have warned of further coordinated action in FX markets. That's after confirming their first joint intervention in 15 years to lift the Japanese currency from a near 4-decade low. President Trump and Japan's finance minister both commented on the move.
We have a good relationship with Japan. We're very strong, very, very strong financially. They have a weakening yen, and they wanted a little bit of help, and we're always there for Japan. Japan's been very good to us, with the exception, of course, of Pearl Harbor.
Mr. President,
they were not good.
What is the U.S. getting out of that arrangement?
Financial benefit. Financial benefit. It's also good for the world economy.
We will not hesitate to conduct further joint intervention.
The Japanese Ministry of Finance and the U.S. Treasury will take decisive actions if any disorderly movements are detected, and those actions will be implemented. I am telling you that we are prepared to take actions at all times.
Well, I'm now joined by Brian Fowler, our senior editor in Tokyo, and then in a second we'll be talking to Derek Halpenny. But Brian, how has this intervention, or has this intervention done enough to actually stem the declines that we've seen in yen?
Well, Francine, if I could give you a definitive answer, I'd probably be doing a different job. But let's just put it this way. Historically, when we've seen joint intervention, it tends to mark the end of a cycle. So in 1995, the dollar fell below 80 yen for the first time ever. There was joint intervention buying the dollar back, selling the yen. And lo and behold, that's the end of that cycle. 3 years later, in 1998, the dollar had gotten all the way to 147, and authorities decided that it had gotten too high, so they did the reverse. They joined intervention to sell the dollar and buy the yen. And again, that cycle ended. More recently, in 2011, once again, we saw the dollar falling very sharply, fell all the way to 75 yen, and authorities jumped into the market, and that was the last of that. So I think I would say that probably this does mean that there's such a new level of risk for speculators to be aware of, that it probably does mean that we're not going to see the dollar go back into the 160 range. We'll still see speculative moves and pushing and pulling in both directions, but I think there's a range that's going to be a little bit stronger for the yen at this point.
Brian, what could further steps look like then from the U.S. and Japan?
Yeah, well, I mean, the first thing is they almost, having done this, they've injected such fear into the market that now part of the market's going to take care of itself to some extent. So this morning we saw a sharp yen rise of about 2 yen. Not really the scale you'd think of for real intervention, but could it have been a small amount of intervention? That's possible. Or it could have been algo trading, or it could have been speculators trying to make it look like intervention. So to some extent, they've given the market such a sense of caution that they can let the market sort of figure it out. We could also see further joint intervention at any time. Authorities from both countries have said that they're open to doing that. And then, of course, we could also see some monetary policy action. I think the action over the last few days in the currency markets raises the possibility that we'll see the Bank of Japan raise interest rates in September, and that would also put a floor under the yen.
Brian, thanks so much. Brian Fowler there in Tokyo. Now, we're also joined by Derek Halpenny, Global Markets Head of Research at MUFG. Derek, what a day to have you on. I mean, I'm a little bit obsessed with the story because also Japanese authorities broke their silence after we saw this photo emerge, right, of Besant's notepad at a cabinet meeting, and on the to-do list was like, buy yen. Like, how much do we actually know about what happened?
Well, we know that there has been joint intervention, and reports are saying that it was not the US dollar in terms of the US authorities, that they were selling the euro for JPY. And that makes sense, certainly if you look at the Exchange Stabilization Fund and the breakdown of what the US holds. Its largest portion of foreign currency is the euro. So in that sense, it does make sense. And I think there is a reason for the US to be somewhat reluctant to be seen selling the US dollar. Obviously, there's inflation issues in Japan, and it would go counter to that. So I think it does make sense that, if it wasn't the US dollar and it was possibly euro yen.
Do you think they'll do it again? I mean, there's now talk of intervention, or I mean, Brian, seems to suggest that actually once you've kind of hit a warning shot, then the market does its work.
Well, I would agree with Brian. I think this is very significant, and I think the US generally tends to choose its moments well. Yeah. To answer your question in terms of going forward from here, again, historically would suggest they probably won't do anything again. They tend to do a small amount on one occasion. When they bought yen in 1998, it was $833 million worth. So it was a very small amount, but obviously it had a very significant impact. So, to me, when all of this started to unfold, I was going, well, why now? This is the 6th episode of intervention, yen buying intervention since 2022. And what it looks like is that I think the US authorities have certainly become more concerned about the US Treasury market. Yields continue to grind higher. And if we look at the data from FX reserves in Japan, the reduction in securities holdings in the month of May was $75 billion. That's the largest one-month reduction in securities in Japan's FX reserves. So if that was to continue, that would certainly have potential implications at a time when yields are already moving higher. So I think that's definitely part of it. The other, and this is speculation, but the other hunch, and Atsushi Mimura, the Vice Finance Minister today, hinted that, maybe there's a deal being done here, because he stated that FX policy would be done in coordination with monetary policy. And he has informed the BOJ of this. So there's certainly hints in his comments today that the BOJ reaction function could start to change. And I think that would been a very important element of getting the US on side, because we know Scott Bessent in the past has been very critical about the BOJ's monetary stance.
Yeah, I mean, Scott Bessent also, I think, has an intimate understanding, actually, of the Asian markets, right? Which could explain also this unusually assertive stance, right, when it comes to yen.
Yeah. Like it makes complete sense that at least getting the monetary stance in Japan to something more neutral would be supportive for the Japanese yen. And if you take general consensus on what R* is in Japan, in nominal terms, that would imply getting to about 175 on the policy rate. And the current curve, although it's moved forward in terms of pricing it quicker, it's taking too long, I think, for investors to become confident in BOJ monetary policy. So I think a move in September is likely. That's what we'd been expecting even before all of this started to happen. And I think that will certainly play into helping to support the yen. But of course, it's not the only factor. But
Derek, how big of a move, and what happens after September?
Well, 25 basis points, I think. So we get to 125, and then we continue with the suggestions of more to come. Going in September is very important, because that would be the first time of just a 3-month gap between one hike and the next. So it would signal a faster pace. So potentially another one in January 2027, which is where we're penciling it in. And then very quickly, the markets then are thinking that actually in the next 12 months, we'll get to that neutral rate.
Right.
Now, admittedly, some of that is price, so I don't think it's a game changer. But it's an important element. Obviously, what's happening in the Middle East, what's happening in global yields, all of that is very important. And if the Fed end up raising rates, which is not our view, but if they did, the grounds for seeing dollar yen going significantly lower from here is I think, difficult to envision. But certainly, again, I agree with Brian in Tokyo. Getting back above the 160 level looks, I think, much more difficult in this environment.
Okay, Derek, keep it there, because we'll talk a little bit about the Fed and also oil prices. Derek Halpenny from MUFG stays with us now. President Trump says new talks would begin this afternoon after he called off a planned attack on Iran. The U.S. president also suggested a deal to reopen the Strait of Hormuz is near. Let's get more from our Abir Abu Omar. Abir, so we've been here before, but what do we know about the new round of talks?
Good morning, Francine. Not much. To be clear, we don't have a lot of clarity on what exactly these talks will be about, where they would happen, and if the mediators are going to be involved. Now, we heard moments ago from the Iranian side about President Trump's remarks about these talks commencing. Now, he did go from threatening an attack against Iran that would be the biggest since World War II to then saying that those negotiations with Iran are set to continue. Now, from the Iranian side, again, moments ago, we heard from the foreign ministry, the spokesperson saying there are no active negotiations happening with the United States. As a matter of fact, he did say that Abbas Araghchi, the foreign minister of Iran, is in pilgrimage to Iraq, and that other Iranian negotiators are in Iran for the time being. So yet again, this back and forth between the president of the United States and the Iranian side. Now, if these talks do happen, Francine, front and center will be the Strait of Hormuz. You mentioned it there. You mentioned what President Trump had said about it. The nuclear component, the main goal role of the United States and the reason it went into this war with Iran in February has taken a back seat in those negotiations. Right now, both parties are focused on opening the Strait of Hormuz and getting a trickle of movement through. This is what Iran is also talking about with Oman. They're trying to establish a middle route in the Strait of Hormuz to get the much needed trickle of movement through the Strait of Hormuz. Again, we heard from the Iranian side earlier about those talks with Oman being close to a final stage. So wait and see. Yet again, Francine will update when there is something monumental to update with.
Abir, thank you so much. Yeah, we'll follow every twist and turn of this story. Abir Abu Omar there in Dubai. Now let's bring in Bloomberg's Justina Lee. So Justina, given what Abir was explaining, how are markets reacting to Trump's latest U-turn?
Yeah, I think we're all used to this set of market reactions now whenever there are any signs of a resolution in this conflict. Now, it all begins, of course, with the move in oil down about 5% today, easing some of those inflation concerns, and that's lifting gold a little bit too, and of course, kind of bringing down the U.S. 10-year bond yield. Now, when it comes to currency, on one hand, it's a bit of a risk-on day with kind of signs of talks beginning again, but of course, it also comes down to that big intervention, joint intervention between U.S. and Japan in the yen, and that also explains, broadly some weakness in the dollar today, Francine.
Meanwhile, chip stocks tumbling in South Korea. What's the latest on tech?
Yeah, what's really interesting here is that, on Friday, we got a record surge in the Kospi. And actually today, semiconductor stocks all across Asia aren't all down, but we are getting a bit of a pullback in South Korea. And I think that kind of indicates that even though we had a big recovery on Friday, a lot of investors still want to reduce leverage. And so we had, the Kospi index down 5% again. And generally, and you can see why this might be a South Korea-specific story, because actually NASDAQ futures are up today. And the Asia Semiconductor Index down a little bit, probably dragged down by a lot of those South Korean names. And another big headline in tech is Alibaba. They just released a flagship AI model that some people are saying could be as good as something like Anthropic's Fable. And we can see a pretty big reaction today, up 7% in Hong Kong, Francine.
Justina, thank you so much. Justina Lee there with the very latest on the markets. Let's return to Derek Halpenny, Global Markets Head of Research at MUFG. Derek, when you look at, thank you so much, first of all, for sticking around, but when you look at the Middle East, it's a stop and start.
Yeah.
So actually, it's unclear what traders are basing their optimism on.
Well, I guess the optimism is, I certainly think, Trump wants a deal. And there's a bit of a link here with what we were talking about earlier with Japan intervention on mentioning the concerns about treasury yields. And I think, I think the administration is becoming concerned about rates in the US, and this gradual grind higher real yields the highest since the global financial crisis in 2008. And if it had carried on through August, and then the markets come back to life in September, October, and if oil was up at over 100, the Fed potentially tightening, ECB, BOJ, suddenly across G10, you've got a wave of monetary tightening, another lurch higher in rates, and that could have been a catalyst for a bigger correction in risk assets, which I think ultimately will come if rates continue to grind higher. So it's about tackling that element, of course, but there's other elements. But I think Trump wants a deal, and that's why he's gone back into negotiations and ultimately going back to the original memorandum of understanding and giving Iran more control on the Strait of Hormuz, which was what was implied by the original deal, might be where we're going.
Derek, overall, we've seen some pretty big moves in bond markets, especially treasuries.
Yeah.
Is it because they're signaling something coming worse, or is it a wider concern of some of the levels?
I think there's a couple of elements. Definitely Warsh, bigger term premium in relation to less guidance. Yeah. I think that makes complete sense. But, there's also, we see some signs of maybe investors starting to consider, higher R-star, higher neutral rates, may be related to AI and this demand for capital, and that ultimately that is, I think, also playing a role in pushing rates higher. And then just the usual cyclical elements, concerns about inflation and Although, relatively speaking, you know, forward inflation rates in the markets have been still relatively stable.
And you're not expecting actually the Fed to move this year?
No, again, going back to what we think, Trump wants a deal, and therefore we don't expect that to play out and ultimately crude oil prices to come back down. And if that's the case, then I think Warsh has a little bit more leeway. And if we get through this window, which I would say is between, you know, the September meeting till the end of the year, then I think we're done. The next move is going to be a cut in 2027.
What's your take on Bank of England? I mean, last week there was a fair pushing back, actually, because of the way that the MPC voted on what comes next. And it doesn't look like, you know, a rate hike is really on the table, or is it?
It's like, it was a 6-3 vote, but I think, you know, the three hawks, there was no surprise there. And really the entire theme was the same. It was the international inflation risks versus the weak economic domestic conditions. And I think they really want to hold out. And again, based on the view that I've just expressed, the Bank of England won't have to raise rates either. But if we're wrong and crude does move higher, I think we're close enough for the committee to flip and be forced into a rate hike, which wouldn't be positive for sterling because they're essentially being forced into it because of external conditions with weak economic conditions at home, and I think ultimately that wouldn't prove particularly supportive for the pound.
Derek, as head of research, how much time do you spend actually looking at AI and the impact it has longer term on our economy, so on labor, on productivity, but also inflation?
Yeah, like we've just written a big piece on FX and AI, and it's hugely important. And I think shorter term, based on what I said a moment ago about rates and the upward pressure on rates and the inflationary risks over the short term. But, you know, if this goes successfully, you have to ultimately come to the conclusion that there is a productivity benefit at the end of the road. And then it's about relative productivity in FX. And if it's the US that's the beneficiary, then over the longer term, that's definitely a positive for the US dollar.
Derek, thank you so much for joining us. As always, Derek Halpenny, Global Markets Head of Research at MUFG. Now, coming up, another twist in the Italian banking M&A saga. We'll bring you the latest next, and this is Bloomberg.
up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
What happened was you were out.
Welcome back, everyone. Monte dei Paschi is reportedly exploring a takeover of Banco BPM after talks over a merger of the two banks collapsed on Friday. Now, that's according to the Financial Times, which says that Monte dei Paschi's chief executive has considered approaching BPM's large shareholder, Crédit Agricole, to discuss a move. It is confusing, it's complicated, but it's great fun to follow. So let's bring in Stephen Ahrens, who leads our EU finance coverage. Steve, so what do we know about the status of this potential deal?
So as you said, it's probably something that's being considered at Monte Paschi. Lovaglio, the CEO, wanted a deal with Banco BPM. They were talking about some kind of merger that fell apart over the weekend, probably after Crédit Agricole on Friday signaled they're kind of, skeptical of the deal. So as you said, it's very complicated. This deal now that's under consideration, according to someone else, would be facing probably similar obstacles, though. So I'm a bit skeptical because Crédit Agricole, the largest shareholder of Banco BPM, seemed to be reluctant to be on board with merger talks between the two banks. So why would they really be in favor of these talks? But it shows, I think the story shows just how much Monte Paschi is weighing his options now after the previous plan fell apart.
So how does all of this play into Monte dei Paschi's defense against Intesa Sanpaolo's takeover?
Well, again, I mean, Intesa, you're right, the biggest Italian bank has tabled an offer for Monte Paschi. That one is active. At some point in the future, shareholders will get to decide on this one. And Monte Paschi, the CEO, doesn't really like the idea because it would break apart Monte Paschi, the oldest bank the world's oldest bank in operation. So he's against that, and he's trying to figure out what else he can do. The talks with Banco BPM was one idea that would have made it much more difficult for Intesa to buy it, and I guess another bid, so a bid for Banco BPM now would do something similar. I'm sure he's thinking about other ways to make sure that whatever his plans for Monte Paschi are will go ahead and probably thwart Intesa's bid.
Stephen, thank you so much. Stephen Ahrens with the very latest on Italian banking. And I know the story will run and run. Now, Bloomberg has learned that British drug maker AstraZeneca is said to have explored the acquisition of Bristol Myers Squibb. A deal between the two leading pharmaceutical companies would create one of the world's largest drug makers. Well, let's get more from Ashley Furlong, our health reporter. Ashley, this is a huge, huge deal. So first of all, congratulations to the Bloomberg team for actually breaking it. But what do we know about this proposed deal?
Very little at the moment, unfortunately. We know that there were preliminary talks. We don't know if those are ongoing, if they've already completed. This sort of comes against a backdrop of discussions about whether a mega merger would be possible between two large pharmaceutical companies. That's been sort of going on over the past year or so. But there's lots of arguments against a mega merger, and we can see that investors in AstraZeneca are clearly not really keen on this idea with Bristol Myers Squibb.
And so could there be significant pushback for such a merger?
Lots of obstacles. Obviously, the biggest one will be antitrust concerns. Both have large cancer portfolios. There might need to be divestments of some of those drugs. And just, two companies this size, this will be the largest pharmaceutical deal ever. So there'll be a lot of concerns there. There'll be concerns about where they will domicile. Will they domicile, will it stay in the UK? Will it move to the US? Those sorts of questions. And then there's also concerns around R&D productivity. We've seen in the past that when there's been mega mergers, they haven't been really that good for drug development. Drug prices can go up. Obviously, a lot of staff jobs will be cut. They can sort of cause a bit of chaos when you have these huge deals. So I think the market is very, very clear that they're not really keen on this. There are also synergies potentially. You can cut potential duplication. AstraZeneca would get access to a much larger US commercial footprint, exactly manufacturing, that sort of thing. But they already have quite a large footprint in the US, so it's everyone's sort of like, why does AstraZeneca need this? We're not quite sure yet.
Yeah, many question marks, and I have to say, in today's trading session, AstraZeneca is getting slammed. Ashley, thank you so much, as always, for joining us. Ashley Furlong. Now, coming up, the EU is set to hold emergency talks on the Kuwait migrant crisis as the fallout grows. We'll bring you the latest, and this is Bloomberg.
the Vivian Tom clientele.
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Oil prices tumble as President Trump says new talks with Iran will begin later today with a planned attack called off. The U.S. and Japan say they won't hesitate to move again after their first joint action on the yen in 15 years. Plus, AstraZeneca slides after reports that it's exploring an acquisition of Bristol-Myers Squibb in a potential mega deal that would rank as the largest ever in pharma. Now, EU ambassadors are convening for an emergency meeting today as Spain faces calls to reassert control over the bloc's external border. It comes as the Spanish government confirmed that 50,000 people have illegally crossed the border between Morocco and Ceuta, while Spain says the, quote, vast majority of them have since left. Let's bring in Chad Thomas, our executive editor for Europe. Chad, good morning. So the Spanish Prime Minister has accused EU countries of a selfish response to the crisis. How politically isolated is he within the bloc?
Hi, Francine. Well, this really exploded at the end of last week and over the weekend. It just actually really shows how isolated Sanchez is and how many people he has upset in the last months with some of his policies. He's often out of step with many other EU leaders when it comes to questions like migration. Some have been accusing him of the lax migration policies that Spain has implemented as being a reason for this influx that Spain now says is under control. Also, you have to remember the whole discussion around NATO. Every NATO member except Spain has agreed to increase their spending to 5%, and that has also angered a lot of NATO members that Spain isn't, in their view, doing their parts. So there was a very strong response over the weekend from many EU members to what we saw unfolding there in Ceuta.
But the EU is set to hold emergency talks. So what actual action, Chad, can we expect?
Francine, I think actually what we're going to see, to be quite frank, is a lot of rhetoric. There are many EU countries that are on the cusp of holding elections, and this is a hot button topic, and so no leader wants to be seen as the one who's not cracking down on any concerns that people might have over illegal migration. But most of these people have already returned to Morocco, and of course, they never were actually on the Spanish mainland. They were in this enclave, so it doesn't really seem that there would be a huge amount that would unfold here, but that letter that was sent over the weekend was signed by 22 EU members, so it just shows how strong the reaction was. Two countries that didn't sign it, interestingly enough, were France and Portugal, and of course they share long land borders with Spain, so it's interesting that those two countries did not weigh in on this over the weekend.
Chad, thank you so much. Chad Thomas, our executive editor for Europe. Now we're joined by Tina Fordham, founder and geopolitical strategist at Fordham Global Foresight. Tina, we'll get onto the Middle East in a second, but when you look at Spain, I mean, are they really isolated? I don't know whether there is a, I mean, Giorgia Meloni of Italy, you know, said we even have to stop the Schengen Agreement. There will be far and wide repercussions.
Well, Pedro Sanchez, the Spanish prime minister, finds himself in the extremely unenviable position of being on the sharp end of criticism, both from the United States, where Spain is singled out for, you know, not helping in the Iran war and the NATO defense spending, and then the migration policies, which put him at odds with a lot of EU member states. So this is a pressing time and criticism for his government, but I think there's a lot more going on beneath the surface here.
What do you think is going on?
Well, first of all, look at where this happened. You can see the terminology, that's being used, enclave, it's an exclave. It's not in the Schengen Agreement. Giorgia Meloni is wrong in terms of her suggestion of closing, shutting Spain out of Schengen, et cetera. But this is another choke point. This waterway, extremely narrow, swimmable between Morocco and Spain. And just like the Panama Canal and the Strait of Hormuz, one of the things that's exposed by this incident is this sense, that it may be in the interests of many that Spain can't control it.
Yeah, I mean, for me, it really goes to the fact that there are many politicians in Europe that feel the pressure from, the further right. And so when you look at France with elections next year, when you look at Italy's, position right now, do they really need to talk very tough on immigration? Otherwise, more far-right parties will emerge.
Well, everybody made political hay for their domestic audiences as a result of this very tragic crisis, which lost the lives of estimated 72 million people. As your correspondent said, look who didn't sign, France and Portugal. Look who was quite loud, Mette Frederiksen in Denmark, which, by the way, Denmark has benefited from a lot of EU solidarity over the U.S. threats to Greenland, and Meloni, who, of course, has elections coming up next year. We've got a EU super cycle of elections next year. Immigration and kind of reinforcing those populist right talking points are going to work for a lot of leaders.
Tina, do you think, there was a moment where we thought Ukraine would break up Europe? Do you think immigration is the one where you could see countries splinter off?
It is an issue that has moved to the center, I would say. It's no longer the preserve of right-wing populists. It's become a centrist issue. It's become mainstream. And so, again, for many, looking at those scenes of tens of thousands of people trying to make their way to the EU was reminiscent of the 2015 Syrian refugee crisis, which, of course, happened at a very sensitive time in this country ahead of the Brexit referendum, made a lot of problems for other European member states. So this has been another reminder of the centrality of immigration, but I happen to think that the singling out of Spain is a bit unfair. As an Italian, you know how many migrants come through Lampedusa, so does Giorgia Meloni, and there's going to be more of this kind of drama as we head into this big election cycle for Europe in 2027.
Tina, where are we in the Middle East? So it seems like we're maybe back on track with the memorandum of understanding that we thought we were on track with a couple of weeks ago. Is there trust between Iran and the U.S., or enough trust to actually get a deal done?
The best news is that there's been another, of many momentary de-escalations. This is welcome. Oil prices were getting over $90. Is there trust? No, there isn't, and why would there be? These are two parties that have been, manipulating and taking advantage of every opportunity that they can. It's in neither party's side, the U.S. and Iran, to, bring about a massive escalation. Iran is still the weaker party from a military perspective. But the U.S. is trapped in a problem, arguably entirely of its own making. The Omanis and Iran have been discussing a deal on the waterway. I don't see how the White House will agree to this. And so we have this constant cycle of escalation and de-escalation. But in the meantime, to just kind of go beyond the headline risks, the UAE has resumed its extremely pragmatic position, talking to both Iran and Israel. And the Saudis appear to really be asserting themselves with the White House, saying that they and the region don't want to see what Trump threatened, which was a massive destruction of Iran's energy infrastructure. We've already got that happening in Russia right now.
What does it mean in terms of who controls the Strait of Hormuz? Because if you look at, again, the Memorandum of Understanding seems to give Iran a little bit, actually quite a lot more power than it had 7 months ago.
Iran has been strengthened counterintuitively and by this conflict, after this conflict, and this tells us a lot about modern warfare. The United States is, of course, the biggest, best equipped, has every type of weapon. It's not quite David and Goliath. Iran has immense ability to also project damage. Remember those cyber attacks on U.S. water processing plants? Finger being pointed at Iran. This is very asymmetric, and that's the nature of power projection right now in our world. Very hard to track, not black and white, and most importantly, doesn't fit into the way market participants like to think about risk, right, which is tail risk, or binary outcomes. This is gray zone, asymmetric. Who wins? Very hard to say.
Does China like this gray zone? Because there's questions on whether actually they were trying to temper it, but it feels like maybe they could take advantage of the situation.
China is benefiting right now from the chaos that the U.S. is perceived to have induced. It doesn't want to change that, but nor has China ever liked a truly chaotic global environment. It still leans toward the rules-based system. What it wants is rules that fit in more with its own goals. So, I understand that China is leaning on Russia not to go back to that nuclear saber rattling, but can China really control all of these spinning plates? Highly unlikely.
Tina, thank you so much for joining us. As ever, Tina Fordham, founder and geopolitical strategist at Fordham Global Foresight. Now, 2 people were killed after 2 helicopters collided in Greece's Attica region while fighting a wildfire. 4 consecutive heat waves and worsening drought have gripped the continent, with consequences rippling beyond the record temperatures. Now, Europe's biggest rivers, the Rhine and the Danube, are drying up. Let's get more with Joe Wirtz, our weather reporter. Joe, thank you for joining us. So how is the heat actually impacting Europe's rivers, and what's been the consequences?
Yeah, so the Danube is, stretches of the Danube have reached record lows in recent days, and the Rhine is, been poised to reach record lows and has seen critically low levels there. And this has really choked shipping. I mean, the shipping costs go up when these rivers get low and hard to navigate. We've seen a ton of impacts from having to transport different goods on these rivers, from oil products, energy products, and different commodities. And also in Hungary. Hungary had to power down their only nuclear plant over the weekend for the first time because they rely on the Danube for cooling water. And with those low water levels, and even with emergency measures to try to pump the water out of those low rivers, they were forced to power down. So those rivers are really key, key for commerce in the region. And when they get low, it's just impossible to navigate.
What's the latest on the wildfires, Joe?
Yeah, so the wildfires, they've had hundreds of firefighters across the continent, particularly right now in Greece, as you mentioned at the top. The wildfires there, the firefighters seem to be getting some control over the blaze there. But as you mentioned, the helicopter crash over the weekend highlights how dangerous and difficult these are to fight, and many of the same factors that are leading to these fires spreading so quickly, the high winds, the gusty winds, is likely a factor in the helicopter crash there, and they're also the ones spreading the flames. So a lot of the same factors that are making these fires dangerous and fast-moving are the same ones that are making them hard to fight. But right now, very high fire danger across the continent, and just indications that the heat, low humidity, and these dangerous conditions are just set to continue for weeks.
Joe, thank you so much, as ever, for your fantastic reporting. Joe Verts there with the very latest on the wildfires. Now, coming up, FIFA's president faces a battle to keep his job as pressure over his axed investment plan mounts. That's coming up shortly, and this is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Earnings season is here.
There are earnings galore.
Some areas have done well. Equity trading has been an area of resilience.
Bloomberg is first to break the numbers.
Diving through the details of these earnings.
That is the weakest growth in more than 3 years.
With the smartest insights.
Are we seeing dislocations that point to something a little bit more severe?
If you look at where global growth expectations are, compare them to the start of the year, they're actually pretty similar.
But there is this uncertainty, and we haven't seen it in the results.
Continuing coverage on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacroix here in London. Now, a busy European earnings season is set to continue this week alongside results from banks and airlines. Attention, of course, will turn to Danish multinational pharmaceutical company Novo Nordisk. Well, we're now joined by Chloe Melly, Bloomberg's EMEA earnings specialist, and Tim Craighead, Global Chief Content Officer at Bloomberg Intelligence. So thank you both for joining us. Has it been fun? I don't know. Are we over earnings now? But Chloe, what's been the highlights from the week?
Yeah, so the week ahead that we're looking at, we've got a lot of different themes that we're going to be focusing on. Of course, there's AI that's been top of mind for the last few weeks with the earnings. And this week we've got Siemens Energy, so making gas turbines for data centers. We'll see if that order momentum from the last few quarters continues there. There's also the German chip maker Infineon, which has also been having a pretty good year. And both of those results will tell us something about this AI spending and the sustainability of that AI demand. There's oil, of course, always in focus. We've got BP reporting tomorrow, and we've had Shell and Eni last week, so that tells us a bit about what we can expect, probably very strong results. And then some consumer names as well, especially alcohol consumer names. So we've got Heineken and Diageo, perhaps signaling a World Cup boost, but at the same time having to deal with that continued weakness in the US market as well.
I mean, earnings season for us, it's like a marathon that you have to run like a sprint. So what, in terms of themes, is it quite clear what we're looking for?
Yeah, I think so. There are a couple of key things that are shaping up, driving this earnings period, which has undoubtedly been a constructive one for Europe. One is financials. Net interest margins are higher. as we look at high interest rates. As Chloe had mentioned, energy has certainly been constructive given what we're looking at from the standpoint of elevated energy prices. The industrial play that is feeding into both AI with data center build out, the electrification of economies around the globe. Europe is quite well positioned in that sort of second derivative of the AI play, even if there aren't the LLMs here in the region. So I think those are all strong suits and important to continue to focus on.
Chloe, what can we expect from Novo Nordisk?
Yeah, so it's interesting the context in which it's reporting. So it's a company that's been dealing with a lot of competition from both copycat drugs and then, of course, its biggest rival, Eli Lilly. And so the narrative at the start of the year was that any rebound would be really dependent on its weight loss pill. And it seems that this has been quite a successful launch for that Wegovy pill. It's had quite strong uptake, maybe stronger even than the weight loss pill from Eli Lilly. And so we could see some analysts are saying potentially there could be a guidance upgrade on the back of that. So I'll be watching out for this potentially from Novo Nordisk this week.
Yeah, and there's so much more, right, to kind of go through. I know your team really go through it with like a fine-tooth comb.
Yeah, I mean, the ones that stand out to us, I would agree on Wegovy. That is the showstopper this week. We run a every 6-month survey of doctors prescribing drugs in weight loss, and it seemed to us that the doctors were much more positive on Wegovy versus Lilly's pill relative to what was embedded in consensus expectations. So this is a real touchstone. Beyond that, HSBC reports were quite focused on what they're seeing with Chinese wealth management flows. I think with BP coming, not only will it be a good result because of where oil is, I think a big focus will be on what they do in the North Sea, given how that's a political issue here in the UK. And I think, picking up on the Diageo comment, there's a new CEO. What's going on from the standpoint of restructuring the company, trying to engender growth? They've got exposure both to China and the U.S., and so a pulse check, a finger on the pulse with that will be quite telling.
I mean, when you look at the biggest contributors, how much of it is cost cutting overall? Well,
I mean, there has been cost cutting in that business for sure, but they're definitely trying to drive. I mean, you've got to drive growth with innovation, and at the same time, think about what was a big inventory overhang that's now pretty well clear in the U.S. So fingers crossed. I mean, there are signs of growth in the U.S., and hopefully that plays through.
Okay, thank you both for joining us. A terrific briefing, actually, on what we've known so far in terms of earnings. Chloe Melly, Bloomberg's EMEA earnings specialist, and Tim Craighead, Global Chief Content Officer at Bloomberg Intelligence. Now, financier Amanda Stavely is planning to return to football club ownership. In 2021, Stavely helped secure the Saudi investment fund's takeover of Premier League club Newcastle United. And in the latest episode of the podcast Leaders with me, Francine Lacroix, Stavely explains her decision to sell her 6% stake in Newcastle 2 years ago and talks about her desire to return to the sport. Now, the interview was recorded before Bloomberg and others reported that a consortium led by Stavely has agreed to buy a 25% stake or share in English club West Ham United for £150 million.
It was the toughest decision I've made. It was so hard. I rowed with my husband so much about it. Had such good memories, and it was really hard. But we felt very much that, we got a great offer for our shares. We also felt that we'd done an awful lot, and perhaps we were doing too much, and that the management team wanted the chance to be able to run the club the way they needed to, and they needed to be able to deliver, and it was a very hard decision. In fact, right up until the day we agreed it, I was still rowing. I was in tears for many days. Didn't want to do it.
Is that the hardest thing, to walk away from something?
Yes.
Is that a good leadership lesson?
Amazing. But that's leadership. You've got to make decisions. And also it's difficult because I was a stakeholder, an owner. And PIF were the majority owner, and I wasn't the owner. It's hard when they're saying to me, "Oh, Amanda, you haven't quite bought that brilliant player in at this price." We were delivering, but it was hard when the management team, if they can tell the management team off and say, "Why isn't this being done?" well, Amanda and Murdad are there all the time. So we needed to give the management team a time to deliver. I think we've also been able to raise, a great deal of capital to invest in other businesses. So if we'd not had the success at Newcastle, maybe we would not have been able to do that so well.
What's next for Amanda Staveley? West Ham?
Oh, gosh. Another club, another Premier League club. Or...
Which one?
I can't say. We're looking at a number. We've done a huge amount of work. Whatever club we take there'll be a big property play as well, because we won't just do a football-led, or might be some other league. We like the US as well.
And you can listen to that episode now wherever you get your podcasts. You can also catch it on Bloomberg TV a little bit later today, 10 p.m. UK time. Now, pressure is mounting on FIFA President Gianni Infantino after plans to privatize the federation's commercial arm fell apart. UEFA, Europe's football governing body, says it has lost confidence in FIFA's leadership. CONCACAF, which represents North and Central America, is calling for accountability, saying FIFA leadership, quote, stopped putting football first. Well, Tiwa Adebayo has been following the story and joins us now. Tiwa, thank you for joining us. I mean, first of all, it feels like actually the backlash was so big. How significant was it?
Well, it's been really significant. I mean, Infantino, this was supposed to be his flagship plan, and it's perhaps rather embarrassing that it's had to be this U-turn. But we've definitely seen a shift over the last week. We saw many of the major bodies come out against the investment plans, but now that's actually shifted into talk about Gianni Infantino's leadership and FIFA's leadership itself. There's definitely been a bit more of a step up in discourse. You mentioned CONCACAF. We've also heard from other bodies, UEFA, saying they'll pursue legal or regulatory action against Infantino. Definitely kicked up a gear. And of course, this morning we're hearing from Wales, the first nation to say that it won't back Infantino's re-election bid. We could hear from more in the coming hours, but he definitely looks to be in a very difficult position.
Does he have any backing from FIFA members?
Well, I mean, we saw actually last week, even executives within FIFA were questioning these plans. So there's limited support. Actually, the only body that seems to be more accepting of these plans is CAF, which is the body that represents African teams. Now, Motsepe, who is the president of CAF, and Infantino have had a historically close relationship. He said they've been loyal, they won't stab FIFA in the back. Perhaps that's the only support that he has, only significant support. That's 54 of the member states of FIFA that are represented in that African bloc. But it does seem that support outside of that is rather thin on the ground. And actually, we've seen the opposite with these member organizations really coming out quite strongly and also criticizing, as we saw with CONCACAF, what they're saying is a pattern of behavior from Infantino. So it's gone past these investment plans now, and they're really looking quite closely at Infantino's leadership.
So, Tiwa, what happens next? I mean, I guess there's some precedents, but not really, something like this. So in terms of timeline, or do you have any hunch of what we're looking at?
Well, it really depends what Infantino chooses to do. We saw, of course, with Sepp Blatter, the quickest route is resigning. It doesn't seem like that's something that Infantino wants to do. We could see the FIFA Governing Council actually force him to leave by calling an emergency meeting, but that would mean that you'd have to have a majority voting for that to take place. So it all depends on whether he chooses to exit himself or he tries to fight this out. But as I say, it's a difficult position, especially having lost the confidence of UEFA, perhaps the most powerful bloc in world football.
Tiwa, thank you so much for joining us. Of course, we'll continue keeping the story very close to what we cover. Tiwa Adebayo there with the very latest on FIFA and Gianni Infantino. This is the picture across the board for markets. First, there's quite a lot of earnings coming through. Then I would say watch out for anything that could further look at yen intervention. So stocks are rising, oil is plunging because there are a little bit of signs about easing tension between the U.S. and Iran, and that has pushed oil prices lower. It does seem to be allaying some concerns about faster inflation. You can see Brent 84.18. Up next, Bloomberg Brief, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent. But when she's here, she can have her app open, and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
About to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Yen intervention. The U.S. and Japan warn they won't hesitate to defend the currency further after their first joint action in 15 years. Deal talk uncertainty, oil dropping as President Trump calls off military strikes and maintains talks with Iran are set to start again. And a structural rethink. Fed Chair Warsh said to be mulling the possibility of changing how often the FOMC meets to set monetary policy. Quite the session across Asia once again with volatility in Korea and intervention in Japan. Let's get to Winnie Su for the latest from Hong Kong. Winnie.
Yeah, good morning, Bonnie. Well, another very exciting day for the Japanese yen. We did see the yen strengthen by as much as 1.4% earlier today. It did pare back most of those gains, but still investors are on speculation that there might have been another round of intervention, or maybe it was just some jittery around traders as well as some algorithm in the background. But for now, we are not exactly sure what has driven that strength. But what we know is that this strength in the Japanese yen pressuring Japanese stocks which have a big exposure to exporters that usually benefit from a weaker yen. And when it comes to the yields, we did see also two-year yield rising on the back of expectation for the Bank of Japan to raise rates earlier. Now, before we take a look at the broader Asia market, because overall Asian stocks under a bit of pressure despite the lower oil prices supposedly providing some support for the market sentiment. We are still seeing South Korea's Kospi index leading declines today, down more than 5%, reversing some of those 18% surge back on Friday. Now, another bright spot that we see today in our region is textures in Hong Kong, led by Alibaba after the company announced this new AI flagship model that has performances on par with that of Anthropic's products as well.
All right, Winnie, thank you so much. Winnie Su there in Hong Kong. Now let's get to London for an update from Europe. Here's Justina Lee.
Good morning, Vonnie. Now, I feel like we've seen this movie again, because once again, there are hopes for kind of deal talks, and then once again, oil is down. So naturally, we are seeing gains for the stocks Europe 600 today, led by a lot of those cyclical names, such as car makers. And actually, the German DAX index is near a record high again. And now, of course, is it also a great day for bond yields? I want to highlight the UK move in particular, because the 10-year gilt yield is down 8 basis points today, and that's outperforming the rest of European bonds. And relatedly, that might be why the pound is depreciating a bit today, even though generally we're seeing a bit of dollar weakness on the back of that yen intervention. Now, if we flip the board here, we've heard a lot about those yen moves, but interestingly, according to what my colleagues have reported, the U.S. might actually have intervened via the Euro-Japan cross rate in order to not be selling the dollar. And so if we kind of see that exchange rate here, we can see a big plunge, that move over the last 3 trading sessions, all thanks to that surreal joint U.S.-Japan action.
Yeah, just, quite the move, and a 4.3% move versus the U.S. dollar as well. That's Justina Lee in London. Here in the US, we are coming into August on a positive note after so much was digested by the market last week and more to come this week. Futures pointed higher, really across the board. If we look at yields, they're coming back down just a slight bit on gas and oil prices coming back down, about 3 to 4 basis points apiece. And then if we move to the oil market, you'll see that we are down 4.5% when it comes to Brent. And we were actually down more than that earlier, but Iran came out and said, hang on, there are no negotiations with the U.S. right now, just negotiations with Oman. Nevertheless, President Trump did insist they would be restarting this afternoon. So here's your picture, Brent crude below 85 and WTI below 81. Let's get to some individual movers now with Chloe Melee in London.
Good morning, Vonnie. Let's start with some M&A this morning. Bristol Myers and AstraZeneca are said to have explored a merger which would create one of the largest drug makers in the world. We've seen actually AstraZeneca investors be quite skeptical about this potential tie-up, and that has dragged down the shares in London. But then for Bristol Myers, it seems that investors are a little bit more enthusiastic about this potential deal, and we're up almost 8% for that pharmaceutical company in pre-market trading this morning. Moving on to another M&A story, we've got Atcor, which is an electrical equipment manufacturer, getting bought by Prysmian, an Italian company, in a deal that values it at $3.8 billion, including debt. We are seeing that really drive the shares this morning. We're up more than 26%. And finally, the plumbing and HVAC supplies company, Ferguson, is up this morning as it is set to join the S&P 500, replacing Electronic Arts. And we're up almost 8% on the back of that as well this morning.
And speaking of which, we're going to be speaking with the Prysmian CEO this hour on that particular deal, Chloe, so thank you very much for that. We're also going to be speaking with Rebecca Walser from Walser Wealth Management on a potential revamp at the Fed. And again, as I said, Massimo Mattaini, CEO of Prysmian, later on. But first, the US and Japan take joint action on the yen.
We will not hesitate to conduct further joint intervention. The Japanese Ministry of Finance and the U.S. Treasury will take decisive actions if any disorderly movements are detected. We are prepared to take actions at all times.
We have a good relationship with Japan. We're very strong, very, very strong financially. They are, they have a weakening yen, and they wanted a little bit of help, and we're always there for Japan.
Joining us now from Tokyo is Bloomberg's Alice French. So we saw 4.3% strengthening versus the US dollar. Alice, is this enough to scare the bears away?
Morning. Yes, I mean, that is the big question, and we're closing out really a wild few days here in Tokyo. As Winnie mentioned, we did have another sharp strengthening in the yen this morning around 9:20 a.m. local time. Now, the yen has given up most of those gains, but it's still trading stronger than it was on Friday night. And I think the general consensus here is that the message from both the US and Japan side is that this is not a drill. This is not a time to be betting against the yen. The authorities are serious about this. We had Finance Minister Katayama coming out this morning with some sort of verbal warnings again, saying that she is willing to take actions. We haven't had confirmation from the government either way on the move this morning, but it certainly seems like this intervention may stick longer than perhaps those previous ones that we've seen in recent months.
In 2024, though, Alice, the yen tumbled all the way to below 140 for a moment. It had been above 160. Is that the kind of move we're going to need to see in order to reset this market completely?
Yes, I think the jury is out on sort of how far it can really strengthen. And of course, in the background, we do have the BOJ. And a lot of what we've been hearing here on the ground today is that it really probably will take at least another BOJ rate hike to really sort of make these gains stick. Now, of course, the BOJ on Friday held rates and you know, didn't really come up with a huge amount of extra hawkish language. But a lot of people now saying that there may be an acceleration in rate hikes, and that may be what is needed to really sort of cement these gains. Now, of course, the fact that we have pressure from the US side, this is the first time that they have conducted joint intervention in 15 years, does make it seem more serious. But, you know, history would show that intervention gains do not usually stick for more than a few weeks. Of course, we have in the background worries about Prime Minister Takaichi's extra fiscal spending, and of course in the background the dollar strength and everything that's going on in the Treasury market too. So I think it really remains to be seen whether this is enough to make a lasting change.
Yeah, I mean, JGB yields are climbing. Markets pricing in about a 93% chance of a hike for October, Alice. But, I mean, September comes before October, and there's even the possibility of an emergency hike. Are markets not anticipating that at all?
There are certainly some voices here today that are saying that that may be on the cards. Of course, you know, we haven't really heard anything extra from the BOJ since Friday. And as you say, October does still seem to be the most, the favorite option. Now, of course, if the BOJ does go ahead with hikes perhaps more quickly than people had expected, that can also weigh on other assets, including, of course, the stock market, which has really taken a battering today, particularly those exporters, those automakers, which do benefit from a weaker yen because of the exports. So there's a lot of balancing to do here, I think, for the government and the BOJ.
All right, Alice, thank you so much. That is Bloomberg's Alice French there on joint intervention in the yen. In Washington, Bloomberg learning that Chair Warsh is considering changes to the frequency and timing of the central bank's policy meetings. Let's get more with Bloomberg's Alistair Bull. Alistair, what would it mean to this market if the Fed chair, I guess in concert with the FOMC, decided that 6 meetings were enough per year to talk about monetary policy?
That's an intriguing thought. So it would push the number of policy meetings from 6 to 8 weeks between them. That would be consistent with what we've heard Chair Warsh talk about to reduce the market sort of finger trigger reliance on utterances from the referee and to play the ball and not the ref. So I think that they would adjust reasonably quickly. The other intriguing component of the reporting was that they would look to try and align the meetings more with the schedule of data releases, and that just makes common sense. I mean, if you can hold a meeting with as much information as possible in front of you, that would be a good thing, rather than the situation at the moment when they meet on a Tuesday and Wednesday, and then you have a big data release on the Thursday or payrolls on the Friday, and they've kind of been flying blind. So, I mean, I think the market will be intrigued. On the paper, it doesn't seem such a radical shift, and we wait to hear more. But one thing that wasn't discussed in the reporting was whether each of these meetings would still be accompanied by a press conference. And so that's certainly a question we'd like to circle back to.
Exactly, and given that we already have meetings scheduled this year for September, October, and December, though they don't have to go ahead, you wonder if it would already start to take effect and if some of these meetings would go away. Paul Donovan of UBS this morning making a good point, saying that there would be more time to hear from other Fed personnel, given that the blackout periods would be fewer. So that's also something else to think about, right, Alistair? Would that inject more confusion or more clarity?
Well, that's going to be interesting to watch, because the fewer press conferences that Warsh holds, the more ground he cedes to his fellow policymakers to make their points. And if he voluntarily hands over the microphone, you could wind up with the market having to take cues from elsewhere and try and figure out who is the guy to best listen to. Now, you've got the Troika, so that's the Fed chair, the vice chair, and the president of the New York Fed, so you certainly listen to them. But there's other influential policymakers, Chris Waller, Governor Chris Waller, who the market does pay very close attention to. So you could wind up having them sending signals and then having to wait for the FOMC or the Fed chair, Warsh himself, to ratify those views. I don't know that it's going to reduce volatility, but it's certainly going to be bear watching. Bonnie.
Absolutely, and it's something he did at the BOE after his review as well. They took down the number of their meetings, so there is precedent. Bloomberg's Alistair Bull, thank you so much. Turning to the conflict with Iran now, President Trump continues to talk up negotiations.
What we're doing is we're talking to them in the form of a negotiation. It begins tomorrow afternoon, and we'll see if it's true. I'd love to do that, save a lot of lives, save a lot of unnecessary power.
Tehran's foreign ministry, though, saying its discussions right now are only with Oman and only on the safe passage of ships through the Strait of Hormuz. Joining us is Bloomberg's Abir Abu Omar in Dubai. Do you know anything about any potential talks scheduled for this afternoon, Abir?
Good morning, Vonnie. We know that there is back and forth yet again between the United States and Iran. So about an hour ago, we heard from the foreign ministry in Iran through the spokesperson that weekly press conference he holds, Ismail Baqai, saying that right now there are no ongoing discussions or negotiations with the United States. He did say that Iran's foreign minister, Abbas Araghchi, is actually in a pilgrimage, to Iraq, and that the rest of the negotiating team in Iran is in Iran for the time being. And so this is the back and forth that has emerged multiple times through the course of this war. Vonnie, now you did hear President Trump essentially saying that he was preparing for an attack that was the biggest against Iran since World War II. And then he went back and said actually negotiations with Iran are set to recommence later on Monday. Now, again, an hour ago, we heard from the Iranian side saying that no active discussions with the United States are set to take place. But perhaps what's different this time is a discussion that is happening with Oman on the Strait of Hormuz. Now, we reported last week, Vonnie, that both Iran and Oman were in active discussions to open a safe route, a middle passageway in the Strait of Hormuz, if you were to get a trickle of movement really through the waterway that really needs it at this point. So we understand from the foreign ministry and from our reporting that those talks could be at a stage that is almost final. Now, we don't know what it entails. We don't know if it will mean demining the Strait of Hormuz or for ships to have to seek less permissions or anything about the tolling system, for example. But we know that it is meant to create a safer trickle of movement or a safer passageway for ships and tankers that are trying to make their way through the Strait of Hormuz, which has seen sporadic movements really over the past couple of weeks or so.
All right, Abir, thank you so much. Abir Abu Omar this Monday in Dubai. Now to other top stories trending on the terminal this morning. Goldman Sachs says it's worried about the situation in Russia due to its impact on diesel supply. Moscow has extended a ban on exporting most of its diesel until September 1st to avoid shortages following waves of attacks. Alibaba released its latest flagship AI model, Twen 3.8 Max. According to Alibaba, it performs better than or on par with Anthropic's Fable. The company intends to release the weights for public download next week. Jefferies is reviewing its exposure to iron ore trader Radiant World following questions over invalid invoices. The review comes as Bloomberg reported that Vitol Group and Cargill are among major firms that have stopped trading with Radiant World. Jefferies declined to comment. Coming up, a potential mega pharma deal brewing. More on the acquisition talks between AstraZeneca and Bristol Myers next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this really normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop?
I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about. Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Bloomberg Brief. I'm Bonnie Quinn in New York. Some breaking news now. Bank of Japan data suggesting Japan intervention of about 5.3 trillion yen on Friday. So again, we're getting figures on that Friday intervention. 5.3 trillion yen suggested by Bank of Japan data. Shares of AstraZeneca getting a hit in London. That's after a report on an acquisition by Bristol Myers Squibb potentially. Bristol shares jumping in the pre-market on the potential mega deal. It'll be the largest ever in pharma. Joining us now is Bloomberg healthcare reporter Ashley Furlong. So Ashley, the markets certainly seem to think that this is going ahead. Tell us about the origin and where these talks stand, if we know.
So unfortunately, we don't know that much. We know that there were preliminary talks. We don't know if those are still ongoing, if they have concluded with no deal, and we haven't had any statement today on the record from either Bristol or from AstraZeneca. What we do know is that investors, AstraZeneca investors at least, are seeing the deal in a very negative light. They see it as one that AstraZeneca really doesn't need to make. AstraZeneca has a really strong pipeline of medicines. The only real benefit potentially would be sort of cash flow, but Bristol has looming patent cliffs for some of its top-selling drugs. So then AstraZeneca, if they merge, would need to take on those patent cliffs. And there's just sort of a lot of concern more broadly about mega deals and the sort of disruption that it has, the impact on research and development. But as you can see, Bristol investors are potentially quite excited about the possibility of a deal.
Is there any possibility that there would be any regulatory disapproval here, or that either company would have to spin off bits of itself?
There will be a lot of complexity. So their oncology businesses, in some cases, actually overlap. They have drugs that are competing. So analysts kind of expect that you'll probably need to make some divestments there. And there's obviously, concern around the broader pipeline. There's also the sense that this is possibly the only time that you could probably actually manage to do the kind of deal at this scale with the current US administration. So there is the sense that if a deal of this size was ever to be done in the pharma sector, it would be now. But it'll definitely have a lot of hurdles, and not least also in the UK, where we saw in, over a decade ago, we saw Pfizer actually try and make acquisition of AstraZeneca, and we saw massive pushback from the UK government on that. So we can expect the UK government as well to have a lot to say, as well as the US government, of course.
Ashley, has AstraZeneca the heft to do this without saddling itself with a massive amount of debt?
They do, and so I think that there's not necessarily concern around whether this is possible. It's more whether it's a good idea, and I think that that's the big concern here, is that it's not, investors don't see it as a good idea for AstraZeneca. What it could give them is access to the US market. Well, big, broad access. Obviously, they already have a massive presence in the US. So that is another benefit it could give. So obviously, Bristol will have a large commercial footprint that AstraZeneca would be able to access. And we've seen AstraZeneca increasingly sort of pitch itself as an American company, even though it's headquartered in the UK. So that is another potential benefit for AstraZeneca.
All right, Ashley, thank you so much. That's Bloomberg healthcare reporter Ashley Furlong. Coming up, a look at what else is making headlines. It's your front page news next. This is Bloomberg.
How do you see AI changing gaming and game development in the future?
Look, I think the biggest thing that I'm thinking about is how do we just make sure it's solving problems. On the game development side, I've gone to a lot of our studios, you know, whether big and small, and I'm blown away with how they're using AI in the production pipelines, how they're using it for iteration and prototyping. That's not production ready, there's still work. And so, and you know, 30% of game development is software, and so there's the traditional applications that we see in enterprise. At the same time, I do not think AI will replace AAA games. I think it's entirely possible, though, that AI represents a new category of games and a new type of development and enables more people to create and participate. And we'll keep an eye on that, and we'll see how we best serve that.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
For your front page news. First up, the Financial Times reporting Monte de Paschi is exploring alternative options to fend off Intesa Sanpaolo's hostile takeover. Options include a potential takeover of Banco BPM after talks over a merger of equals between the smaller lenders collapsed Friday. Next up, the Washington Post reporting Acting Attorney General Todd Blanche issued a written order late Sunday formally rescinding the Trump administration's proposal for a $1.8 billion fund for people who claim they were victims of political prosecutions. It's a step toward breaking that impasse that had threatened Blanche's chances of becoming the Senate-confirmed head of the Justice Department. And the Wall Street Journal reporting California's Democratic Party has endorsed the state's proposed billionaire tax. It marks a win for its advocates there 3 months before California votes on the measure. If it takes effect, the state's roughly 20 billionaires would pay a 5% one-time levy. Coming up, chip stocks notching their worst month since 2008. We'll discuss more with Rebecca Walser of Walser Wealth Management. That's coming up next. This is Bloomberg.
Is there anything that humans today can do? Yes. That will change the lives of the humans currently on the Earth?
Well, first of all, people who switch over are getting the benefit right away. But coming back to the point about the fossil fuel industry and our debt to them, there's an old saying that came from the King of Saudi Arabia years ago. The Stone Age didn't end because of a shortage of stones. It ended because something better came along. Something better has come along now to replace fossil fuels, which are dirty and polluting and threatening humanity's future. The cheapest electricity in the history of the world is solar energy. Second cheapest is wind energy. And now batteries, the only thing that's come down in price faster than solar is utility scale batteries, doubling every single.
Why are we ending the wind farms that are now being built off the coast of the United States? We're ending them.
Because Trump is insane.
On another subject,
you don't want to explore that, but let me add one point on the solar. If you look at all of the new electricity generation installed worldwide last year, I often ask people what percentage of it was renewable, and people say, you know, they're looking for a high number. Say maybe 30%, 35%. Correct answer is 93%, because it is taking over the electricity generation industry.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Mumbai. This is Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Yen intervention. The U.S. and Japan warn they won't hesitate to defend the currency further after their first joint action in 15 years. Deal talk uncertainty. Oil drops as President Trump calls off military strikes and maintains talks with Iran are set to start again. And a structural rethink, potentially. Fed Chair Wharf said to be mulling the possibility of changing how often the FOMC meets to set monetary policy. So that's one thing in the back of markets' minds this week as we head into August. The first trading day in August today. It looks to be getting off to a good start with futures across the major indices positive. This after such a volatile week last week and a volatile session across Asia as well, with the Kospi down firmly by 5% after the 18% gain on Friday. We also had, of course, yen intervention. That yen is steadily rising, though, once again, back above 156 right now. Let's take a look at yields and see if we are continuing our movement of last week. Well, oil lower is pulling yields lower, but as you can see, still pretty elevated with that 2-year yield close to 425, the 10-year yield close to 470, and the 30-year yield basically at 523. Here's your oil picture now as the president maintains talks are ongoing. Iran, though, this morning saying, listen, we're talking with Oman about the Strait of Hormuz and potential lanes. There's nothing on the cards, though, in terms of U.S. talks. Brent crude below $84 a barrel and WTI now below $80 a barrel. Let's get to some individual movers now with Chloe Malley.
Good morning, Bonnie. Let's start with big pharma M&A. Bristol Myers and AstraZeneca are said to have explored the possibility of a merger that would create one of the largest drug makers in the world. And this news of this potential tie-up has really dragged down the shares in AstraZeneca this morning in London. But we are seeing potentially a little bit more enthusiasm from the Bristol Myers side, and we're up about 7% for this pharma company this morning. Moving on to even more M&A, and we've got Atcor getting bought by Prysmian, which is an Italian electrical manufacturer, in a deal that values Atcor at $3.8 billion. And we are seeing that really drive the shares this morning. We're up more than 26%. And finally, Ferguson Enterprises, which is a plumbing and HVAC supplies company, is up this morning as it is set to join the S&P 500 this week, replacing Electronic Arts, which is getting acquired. And so we're up about 8% this morning for Ferguson.
Chloe, thank you so much. And just a reminder, we will be speaking with the Prysmian CEO in just a few minutes, so do stay tuned. Now, the Philadelphia Semiconductor Index has wrapped up July with a 21% plunge, its worst month since October 2008. Joining us now is Rebecca Walser, CIO of Walser Wealth Management. Let's put this in perspective, though, Rebecca. The SOX is up 59% year to date, which would be a wonderful, wonderful gain under normal circumstances. However, at the end of June, it was up more than 100%. So what do you do as an investor? Do you just decide it's too much stress, I'm getting out of semis?
Oh gosh, I think that would be a huge mistake. And obviously it is, Bonnie, very difficult to stay the course, right? But this is why you have to really take your risk assessment first and say, what is my risk tolerance? And in something like a fourth industrial revolution, in something like a new technology frontier. And if you look back at, and I hate to use this, but if you look back at the .com, you'll see the same type of thing. Like monetization doesn't really know where it's going to land. So sometimes it overshoots, right? And then we come back down to reality. So you have to understand that is normal in new technology, and so if you have the tolerance for it, then invest and then stay the course. Because if you set your mind to this is normal, I'm going to stay the course, then I think 3, 4, 5 years from now, you're going to be very, very happy.
If there is serious competition from China, though, perhaps there won't be as much pricing power for these semiconductor stocks, particularly the memory stocks and just the general AI infrastructure stocks.
This is the biggest concern. Kimi 3 with moonshot out of China is a huge shot across the bow, and it really goes to speak to Xi Jinping gave a speech at this technology conference where he said, is it going to be an open source world where everything is free, or is it going to be more of a capitalistic model like the U.S. where these companies pour trillions of dollars into capex to really develop their product, and then they reap the financial benefits and rewards. And I think that, it's fine for Xi Jinping to go up there and say that, but we all know that his country is actively stealing IP. That is their business model. Let's get the IP stolen. I'm not saying that Kimi 3 is stolen, but I'm saying that if China can do things faster and cheaper, and it might not be as good, but it's good enough, then that does have a really big impact on our capex spending and our U.S.-based growth around this AI and frontier.
So would you be recommending that people take some chips off the table, some profit off the table, and perhaps put it to work somewhere else? And where would that be?
I definitely think you have to have investment of breadth. We can't have just everything in AI, especially because of what I just said at the beginning. It's always very volatile. You can look at sectors that also support the AI trade. So the industrials, you can look at things that obviously energy, because obviously all of the data centers are very undercapitalized as far as energy and being able to actually deliver what they're going to promise with the chips themselves. So there's all of these ancillaries that are also going to be coming up. But again, if we in America do not remain the hub of the AI frontier, if it does reroute outside of us, then there's going to be massive problems with our future projections.
Do you anticipate problems with the data center build-out, given how unpopular they are, how many obstacles are being put in their way, and what does that mean then? I mean, does it take a lot longer to get return on your energy investment or your infrastructure investment?
And I think it's hard too, because if you have states like New York saying we're going to take a pause for a year and do nothing, then obviously energy companies, utility companies, they might be relegated to some very rural, out in the middle of nowhere, where people aren't going to be complaining and HOA and saying no, we're not doing this. So it is a big concern. You're right, Bonnie. I mean, we really absolutely have to be able to implement the data centers. The investment has to go somewhere. It can't just be in the clouds. So.
Let's talk a little bit about the Fed.
Yes.
So several things happening. We may have fewer monetary policy setting meetings. We also have the 10-year yield creeping ever higher, not to mention the 30-year yield. How do you think about how the backdrop of monetary policy is changing and what that means for portfolios?
Yeah, that is a huge question, and I think Warsh is the man for the job. He already telegraphed that he doesn't like that they're giving so much forward guidance and sort of setting the tone of the market. He doesn't want the Fed leading the market, and he did a really good job of saying, hey, we're not going to give you this information, and after the Fed meeting, we saw the 30-year-old rise, the 10-year, so we know that basically the market is saying everything is a little too hot, and we're naturally raising rates without the Federal Reserve then actually saying we're going to raise the Fed funds rate. So I think that he's already telegraphed this, and I also believe he doesn't believe in the data sources, and this is what the reason for the task force is, Bonnie. This is the reason he wants to get new analysis of what should we be doing, what should we be collecting, because it is really outdated, outmoded, and it's too much of a laggard. We need more projections without so much guidance, and I think that it's clear that he doesn't like the Fed leading the market.
Well, what does it mean for a portfolio? Say the 10-year gets to 470, which is basically out right now. Do bonds suddenly become, more or less a part of a portfolio? What does it mean for stocks? And do you really need to rethink how you're approaching building portfolios?
I think I agree with you 100%. I think you do. But the bond market has changed for a while. Like, we used to buy bonds and their security, and what investors don't understand this, their security came from holding to maturity. Then you started getting a bond portfolio. Now we're getting bond ETFs. So you have bond portfolio managers that are buying and selling bonds all the time, which makes bonds a lot more less of the safety play that they were, especially in the middle of massive monetary policy changes and global geopolitical currency changes. You've got, just with this yen situation, with the United States also buying yen, and what I noticed is they haven't told us how much treasuries they sold, Vani, to actually intervene. So I'm waiting for that number that just happened over the weekend. So we're really waiting, but you could start to see it last week. Something was starting to happen because it was dropping already, and then this weekend, obviously, the big intervention. So I do think that you have to rethink: do you really believe that bonds are the safety play, or are you just using them for some kind of fixed income?
You're also looking at other areas. So energy, for example, does it still look attractive, even though we're seeing potentially, talks restart? Healthcare, where would you even look at healthcare? It's such a diverse play, and also software, interestingly.
Yeah. So to just take them in order, and I'll go in the reverse order. So software obviously is just, it's a really still good value play. I mean, it's going to have its end at some point, because eventually AI will take over, but we're not there yet. And I think that the margins are really increasing, the cash flow is increasing. So it is definitely under priced right now. And then for that reason, I think it's a good rotation into. Energy is obviously just based on what's going on with Iran. I just don't believe that, unfortunately, we can get a solid deal that is just cut and dry. So I believe that we'll still have more volatility back in energy. I wish we could get a deal and it would be over, but that's not the case. And with healthcare, you have to really look at the ones that are newer, that got the GLP-1s and have the variants of that. That's where the growth engine is right now, is in the GLP-1 space, not so much the old legacy. A lot of the patents are coming off of some of the older legacies. So that's why the healthcare rotation is really into the more of the GLP-1s. And we have 1 out of 8 Americans on GLP-1s right now in this country. So some of that has already been taken, but we'll see the variants will come along, and that'll be better.
All right, Rebecca, we have to leave it there, but thank you so much. That is Rebecca Walser of Walser Wealth Management. Now to other top stories trending on the terminal this morning. KKR is buying a 50% stake in a portfolio of assets from Total Energies valued at $2.1 billion. The stake is the latest in a string of green power deals for KKR. The KKR deal is part of Total Energies' strategy of offloading stakes in renewable projects. Senate negotiators reached a bipartisan deal to avoid a government-wide shutdown this fall. Senate Majority Leader John Thune plans to bring the measure up for a vote this week ahead of the chamber's August recess. Republicans move to take a shutdown off the table ahead of the midterms. Spider-Man: Brand New Day delivers Hollywood's second biggest debut ever. The film, featuring Tom Holland as Spider-Man, made $355 million in the US and Canada over the weekend. It's a story about an isolated man torn between his duty to serve the city and his desire for personal connection. A plot apparently that resonates with audiences. Marvel's Avengers Endgame holds the #1 spot for Hollywood's biggest debut. Coming up, an exclusive interview with Massimo Battaini, CEO of Prysmian, on its all-cash deal to buy US electrical parts maker Atcor. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. every weekday only on Bloomberg Television.
Anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Shares of electrical manufacturing company Atcor soaring in the pre-market. That's after Italy's Prysmian struck an all-cash deal to acquire it at a value of about $3.8 billion, the latest in a series of deals the Milan-based company, which was originally spun out of Pirelli, the tire maker, has made to expand its presence in the US. And I'm pleased to say Prysmian CEO Massimo Battaini joins us now from Milan. So congratulations, you had been looking for a deal roughly around the $4 billion size, Massimo. So what's next? Have you more firepower for more M&A?
Yeah, thank you. We definitely have more firepower than $4 billion. We mentioned a few months ago a firepower around $10 billion through our treasury shares, the equity raise, and the financing debt. And so we will be continuing looking for more. It's important that we remark that what we are looking for is additional expansion of our leadership in some geographies. US is a priority one. And also we look at the complementarity of the portfolio, because cables plus other components help us enhance our leadership in the market and benefit from the strong driver of growth in the electrification space in US, and also from data center expansion and build out. So we will continue looking at those type of opportunities in the coming months.
So very similar companies then to Atcor, or something slightly in the neighborhood of just electrical manufacturers generally?
But similar to Atcor, but maybe in different segments. So we have basically 4 segments of business. Transmission is where we own full leadership, and we can't buy anyone. But in electrification, in power grid, and in digital solution, it is where we can complement our portfolio with a similar company to Atcor. So adding something to our cable portfolio, so that we can package cables and components and installation devices, all the stuff of sensing, for example, to strengthen our leadership in the market.
And you're looking primarily in the US. Do you have targets in mind yet?
We are looking in the US. We are looking also in other regions. The US has a great favor from us. I lived there for a long time. I understood how interesting the market is, how nice is the consolidation of the market on the customer side, on the supplier side. And now, US is exposed to the strongest driver of growth, the one coming from data center. And we are unique in data center, because we can sell to data center all cables that goes from electrification of the building, power grid to strengthen the grid, and also digital solution, optical cable that goes inside the building and connect data center among them. We are the only one having a possibility and the capability to play in all the value steps of the supply chain in data center.
Now, when it comes to Atcore, it's mainly US skewed, so 88% of its sales are in the United States. Do you plan to try to have it expand in the European market, or will you keep it US based?
No, we will keep the US base. We'll have also similar synergies to the one in US in the other geographies. Atcore has a footprint, interesting footprint in Australia, in New Zealand, also in UK and in Europe, and we'll have a similar opportunity to leverage the combination of the two perimeter also outside of the US.
Can you tell us the proportion of debt and equity that you're using in order to make this deal happen?
We are basically raising 20% of the equity of the enterprise value as a new equity, or maybe using our treasury share. So it's not so much, it's not that much, and it's needed because we want to maintain our investment grade, and that is the condition to allow us to maintain it. Some fund, some debt, and also equity.
I have to mention that Atcore had been under pressure from an activist investor, Irenic Capital Management. Did you have or have to have any conversations with Irenic?
No. This acquisition is being performed through a competitive process. There were other players, US players, that were after this acquisition, this company. We had nothing to do with the activists, and so we work intensively in the last 3 months with the advisor of Atcore to compete against the other competitors.
Now, Atcore has seen a little sales decline in the last couple of years. What's the medium-term outlook for bringing that sales figure back up?
Atcore has gone through a spiking process in 22-23, where the margins has risen to an unprecedented level, which is what has happened also to our premium perimeter in the United States. Then the level of EBITDA margins and revenues have normalized over the last 3 years. We think that now we are at the bottom, or they are at the bottom in terms of EBITDA margin and revenue. And from now moving onwards, there will be different drivers from the market helping us restore higher profitability and growth in revenue, alongside 150 million of EBITDA coming from synergies. 60-70% of synergy will be extracted from commercial opportunity. So the idea is to package cables with component and sell more, gain more share of wallet within our distributors with the common go-to-market also Atcore. The rest of the 30% synergies will be basically about organization, procurement, and operations. So consolidation of footprint in US. They have 30 factories, Atcore. We also at Prysmian have 30 factories in US. So with 60 factories, now we sit in US with a very large footprint, able to service properly customer with short lead time and fast delivery from every part of the States. This is a very important strength to be even more competitive in the data center build-out opportunity.
Well, Massimo, can't wait to see what you do next, and thank you once again for your time. That's Massimo Battaini, CEO of Prysmian. Let's get a check on the yen right now, as we've had plenty of action around this currency in the last 3 days, including the weekend. Right now, we're trading at 157.02, so very slowly but surely creeping back up there. Bloomberg analysis indicating that Japan likely spent around $34 billion intervening in the currency market Friday. Bloomberg's Ven Ram joins us now for more. Ven, it looks like all the bears haven't been chased away, certainly.
Certainly not yet, because they've still got the work cut out to do. I mean, for all the firepower and for all the pyrotechnics that we've had over the weekend, I mean, the yen is up, dollar yen is down just 3%. So it's not too much bang for the buck. And, what it shows, Vonnie, is that the most important player in all this is not the US Treasury, is not the Japanese Finance Ministry, but the Bank of Japan. The Bank of Japan needs to raise rates at a faster pace because they're behind the curve in fighting inflation, and that is what is holding bondholders back. And that is the same concern that is rippling through into the currency markets. The moment the BOJ shows intent to put up its real rates to positive territory, you will see the yen come back up at a far faster pace than they can do with intervention alone. And that's the point that the Japanese authorities are missing.
Yeah, like I said earlier, we saw 140 back in 2024, right? It was a 20 big figure move. So Ven, why are the markets not anticipating that there'll be a hike in September, particularly given that the Treasury Secretary, Scott Bessent, is all for the Bank of Japan hiking?
Well, the Bank of Japan wants to make sure that they are not stamping out inflation, because if you go back in history, Bonnie, Japan has had lost decades where they haven't had meaningful inflation, and now they've had inflation for the past few years, and they want to make sure that they don't want to go back, relapse into the deflationary era, and that's why they're showing so much caution. But of course, that, as I said, that short-changes nominal bondholders, and that is why we are seeing the reaction in the markets that we are seeing now.
All right, Ven, we have to leave it there. Not even going to get to talk about the Fed. That is Bloomberg's Ven Ram. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Now, look at what's ahead this week, your first trading week in August. First up, SpaceX's first earnings report coming on Tuesday with a lockup expiring 2 days later. That's followed by Novo Nordisk and Disney on Wednesday. We'll keep a close eye on Fed speak throughout the week, starting with Schmidt and Cook on Wednesday. And wrapping up the week with the jobs report Friday. Here are some micro movers. Atcor surging before the bell after an acquisition from Italy's Prysmian. It's following U.S. electrical products maker at about $3.8 billion. Also, AstraZeneca looking to acquire Bristol Myers, said to have had talks, and that's causing Bristol Myers to soar. Alibaba out with a new trend model, and it's supposed to be able to rival Anthropic's major model, sending those shares higher. This is your macro picture for your day ahead.
world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market. Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space. Excellent reporting.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
All in all, earnings were pretty good across the board.
The beats are being rewarded.
The equity market overall is doing fine.
There's still lots of demand for equities.
The right trade is not to trade. Hold your core positions.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday with some extra intervention. The US and Japan teaming up to support the Japanese currency. As the president is scrapping planned attacks on Iran to focus on talks, it's combining to send crude down, equities higher, and helping the yen hold on to big gains.
This is a huge deal. This is the first bilateral coordinated currency intervention with the U.S. and another country going back to 2011, when a group of nations helped Japan depreciate their yen in response to the earthquake and the tsunami. So here is the question, and you were alluding to it last week. Why? Why is the U.S. doing this, and why now? Is it because of some sort of financial benefit that, as President Trump was alluding to? Was it because we help our friends, as he was talking about and Scott Bessent was talking about? Or is this also a yield story that potentially could come to fruition?
I would argue there is a policy response that the U.S. is hoping to avoid, and there are two of them. One is Japan actively selling lots of treasuries to support their currency, and two, Japan actively encouraging Japanese investors to repatriate capital, again, which would weigh on the treasury market. This is not a great backdrop right now for treasuries already to begin with. The latest developments in Japan leading up to this don't help.
And some people are debating, speculating that the shift higher in long-end yields, with 30-year yields rising to the highest levels going back to 2007, did help motivate some of this activity. Nonetheless, it highlights what the motivation would be for the United States, aside from just helping our friends.
The Treasury Secretary is in a tough spot right now. Put it all together. You've got the international developments, Japan, the hit to Fed credibility just last week, plus, and Lisa, you've talked about this endlessly all year because it's so important, the additional supply coming from everywhere else in this competition for capital.
So it goes down to what can they do? At this point, is it just issue on the front end, have the front end pegged by the Federal Reserve, and at some level just allow the long end to float and hope for the best? Or is this going to be some sort of coordinated action to bring down long-term yields? There's only so much he can do. And that ultimately is the crux here. Going forward, this to me is going to ultimately rely on what the Taikeishi government does and what other governments do, because at the end of the day, intervention can only do so much. At a certain point, there has to be a policy response of either hiking rates or potentially curtailing fiscal spend. And without that, this can only go so far.
I think Mohammed Al-Erin put it nicely over the weekend, you're fighting gravity. and at the moment it feels like you're fighting gravity. Let's talk about the US bond market. 2s, 10s and 30s, yields declining throughout this morning. We're down 4 on 2s, on 10 we're down 5. Your 10-year this morning trading around 470 still, on 2s around 425. This move in crude is helping WTI and Brent. Unfortunately, we have to talk about the same old story. 84 on Brent, 80 on WTI, and I'm sitting here and I'm going to say the same thing again. The story hasn't changed. It's the uncomfortable new normal where we just toggle between strikes and talks, strikes and talks. This morning, it's talks.
And the problem for market participants is that the stakes are getting higher and higher as it brings in more parts of the world. You have now the Saudis and the Houthis actively fighting one another. You have this question of proliferation in Iraq, Oman, etc. You start to look at all of the potential for escalation and widening out in the conflict. And it's keeping people very nervous. At the same time, oil potentially can keep flowing. And I was looking, actually, this is an interesting statistic, that the stockpiles of oil in the U.S. have declined 19% since April. That's a lot, but not nearly as much as some people would expect.
The U.S. once again talking about talks and Iran denying they're happening. We're doing that again on a Monday morning. Shock. The week ahead looks like this. Into Friday, we're all building up to one thing. We're looking ahead to payrolls Friday. Lots of labour market data in between. A sneak peek of the estimate here at Bloomberg in our survey, 80K is the median. You'd have to think that an 80K this Friday would keep the rate hike bets alive and well into September.
Especially because the unemployment rate is expected to stay at 4.2%. Watch the JOLTS data, the ADP data, to give some indication of what wage growth could look like. This goes to what we heard from Beth Hammack and others, where they're worried about it spiraling out of control in terms of inflationary inputs that take on a life of their own. To me, this highlights how much more volatile the market is going to be to every data point because we aren't getting a clear guide, although we are getting a lot of Fed speak this week.
Welcome to August, everybody. July was exhausting and the S&P 500 was basically flat, unchanged. Beneath the surface, pretty violent. We'll talk about that throughout this morning. Coming up this hour, we'll catch up with Stephen Cook of the Council on Foreign Relations as President Trump claims an Iran deal is imminent. Jeremy Stretch of CIBC as the US and Japan combine forces to support the Japanese yen. And Marco Banner of Bank of America as Fed Chair Kevin Walsh considers cutting back on meetings. We begin this hour with equity futures pushing higher, crude lower and bonds rallying as the US and Japan are teaming up to support the Japanese yen. Joining us now to discuss is Phil Orlando of Federated. Phil, welcome to the program, sir. We talked about it briefly at the top there. I'm sure you were tuned in. What is it about this right now and this backdrop that has prompted the U.S. to get involved to help the Japanese?
Well, the relationship between the dollar and the yen was roughly a 40-year high for the dollar, low for the yen. And I think the Japanese government simply reached out to the U.S., indicated that they were going to try to reverse the weakness in the yen. And the two countries are excellent allies. The United States needs more friends rather than less friends, given the very strange and strained period of geopolitics that are going on right now. And I think the United States agreed to support the efforts that the Japanese were going to institute.
Do you believe, Phil, that U.S. participation goes above and beyond that? That their interests are beyond just helping out an ally, a friend? There are some concerns building about the backdrop for the Treasury market.
Well, it's a perfectly valid thesis. You and Lisa were talking about it. Perhaps there is concern that there would be a disintermediation of Japanese money out of U.S. Treasuries, and that would have a deleterious impact on U.S. interest rates, while rates have already gone higher. You talked about, benchmark 10s are already up to 470 or approaching that. Our view is that we could see yields continue to drift up to 5%. U.S. probably doesn't want to see that happen. And if a significant ally, one of the most important economies of the world, is looking for some help, and we can forestall our Treasury yields moving materially higher, then perhaps we would try to participate in helping that become achievable.
Phil, you don't think that the Fed should hike rates or will hike rates throughout the duration of 2026. With your vantage point that maybe what the Fed did this week was the right thing, why do you think long-end yields moved up so much?
Because I think investors are concerned about two things. The fact of the matter is that U.S. economic growth is very strong, and there are inflation concerns. And so as a result, absent the sort of forward guidance that the Federal Reserve might ordinarily provide to investors, perhaps under the Powell regime, bond investors are going to do what feels more comfortable to them, which is to push yields higher. So as we're looking at the situation, though, economic growth is pretty good. You know, we think the core private domestic final sales number that we saw last week, 3.9%. GDP growth is solid. And inflation, which spiked during March, April, and May as a result of the conflict in Iran, came down substantially in June as we got some reprieve from the fighting. So as we look out over the course of the next couple of months, we'd love to see the Iranian situation stabilized and have energy prices come back to more normal levels. So from our perspective, the Federal Reserve were to be hiking interest rates here, given a normal policy lag, as those higher interest rates would begin to take effect, energy prices might be back at, you know, let's say $70 a barrel. That would create potentially a deleterious impact on labor market strength and economic strength. So the right course of action for us would be the Federal Reserve to sort of look through this energy supply shock and be patient and right now do nothing until we've got some better information.
Based on that, Phil, are you buying duration? I mean, just to take a step back, regardless of what they should or shouldn't do, right now, the market's not getting a lot of guidance, and it's unclear exactly how they're going to operate. Long-end yields are going up. Do you think it's a buying opportunity for both long-term bonds and high-duration stocks that have sold off and been punished in the wake of this?
Our duration committee at Federated Hermes, which is chaired by R.J. Gallo, put out a note last week based upon their latest duration committee meeting, and they've decided to stay at neutral. So I guess there's the potential. They believe that rates could continue to drift higher, and if we were to get something in that 480, 495% neighborhood, you might see them lengthen duration at that point. But given where we are right now, just under 470, and the uncertainty of the situation, I think they're suggesting the best course of action right now is, again, to be patient, be neutral, and wait for some additional guidance.
Do you think it's becoming increasingly problematic for the outlook for equities?
Well, certainly. If we're right that yields continue to drift higher up to 5%, that could potentially continue to result in contraction of price earnings multiples. Now, you look at from where the S&P 500 was, or the NASDAQ for that matter, where they hit record highs at the beginning of June, the S&P is down, 4 or 5% over that period of time. We could see a like move down over the next couple of months. So let's say a total move down to the 200-day moving average, down around the 7,000 neighborhood, give or take. So if we were to see continued problems in Iran, continued concerns about inflation, continued drifting higher in treasury yields, that could absolutely facilitate, another little bit of an air pocket here. Let's call it another 4 to 5% on top of what we've already seen over the course of the next couple of months.
Phil, it's good to see you. Appreciate the input. Phil Orlando there,
thank you, John.
Federated. Phil, thank you. Even them, they don't expect hikes from the Federal Reserve anytime soon. There's concern still about a drift of the longer end of the curve, and we've seen the long end of the curve become somewhat untethered repeatedly over the last several years. And the reasons for it, Bramo, the list is getting longer, not shorter, and that's a problem for anyone issuing debt right now.
It has to do with just the fundamentals of debt growing dramatically around the world. It has to do with who's going to buy when people are selling in order to support their currencies and their economies. Torsten Slok actually came out, and he had a great note over the weekend where he said, why did long rates go up during the press conference? And he focused on not what happened during the press conference. There was some oscillation, but it was really after the press conference. And ultimately, he said, yes, he reconfirmed the idea of getting to 2% inflation. He didn't explain how. And he likened this to saying, I'm going to take you on a trip to Los Angeles, but I'm not going to tell you how, and I'm not going to tell you how long it's going to take.
We might walk.
You might walk, or you might say, we're not going to Los Angeles, which is essentially what this market is saying.
The preferred tool. He gave a nod to the interest rate tool, but only a nod. Could, maybe, might. And left open the possibility of using balance sheet, which again would contribute to a drift higher in yields as well. That uncertainty and lack of clarity is contributing to the move we're seeing.
So the Wall Street Journal came out with an op-ed that was scathing to everyone who was whining, and I read it. I said, thank you for releasing to me. It felt very personal, and it was talking about, not that I'm whining, and truthfully, it was saying, Wall Street's whining, stop your whining. You're used to a Fed that holds your hand and now it's not going to hold your hand. And Kevin Warsh is doing exactly what should have been done 10, 15 years ago. And I was reading it, and they kept saying people are looking for forward guidance. And I said, this all comes down to, once again, people conflating the idea of forward guidance with reaction function. They are two different things. They have distinct purposes, and they are not the same in terms of giving a market some sort of framework to have a sense of exactly how to respond to economic
Was this a note on being the Lionel Messi of central banking? Was that the note from Citi?
It was that they were talking about?
Yeah.
It was different. They were talking about something else.
Okay, all right.
It was just scathing. And it was saying, you know, the journalists are responsible and Wall Street's are responsible.
No, you've got to park that. This is not about hand-holding. We're all very, very open to moving to a world where the hand-holding of the post-GFC architecture is completely destroyed. Totally open to that world. It wasn't even just about that. I don't want to go over it too much because I'm bored of it too.
Yeah.
But last week was way more than just about the end of forward guidance. It was about a lack of clarity on the preferred tools. When it comes to the inflation target, is it still going to be the inflation target? How does that change in the next 12 months? There were open questions left unanswered about that as well. Then it was just the tone, as if the Federal Reserve was only just thinking about these massive debates, these massive issues that have dominated discourse now for the last half a decade.
You know, going into this, I was going to say more transparency, the better. And then I read the article about how Kevin Warsh is thinking about moving it to only 6 Fed rate decisions a year and have 2 meetings where they just talk about big issues. And I was thinking maybe that'll be better because ultimately I don't think that we gleaned much information from that press conference.
I would agree with you. This came from Bank of America again this morning, called it a credibility shock over the Federal Reserve, and said the Fed is facing a credibility problem that hiking in September could become imperative to regain the narrative. The latest from B of A a little bit earlier this morning. Let's give you an update on stories worldwide with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. The yen rallying on speculation the US and Japan may have intervened for a second time after a coordinated effort last Thursday. It was the two countries' first joint action in 15 years. Japan is estimated to have spent $53 billion last week. It's unclear how much Washington spent. Federal Reserve Chair Kevin Warsh is considering changing the Fed's meeting schedule, as you've been discussing. Sources telling us here at Bloomberg, Warsh is thinking about cutting annual policy decisions to 6 from 8, while reserving 2 gatherings for in-depth discussions of economic issues. And it is a merger Monday. Potentially, AstraZeneca exploring an acquisition of Bristol Myers Squibb. Sources telling us here at Bloomberg the discussions are at an early stage. The 2 cancer powerhouses would form the world's biggest drug maker with about $107 billion in annual revenue. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the program, renewing hope for a deal.
It was going to be an attack that would have been by far the biggest attack since World War II. When the Allies asked to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal.
It wouldn't be a Monday morning ahead of the Open without more talk. Stephen Cook of the Council on Foreign Relations joins us next, live from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
I'm not sure how I missed this over the weekend. This piece from the Wall Street Journal.
It's amazing.
Reading it in the commercial break.
It's fantastic.
I was talking about the piece from the FT.
Okay, yeah.
Okay.
About sitting, skulking around, waiting for a shot.
Right?
Yeah.
This is quite a quote, isn't it? Memo to Wall Street, quit whining about the Federal Reserve. Your clients are paying you a lot to make judgments about risk and returns in real time. It's embarrassing when you complain now that Daddy Fed isn't telling you how to do it.
Yeah, if you were concerned about the tone of the Fed conference, well, this gives you a different kind of tone. I guess this is the counter argument, but my main take from this, and we don't have to get into it, is just the idea of forward guidance versus reaction function. And again, it goes to the idea of conflating both, and Torsten Slok put it well. It's one thing to say we're going to get there. It's another thing to say how long it will take and potentially what parameters you're using to get there. And if that's not given, then people just assume that you're either not going to get there or potentially just overreact to every single data point.
And that's what we've seen last week, potentially. This morning, equity futures doing better, up by 0.5 on the S&P. What a ride it's been in the US stock market over the last month or so. 2 days of gains last week, helping drive stocks advance on the week. On the month, we were down by about 0.1% on the S&P 500. Within that, a 20% move lower on chip stocks, 20% plus. The worst month we've seen for chip stocks in America since 2008.
There's an existential question here. On one point, there's the idea of strategic concepts or the hedge fund that blew up and how much that was situational awareness, how much that potentially could be contributing to the volatility. But then there's this question of at what point do competitors create chips that are actually cheap and that are potentially rivaling these and that lower the potential 80+% margins that some of these companies are seeing.
That's the equity picture this morning. Here's the bond market move. Yields lower across the curve, down 5 at the front end of the curve. 2s down to 424, 10s at 468. If you turn to the commodity market, crude declining, Brent and WTI. Brent down by 5%. WTI back into the 70s, 79.70 so far this morning. And the Savannahs this morning, renewing hope for a deal.
It was going to be an attack that would have been by far the biggest attack since World War II. When the Allies asked to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal. We're talking to them in the form of a negotiation. It begins tomorrow afternoon, and we'll see if it's true. I'd love to do that.
So here's the latest this morning. Oil plunging on developments in the Middle East. The president cancelling a planned attack on Iran, saying a fresh round of talks will begin today. Tehran denying any current negotiations with Washington. Stephen Cook of the Council on Foreign Relations writing, any way you look at the current state of play in the war, it is a strategic defeat for the United States. Stephen joins us now for more. Steve, welcome back to the program. Is there any reason to believe we've broken out of so-called purgatory in this situation?
Well, it doesn't seem to be the case unless the president is prepared to capitulate. I think that the conflict over the status of navigation through the Strait of Hormuz will continue. Allegedly, the Iranians and the Omanis are close to a deal in which they have hammered out a two-way traffic in the Strait, but it doesn't suggest that the Iranians have given up on the idea of tolling traffic in the way in which they control navigation. So it seems to me that we're basically in the same exact place that we were in before the president's recent escalation, the same exact place we were in when he threatened escalation over the weekend and then pulled back.
Steve, you and I have been talking about this endlessly. You've talked to us on this program for months on end as we've toggled between strikes and talks, talks and strikes, strikes and talks, talks and strikes. Stephen, what is it about the situation the US has got itself in that is proving so difficult to break away from?
I think there's really two things. One, the Iranians are willing to absorb a lot of punishment in order to control the Strait of Hormuz. Two, the United States has demonstrated over and over again it is not willing to escalate. The president has over and over again threatened the Iranians only to, at the last minute, claim that negotiations are underway, there's a new regime, or our Gulf partners have said, hey, this is not something that we can tolerate because of the damage the Iranians are willing to inflict on us. So that is how we've gotten to this point where there's been no progress. and the Iranians continue to control the Strait of Hormuz, a situation which is a step back from where we were on February 27th when there was freedom of navigation in the strait.
I read a number of articles over the weekend, Stephen, with a lot of hand-wringing about how the U.S. has lost its role as sort of controlling international conflict in the same way that it had been in the post-World War II era, and that this feels like it's spiraling out of control with respect to the number of actors getting involved. How much is hyperbole and how much is true?
Well, I think there's a certain amount of hyperbole here, but at the same time, you can't look at this situation and not understand that the United States' deterrence has eroded dramatically, and our global competitors are watching this. If the Chinese are interested in how the United States keeps a waterway open, this is an exact lesson on how not to do it. The president has backed down over and over again. That's not a suggestion that the United States should escalate, but if you're going to threaten it over and over again and back down over and over again, it is going to erode your ability to compel your adversaries to do things.
There's a potential for a lack of ammunition. That's something people have talked about. One reason why the U.S. might not be escalating. Then there's this issue of what it's actually going to accomplish. I was reading some notes saying that essentially all that's been accomplished has been already from airstrike perspective, and to really do more, they would have to put troops on the ground. To what degree do you see that as a reality?
Oh, certainly the interceptor issue is a problem. The U.S. military has said that in the event of a renewed conflict between Israel and Iran, the United States would be unable to help defend the Israeli airspace. The president has ruled out ground forces, but really, if you want to keep the Strait of Hormuz open, you're going to have to land troops on the shores of those islands as well as the northern shore of the Strait of Hormuz. That is something that was, I believe, was in the original war plan, but that the president rejected that.
And still waiting to see if he follows through. Stephen, thank you. Stephen Cook there, the Council on Foreign Relations. As things stand this morning, we're back to talks again and crude declines. We've had a massive range on crude in just, 2-3 weeks? We're down 5 or 6% this morning. WTI is back at 79. Brent crude in the low 80s. Let's call it a $20 range in, a week or two on crude?
I don't understand how there can be liquidity in this market to the same degree, how people can have any conviction to trade when you have this whipsaw experience every single day, when you have a 6 to 7% either gain or loss one day to another. It just highlights, I mean, last month, this was the best performing asset, right? Up 24%. But my goodness, was it a jagged path, and it really leaves people queasy and uncertain of really involving themselves.
Why are people finding it so tedious? They're finding it tedious because nothing's really changing. This is why it's so uncomfortable. We've talked about this endlessly on this program. This is the new normal, just toggling between talks and strikes, with no clear break and no real path to break away from this situation we're in.
It's an era of supply shocks, and people are looking at this and saying this is the new normal. We've talked about that. If this is the new normal and potentially sets a precedent for that, what's the likelihood of ongoing supply shocks that cause prices to rise in sequential manners, even if in different areas?
Crude down 5, back in the 70s on WTI. Up next, Jeremy Stretch of CIBC as the US and Japan join forces to boost the yen. From New York City, you're watching Bloomberg TV.
exploring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Looking to build on 2 days of gains on the S&P 500, building on that rally this morning. We're higher by 0.5 on the S&P, up by a third on the NASDAQ. What a ride it's been on the NASDAQ and for tech, particularly for chip stocks. We talked about that monthly decline for chip stocks. Semis down by more than 20% through the month of July, the worst month going back to August, going back to 2008, which is just crazy, just absolutely crazy. Switch on the board and get to the bond market. 2s, 10s and 30s. Yields shaping up as follows. Yields declining this morning. We're down by 5 basis points. I just wonder how much the Japan situation is helping out the bond backdrop, and we'll spend some time on that in a moment. We're down 5 basis points on 10s to 468, on 2s to 424. Certainly this move in crude is helping as well. WTI and Brent. Brent crude is down by 4 or 5%. We're down close to 6 on WTI. 79.74 on WTI this morning. Brent crude 83.80, and the swings, the wild swings, continue.
What's notable is that last week we were talking about how oil swings weren't having as big of an effect on the bond market. Suddenly they're having that much more when they're also being coordinated with yen intervention that led to the Japanese government bond market being one of the best performing last week. You actually saw yields come in a basis point at the long end in response to some of this intervention. Again, it goes to, are we in a free market? Not to be existential, but I was thinking about this morning. How do you situate a portfolio when you have a potential bazooka up against you at any time? You don't know when to do it. And this is partly by design, right? This is part of the goal of some of this intervention is don't short some of these currencies because we could come in and mess up your plans. Nonetheless, it does introduce another layer of volatility.
I have struggled with that question in Japan for a long time. I don't think it's much of a market and hasn't been for a long time because of the central bank involvement in the currency and in the bond market that's built up and built up over the last 10 years, 15 years for that matter.
But this market is having a bigger effect on the rest of the world, and that's what I think is different. And the intervention coming from other places because they are so worried that the money coming from Japan could come home or potentially leave their bond market. Either way, it could really hurt what happens here in the U.S.
Dollar yen this morning, 157, just a little bit more yen strength. 3 hours away from the cash open. The opening bell just around the corner with your morning move is your single names. Yahara has more. Hey, Yahara.
Hi, John. We start with the possible pharma deal. AstraZeneca and Bristol Myers moving in opposite directions as we in the FT report that the companies have held early stage merger talks. And this could be significant if a deal ultimately comes through. It would create the world's biggest drug maker by revenue. But as you can see, the market is not convinced, and that's because Astra has one of the strongest pipelines in the industry, so investors are questioning why it needs Bristol at all. Meanwhile, we are seeing Alibaba ADRs rising 4.5% in the pre-market after the company unveiled its biggest AI model yet, calling it its most capable yet. That's that it delivered comparable or sometimes better results than Anthropic's Fable 5, which of course is one of the world's most advanced advanced AI models and outscored the breakthrough Kimi K3 in several internal benchmarks. And just speaking to the risk-on mood that we're seeing in markets, we are seeing the hyperscalers, Amazon and Google, rising in the pre-market, enjoying the tailwinds after last week's stellar earnings that show that their AI investments are paying off. And Goldman Sachs' Ben Snyder is out with the note overnight, saying that that dynamic could help calm some of the volatile swings that we've seen in AI stocks as of late. And obviously, Meta has been the wild card, though it is continuing to recover after last week's big sell-off. John?
A few members of the Mag 7 making a comeback. Yahara, thank you. More from Yahara in the next hour. On our radar this morning, President Trump saying new talks with Iran are set for this afternoon after cancelling planned strikes, suggesting a deal to reopen the Strait of Hormuz could be close. Tehran denying negotiations are happening. Elsewhere, Fed Chair Kevin Walsh considering cutting back the number of yearly Fed policy meetings. Sources telling us here at Bloomberg, Walsh is floating the idea of meeting 6 times a year to decide on interest rates and 2 times for discussions on big economic topics. And finally, the US and Japan joining forces to boost the Japanese yen.
We have a good relationship with Japan. We're very strong, very, very strong financially. They wanted a little bit of help, and we're always there for Japan. Japan's been very good to us.
With one exception, which the president was keen to point out, but we won't go there. Officials from the 2 countries not ruling out additional intervention.
Yeah, Scott Bessent went out on X last night, Treasury Secretary Scott Bessent, and said the Trump administration delivers for America's trusted partners. Economic security is national security, and the U.S.-Japan alliance is built on both. He went on to say that they are prepared to act against more disorderly yen movements, which is part of the reason why you are seeing a follow-on move this morning. Also reportedly on Thursday alone, the finance ministry of Japan injected some more than $50 billion of currency intervention into their market. Again, you have to go back to where are they getting this money? They are selling Treasury holdings in order to raise the cash in order to do this. If the U.S. gets involved, they can sell down some of their euro holdings in particular and transfer them into yen-denominated holdings, which gives them a potential influence over exactly what that valuation is.
Which, according to the FT, is what went through the New York Fed into the weekend. You've touched on an important dynamic. We've been talking about it throughout this morning. It starts with a central question. Why does America care so much? Let's park the friendly stuff and talk about the reality of the bond market. Let's talk about our world. There is a strong belief this morning that the US cares so much because they're worried about 2 policy efforts materializing and building up. One is that Japan has to sell its Treasury holdings. They are the biggest Treasury holdings on the planet. You don't want to see those declining if you're Treasury Secretary Scott Bessent. And 2, you certainly don't want to see Japanese authorities begin to promote, maybe even encourage and regulate the repatriation of capital from abroad, which leave the US bond market and others too vulnerable. This is a global bond market. The Treasury market is exposed to it. There are factors in Japan that are very unique that could contribute to high yields. It is of concern because we're seeing the list of reasons for high yields grow longer and not get shortened. And we've talked about this after Wednesday's policy move from this Fed, that out of everybody watching those moves, and we talked about Wall Street being unhappy about forward guidance, forget that. I was thinking of the Treasury secretaries. I was seeing yields start to fly higher at the long end of the curve. That's a man that might be concerned, and I think he was concerned going into the weekend.
Treasury Secretary Bessent is not one to waste a crisis, and if those moves were going to help facilitate this intervention, well, it's a great time to do it. It sort of strikes me of his experience in the markets with currency over the years, whether it's with George Soros or whoever else, and understanding that sometimes when the iron is hot, you got to strike.
Valuable experience. Did you see that note? And
I did.
Just that picture?
5 to 10 billion.
He's done this before.
Really?
He was being asked about it, and he says, I write it there because I know you'll read it.
That's
right?
good. All right, so there you go. I mean, obviously. I mean, nobody writes notes themselves
Market moving notes in a cabinet meeting with the press sitting over your corner.
Yeah, I mean, what do you think?
Come on, he knows what he's doing. Jeremy Stretcher, CIBC, writing, compared to the April-May interventions, the latest round arguably carries more weight because of the coordinated moves by the US Treasury. Jeremy joins us now for more. Jeremy, there are some underlying problems in Japan. There is a term of trade shock, and welcome to the program, buddy. It's always good to see you.
Good morning.
You're facing a terms of trade shock that oil has contributed to. You've got deficit issues as well, and massive rate differentials with the US. Why does this intervention help them fight those 3? Well, indeed, you are talking about, in effect, a containment policy, because unless the oil price is going to come down materially, or unless the interest rate spread between the US and Japan closes exponentially, and that would imply that the BOJ would have to bring forward, not only bring forward their policy tightening, but be more aggressive and perhaps the market reprice the Fed expectations, it is seemingly more of a containment issue. But I've just been listening with great interest to your discussion with Lisa regarding the holdings of treasuries by Japanese investors, and I think that is particularly notable. I think that twist steepening that we did see in terms of the US curve after last Wednesday's Fed decision, I think was also notable. And I think if we go back to Liberation Day and the post-Liberation Day period, it was the discipline of the bond market that really exercised control on the politicians. So I think it is that sort of bond market dynamic that I think is proven to be contingent here in terms of this broader narrative regarding the dollar-yen exchange rate.
Jeremy, just to take that a step further, how much is the timing kind of predicated on the move that we saw following the Wednesday Fed press conference?
Well, certainly, I think the two are not inconsistent in terms of the timing dynamic. So we have seen obviously a consistent grind higher, or had seen a consistent grind higher in dollar yen through the month of July. But clearly, that's risked. There was an increasing degree of concern or destabilization, perhaps in the bond space after that Fed decision. So I think that did amplify concerns, and in a sense, it is an opportunity to try and hit a market which is very extreme in terms of its positioning. I think it was very notable that if you look at yen short positions, they were the most extreme in 2 years, and indeed were pretty close to the levels that we hadn't seen since 2007. So the market was pretty stretched. There was a degree of volatility or a degree of uncertainty which had been unleashed in terms of the Treasury curve, in particular after the Fed guidance narrative. So I think those two things certainly coincided to provide perhaps a fertile ground into the month end for the authorities to try and come in and hit a market which had been heavily skewed in one direction.
This is incredibly rare, Jeremy. We were talking about how the last time there was some sort of bilateral coordinated currency intervention was 2011, when at the time a number of nations coordinated with Japan to help depreciate their currency. Then before that was 2000, when the U.S. and a group of other nations helped support the newly formed euro when it was depreciating. Do you think that interventions like this are going to become more frequent, given what we're seeing now with Japan, given what happened with the credit line to Argentina, given some of the rhetoric that we're hearing out of the Trump administration?
Well, again, I was listening to your discussion earlier when you were talking about free and fair markets, and in a sense that does beg the question that intervention, or the prospect of intervention, certainly creates uncertainty regards the sort of the free floating nature of both currencies, but also the free flow of information and the market reactions accordingly from that. So I think there are degrees of concern in relation to the current environment, and I think there is going to be increasing skepticism as to whether there will be some degree of increase in official action going forward, and that could create additional pockets of volatility and or uncertainty. And I think that's the subtext here, and I think it's quite interesting to tie this with the forward guidance debate and discussion that you've been having for some time, and in relation to Mr. Walsh and etc. I think we have to remember that we are in a new world, or at least for many market participants, we're in a new world, because I've unfortunately been around more than long enough to remember free forward guidance, and perhaps many in the market have yet to understand the ramifications and the uncertainties that could come with that.
It looks like we're going back to that world. Jeremy, it's good to see you. Jeremy Stretch there of CIBC.
Thank you.
On Japan. On Japan, I consider this as changing the volume of the music, but not changing the track. The mood music is exactly the same. They just turn the volume down. That's how I look at this situation. That's how I view intervention. It's very difficult to do this every single day, to convince people not to trade a currency in a certain way, but the fundamentals are against it in the way they are.
Well, ultimately, it has to come with some sort of reaction from the Bank of Japan, and we're going to get the meeting minutes later this week from their previous meeting. Do we get a sense that they are ready to go sooner than September, and potentially even more aggressively than September? And frankly, it has to go to fiscal questions. The fact that Prime Minister Takaichi is as involved as she is and as close to President Trump, you wonder if there are going to be certain fiscal prescriptions on their end to help fortify this.
Because this is what's happening in the polls right now for Takaichi.
Yeah.
Right? As a consumer, you're getting hit by higher energy prices and a weaker currency. None of that's going to help you in the polls.
Yeah, but the problem is that typically what has been winning in the polls is to provide more services, to do more, to provide more for potentially fewer tax dollars coming into the coffers. So How do you then rein that back to convince the currency markets to then give more strength to your currency that could potentially lower inflation, that then actually improves the quality of life for your constituents? It's a more complicated message, and complicated messages don't fly politically.
4-day, 4% move in the yen's favour. Dollar yen down to about 157 this morning, with an update on stories worldwide. With your Bloomberg Brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Alibaba releasing its latest AI model ever. Trend 3.8 Max is said to be on par with Anthropic's Fable and ranks higher on several benchmarks than Moonshot's Kimi K3. The model is the latest in a string of Chinese tech firms pressuring US rivals. Europe's biggest rivers are drying up after the summer's blistering heat waves. Extremely low levels of water on the Rhine and the Danube are disrupting transportation of goods and curbing power generation. The continent's fourth heat wave is set to stretch through most of this week. Spain says nearly all 50,000 migrants who illegally crossed into Ceuta last week have returned to Morocco. EU ambassadors will hold an emergency meeting to discuss immigration, with some countries set to push for tougher policies. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thanks for the update. Up next on the programme, keeping markets in the dark.
There really was virtually no information about how the Federal Reserve is thinking about monetary policy. The silence of Warsh was really quite deafening, and the financial markets, basically said thumbs down. He's overpromised and underdelivered.
Up next, Mark Cabana of Bank of America.
Look at the more successful economies in the region. The key to their success is continuity. But the way our Constitution is written, it actually encourages a lack of continuity. And that's a problem. The term for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Lisa is very upset that Daddy Fed is no longer providing guidance.
I'm crying.
just to clear that up.
Yeah, exactly.
Destroy, in fact.
It's
Surprised you made it to work this morning.
It was tough. It was a tough weekend. I dressed in black the whole weekend.
Oh, did you?
Yeah.
This morning?
And I just stared at the wall.
Mourning the death of
yeah,
forward
exactly.
guidance.
It's sad. It's a sad, dark day.
Equity futures this morning doing okay, bouncing back by 0.6%, adding to a two-day winning streak into the weekend on the S&P. And the bond market yields declining across the curve. We'll talk about fixed income in just a moment. We're down 5 basis points on 2s to 424, down 5 on 10s to 468. Under surveillance this morning, keeping markets in the dark.
There really was virtually no information about how the Federal Reserve is thinking about monetary policy. It's weird when you're not explaining why three people are dissenting. The silence of Warsh was really quite deafening, and the financial markets, basically said thumbs down. He's overpromised and underdelivered.
So here's the latest this morning. It might get quieter. Fed Chair Kevin Warsh floating the idea of fewer meetings. Sources telling us here at Bloomberg, Warsh is discussing the idea of meeting 6 times a year to decide on interest rates and 2 times for discussions on economic topics. Mark Banner of Bank of America looking forward, writing, the Fed now has a credibility issue to deal with. We believe they will want to regain control of the narrative. Mark joins us now for more. Mark, good morning.
Morning.
Are you upset that Daddy Fed's no longer providing guidance too?
No, I'm not upset about that. I just want to understand what the reaction function is, and I want to understand what is the justification for any decision that they make. It's fine that you don't have to tell us exactly what you're going to do, but the analogy that we were discussing earlier is if I tell you that I'm going to lose weight and I'm going to lose 15 pounds, then you're going to want to know how I plan to do that. And if I tell you that I'm not going to do it through diet, exercise, or GLP-1, then you're going to have to question how committed am I to actually doing this. And that is exactly what the market is doing right now for the Fed. It's wonderful that you're resolute in your determination to have 2% inflation, just like I'm resolute to lose weight. But unless I tell you how I'm going to do it, we will not believe you. And you can't fool the bond. You can't do it. The bond will see through it, and that is our interpretation of what happened last week. And if this continues, the bond will continue to reflect a greater inflation risk premia and more uncertainty. And the only one who's going to be crying will be the taxpayer, because it means higher associated costs and likely wider bid-offer spreads. So it's really a choice for the Fed. We're not crying because we need the forward guidance. We are looking for a plan, and we don't see one right now. And that is what the long end of the rate curve is telling you.
If Kevin's watching this morning, good morning. That felt very personal. Can we talk about the Federal Reserve equivalent of diet, exercise, and GLP-1s? Interest rate, balance sheet, or just sit there, do nothing, and wait? Which one is it?
Well, tradition would suggest that it's the front end and it's the overnight rate. That is the Fed's most widely known tool. It's the tool that they have the most comfort with, and it's the tool that they can map for the longest period of time. On the balance sheet, there's just not that much they can do. And if anything, what we've learned over the last 24 hours with all the yen intervention is that if anything, the Treasury Secretary wants the Fed's balance sheet to grow through the use of the FEMA repo facility. So how is this going to translate into getting inflation lower? If anything, what would happen is that if the Japanese authorities use the FEMA repo facility, you're adding more dollar liquidity into the system, you're putting downward pressure on interest rates, and that is ultimately allowing for inflation to become even more deeply entrenched. So, traditionally, it's been the overnight rate. That's what we all continue to think that the preferred tool will be. The balance sheet, they're going to struggle to get it down. There's very few things that they can actually do in order to bring the balance sheet down outside of bank liquidity deregulation. And then beyond that, I'm not exactly sure. You can sit and hope and wait, but hope and wait is not a strategy. The market needs to see action. Otherwise, we're going to continue to believe that inflation becomes more deeply entrenched.
It's unclear whether the rest of the Fed committee is on board with this strategy of just silence. And clearly, we're not getting silence this week. We're getting the Fed's Schmidt coming out on Tuesday. On Wednesday, we get Lisa Cook and Mary Daly. We get Alberto Musalem on Thursday, and then Tom Barkin on Friday. A lot of Fed speak. How much louder will their words be with the absence of Kevin Warsh's words filling the space?
We're banking on them being louder. We're banking on the rest of the Fed trying to reestablish some of the inflation credibility that we perceive was lost last week. And if Warsh is not going to be the one that gives us the plan for how this goes, we expect that the rest of the committee will begin to fill in that gap. And we do think that we're going to hear more individuals at the Fed that talk about how they perceive it's important that rates be higher because they don't want to see this type of inflation credibility hit continue to grow. They don't want to see longer dated inflation break-evens continue to widen, which is exactly what we saw last week. To us last week, it was a textbook inflation credibility shock. You had nominal and real rate curve steepening. You had inflation break-evens widening. You had the dollar weakening. You had equities lower. You had this classic credibility shock. And we expect that the rest of the Fed will lean against that and provide more insight into how they are thinking, what they want to do about it, and then when they think it's appropriate to start raising front-end rates.
Someone could argue, potentially in the Wall Street Journal in an article calling us all crybabies, that potentially the rates being where they are on the long end is a result of economic activity accelerating, AI investment, the fact that the economy is strong, and to the degree that it overshoots, it will naturally constrain economic growth and do the job of constraining inflation. What do you make of that argument?
So I do believe that rates are relatively elevated because we do have extremely strong U.S. growth and we have a period of very large inflation for which there's still some increased inflation risk premia at the long end. To say that I'm not going to do anything and I'm going to let the long end essentially build in more inflation risk premia, have that tighten financial conditions and weigh on the economy, yes, you can get there, but it does come at a cost. It comes at a cost of, well, I don't see a central bank that is taking action. I therefore think that inflation is going to be higher, and I'm going to bake that into my business decisions in the future. And that is the cost that goes along with it. It also runs the risk of more volatility, and that means wider bid-ask spreads. And I just don't think that that is the most efficient way for a central bank to handle this. But if the Fed does not respond, we will see more of that at the very long end of the curve. And that's just been a very non-traditional and arguably much less efficient way of conducting monetary policy.
Mark, 45 left on the clock. What are the data points that will keep this Fed call alive for you, the September hike, and how do they need to come in?
So Friday matters a lot. And we think that in the employment report on Friday, you're going to see 80,000 headline, you're going to see 95,000 private, you're going to see an unemployment rate that ticks back up to 4.3 simply because the participation rate is expected to go back up a little bit. But generally speaking, a labor market that is running like that to us still has risks of further strengthening. You're running above measures of the monthly break-even rate of employment growth, given all the demographic and population change, especially with immigration changes that we have seen. And we do worry that that's going to continue to allow for a very strong economy, labor market that is at the risk of showing a further tightening and upward wage pressure. And if that's the case, if that data holds, we do think that that'll be consistent with a hike in September. Inflation will be the other key data point, but really this week it's all about Friday. And a print that comes in line with consensus, we think will be very supportive of a hike in September.
Mark, appreciate it. It's good to see you.
Thank
you, buddy. Mark Urbano there of Bank of America, looking ahead to payrolls this coming Friday.
Mark, you don't need to lose weight, so I think you're fine just the way you are.
Doing great,
saying you're doing great, but it's I love the passion though, and it highlights kind of how people are looking at this in a very rational and unemotional way.
I thought he was talking directly to Kevin at one point, like down the barrel of the camera.
I think.
Right? Foul person.
I mean, you know.
Coming up next, we'll catch up with Sarah Hunt of Alpine Saxon & Woods, Colonel Wayne Sanders of Bloomberg Intelligence, Sarah Kuntz of Clio Capital, Neil Dutta of Renmac.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot. Very, very strong alignment. 3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said,
Succession starts now.
I'm Francine Lacqua, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacqua. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend. This is Bloomberg Television.
At 9:30 a.m., the market tells you what it's really thinking. We beat the drum to the opening bell. With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
The commentary from the Federal Reserve obviously has given a lot of people some indigestion.
People are more worried about the Fed's resolve to do the job.
The data is going to be important over the next couple of months.
I do think the economy is doing well.
The economy is strong. Inflation is pretty healthy, maybe even overheating a little bit.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action, your scores look like this. Equity futures adding to 2 days of gains on the S&P 500, higher by 0.6. On the NASDAQ, up by 0.4. In the bond market, yields declining off year-to-date highs. On twos, we're back down to 423. We're negative 5 or 6 basis points on the session across the curve. Helped out by this move in crude, WTI and Brent down by 5 to 6% for much of this morning. Brent around 83, WTI at 79. And how about by this too? Check out dollar yen this morning. 4-day move, 4 percentage point decline in the yen's favor. Dollar yen back down to about 156 so far this morning.
This comes after the yen had weakened some of the lowest levels that we've seen versus the dollar going back some 40 years. And already we had seen the finance ministry of Japan intervene with billions and billions of dollars that were spurred by what? In terms of how are they financed? And it was financed by selling U.S. treasuries to get more capital, to get into their market to try to support the yen. We talked and joked about how this was burning capital, but now the U.S. is getting in on it and saying, okay, we're going to help you out. And the question is why? The U.S. is now selling euros and buying yen in order to support the currency at a time when you see the administration talk about friendship, collaboration, security. A lot of people are saying, look at the long end of the yield curve and you'll get all the answers you need to know.
Yeah, this has nothing to do with friendship and everything about this. Bring up the yield curve. Everything about 5% on 30s plus and approaching 470 on 10s. That's what this is about. Look across the curve this morning and think about what's contributed to all of this. Fed credibility is a factor, sure. Additional supply coming from here, there, and everywhere, without a doubt. But the global backdrop, the very fact that JGBs were once an anchor around the neck of this bond market, and that anchor is away. Yields are higher. And the fact that they're now facing down a currency shock, a terms of trade issue, widening rate differentials, and they need to do something about it. And there's only one lever. You sell treasuries, and that's a problem for this treasury, given the backdrop for this fixed income market.
Is it a coincidence that the 30-year yields in the U.S. reached the highest level going back to 2007, the same week that the U.S. helped the Japanese intervene with their currency to support, create a ballast, create a ceiling or a floor for how low it could potentially go versus the dollar? Going forward, there are going to be some really key constraints here, because you were saying, what else can they do other than to pull this lever? There are things that they can do, like hike rates, like potentially constrain some of their spending. Question is this action by the United States contingent on some domestic actions to fortify this move other than just intervening in markets?
Well, let's talk about what they can't and what they're not willing to do. What they can't do, they clearly can't have an energy revolution anytime soon in Japan. So they're going to be importing energy, importing food. That's a problem. They clearly have no willingness to hike interest rates aggressively, which is why rate differentials have gapped down to the extent they have. And there is obviously an unwillingness to do something about the budget deficit anytime soon, too, based on what we've seen domestically in the politics. So what do you have left? Either you do something aggressively on currency intervention, which weighs on treasuries, or you start to encourage, promote, possibly even regulate the repatriation of capital and bring it all home, which would once again cause some problems in the bond market.
Yeah, and again, none of these things are solved. This is an important note to make, which is that we haven't resolved any of those issues. All we've done is bought time. And so now the question is, how is that time used? Last week was a seismic week. We really have to underscore that. Not only did we get the biggest intervention possibly going back decades, the first in this type of manner going back to 2011, we also had the unwind of a massive hedge fund of a situational awareness that affected a lot of the chip stocks in that region that helped a lot of tumult. We also had a Fed decision that allowed long end yields to go up. You can argue why exactly, but a lot of people are saying it was a loss of credibility and inflation expectation shock. This has all led to a lot of seismic interventions. And again, I keep going back to the free markets versus actual markets, because at a certain point, how do you bet on things if you know someone else is going to come in and put on the stop button, regardless of whether it's coming from the Fed or Treasury when things get out of control?
I prefer the Ken Griffin style intervention, right? Leave it to the markets to sort out themselves.
The Grim Reaper?
That kind of intervention.
Are you going to be the Grim Reaper who calls up? I love that description by Cliff Aston.
I wish I was in Ken's position to be able to do that, but unfortunately I'm not. I mean, that's a guy that can afford to buy dinosaurs and store them wherever he likes. So no,
we
I'm not
didn't
in that
know who
position.
bought that dinosaur.
Well, he's bought dinosaurs previously,
That's
right?
true.
Or a dinosaur. So yes, you're right. We've got all these little points of tension and all these little points of intervention. I remember a piece from Mohammed El-Arian a long, long time ago, and he talked about all these little fires starting to come out. There's a lot of little fires starting to come out. There was one missing that you didn't mention, South Korea, which I think probably contributed to the move that you saw in situational awareness
Yeah,
too.
and which beget which, given some of his positioning. But yeah, there are a lot of little fires. At what point do they come together to have a conflagration?
Just a blaze.
Yeah, or is this just going to be little fires and it actually controls the underbrush?
Yes, there you go. Maybe. Doubtful. Possibly. Yields down this morning. We're down by 6 basis points. Tens about 467. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods. With stocks hovering near record highs, Sarah comes of Clio Capital as SpaceX prepares for its first public earnings report, and Neil Dutter of Renmark as Fed Chair Kevin Warsh weighs changes to policy meetings. We begin this hour with stocks rising following the weakest July performance in over a decade. Sarah Hunt of Alpine Saxon Woods writing, the absolute growth in S&P 500 earnings for 26 remains driven by information technology and communication services. So hopefully the earnings growth story can continue. We hope, Sarah. Good morning. Good to see you.
Good morning.
Has a 0.13% decline in the S&P ever found this bad?
It has not. There is an absolute, I think that this is one of the things where the indices are moving in ways that belie the underneath the tumultuousness, wow, my words, tumultuousness under the surface. I think there are a lot of sector moves that are going back and forth. I mean, you saw the Procter & Gamble news. The reason I mentioned that on the earnings is because staples are not in great shape. Here's where you're starting to see that margin compression. You're not seeing it yet in industrials. You're not seeing it yet in technology. But that's the kind of thing where people are starting to say, okay, you can't keep pushing price forever. And that's where you start to get some problems. So I think that there is a lot more movement than the headline indices would suggest.
Who has pricing power and who doesn't? We thought chips had pricing power, then chips just went on a massive round trip. But a 20% plus decline on the semis last month. I mentioned earlier this morning, biggest monthly decline, I think I said August, it's October 2008. Still, it's 2008, it's been that long. Semis went vertical and then they crashed. What are your thoughts on that sector now? The pricing power, the sustainability of the earnings stream, the pricing, the valuation of that story too?
I think the valuation is still something that's a little bit a little bit challenging even after that crash, just because of how parabolic they went. And I think that the expectation was these things can continue on this trajectory in a linear form, which is the problem, I think, historically, is that we all tend to think in these linear forms when things start to go in our direction. And for the continuous interruption of coming out from China and saying, we can do this cheaper, we can do that cheaper, it takes away from that story. Now, in the end, do we still see a lot of CapEx? Yes. I think the Amazon and Microsoft numbers were very important last week. And I think that if you talk about reasons for the market to have turned back around and feel more comfortable, that huge increase and acceleration in demand for cloud was very important to all the story, because it says we still need to keep buying. But whether or not you can price infinitely higher forever is clearly, I think, a question, and I don't think you can. But I also think that things got away from themselves, and usually you don't look at those stocks when the earnings are continuing to accelerate. You look at those stocks when those price-earnings ratios don't look so good. So I think that there's a little bit of a tension there, but definitely that demand picture that we saw last week from earnings was very helpful to the story.
Yeah, well, the hyperscalers clearly seem to be like winners once again, and a lot of people are in particular going on to Amazon and Microsoft to some degree this morning, Google as well. From your perspective, how much was this completely a result of situational awareness? Was a lot of the volatility, particularly in the chip stocks, over in South Korea, over here in the U.S., how much is a result of a little fire or a pretty big fire bailed out by Ken Griffin?
Well, that's the problem of things that interact like that, right? Because which is the chicken and which is the egg here? You saw an enormous amount of leverage use in Korea. You saw an enormous amount of single stock levered ETFs that were acting in the memory space. All of these things together work beautifully on the way up and horrifically on the way down. So that movement that we saw in June, where everything was moving higher, and even at the beginning of July, it wasn't so bad. I think once you get one trip in that system and it starts to come down, you see that leverage unwind. And I think that's what we saw. And that was very painful for a lot of people, including the Korean market. Besides the situational awareness piece, I'm sure that there are plenty of other places where there was a lot of trouble, but the question was it trouble that was existential, like it was with situational awareness?
It also came when there was a breakout of an argument in Silicon Valley last week that really rocked the boat, and you saw truly everyone pitted against OpenAI Anthropic. OpenAI Anthropic saying, we want these closed models preserved, we're hoping that regulation can do this. And you had the likes of Mark Zuckerberg from Meta, you had the likes of Jensen Huang from NVIDIA coming out and saying, you're wrong, we need open models to compete with China, because China right now is flooding the zone and they're actually developing technology that's going to be the leaders. How much does this potentially undermine the prospects for OpenAI and Anthropic? And that's kind of hanging over people, the idea that potentially these kind of frontier models are going to be rendered obsolete in some of their financial prospects.
Well, to some degree, there's a little bit of talking your own book, right? Because if I have a model that I want it to stay closed, then I'm absolutely going to come out in favor of that. If I'm struggling with that, like perhaps some of the other folks are, then maybe I don't want to espouse that so much. I think that it is still a frontier mentality where people are still running to stay in front and trying to figure out exactly how this is all going to interact. And I don't think we have the answer to that yet. And that's part of the problem with which way to go on the investment side, because you see people running this direction and then turning around and running in the other direction because you're trying to capture that. And right now it's difficult to figure out exactly how to capture that.
Lisa's making a really interesting point, and we were building on this conversation with regards to whether value will be created. We just see a commodification of the frontier model there. And maybe the money's made somewhere else in the infrastructure. I don't really know. I'm still trying to work that out in real time, and I'm sure you are too. Where do you anticipate the value will be made within the AI ecosystem?
Well, I think what you're still seeing, and this goes back to the conversation that's been going on for a year and a half, there's an ancillary trade to all of that, which is still building out the ecosystem. And there will be value there because people will use it. I mean, the question is exactly how and exactly who's going to get paid. But the fact that you saw that acceleration for the hyperscalers, I think, was an important part of the story. Had you seen a deceleration there, I think we'd be having a very different conversation. And when they started talking about CapEx and maybe not bringing CapEx down so much, but that second derivative is not nearly as strong and in some cases negative, I think the market wants to see a little backing off of CapEx. They're a little worried about how all this is going to get funded. So to the extent that you can bring that down a little without crashing the whole system or without crashing investors' expectations, I don't think that's necessarily a bad thing.
It was a bit sketchy at one point, wasn't it? These guys were being punished for spending, and the people who were getting the money from the spending were getting punished too. It was an odd month last month at times.
Well, I think that just says that people were worried about the sustainability of that, because the sustainability of saying I'm going to raise CapEx by 20 or 30% every year ad infinitum is not something that anybody thinks can be funded. And then you start to have those questions about, do I want to be on the debt side, the equity side? And if I can't do it with debt, can I really keep raising equity? And I think that there is a point at which it is safer for the market in general, but also it is better to have a more moderated pace of spending so that you can actually see that that spending is worthwhile. And that's been the question all along.
Sarah, it's good to see you. Thanks for dropping by. Sarah Hunt there of Alpine Saxon Woods. I found the reaction to the collapse of situational awareness to be quite instructive. The willingness to find a convenient narrative for the weakness that we started to see in the tech story, to find an excuse to buy again. How quickly people jumped on that on Friday. Max Kenner, HSBC, we talked about his note almost immediately. News around the unwind of the AI hedge fund situational awareness gives markets a welcome narrative to justify the renewed sell-off in chip stocks in the past 2 weeks. Technicals are cleaner now. It creates a powerful backdrop for a positive reversal.
What was it, 18% that the Kospi was up in the wake of this in one day or something of that nature? I mean, it was the biggest one-day rise ever. And you wonder, is this healthy? Does this give people confidence, or is this more volatility as people search for the next winner in this trade? It is notable, the idea of people looking and going from one winner to another. And last week, the real winner was the hyperscalers, in particular, Microsoft, up 22%. You take a look at Amazon, up 17%. These are massive gains, even though Apple was down 7% and Meta was down 6.5%. So clearly, they're the haves and the have-nots. It's just unclear who those haves and have-nots are from day to day.
A reason for people to buy, looking for an excuse. Nasdaq futures this morning up by 0.3. Equity futures on the S&P up by 0.5. With an update on stories worldwide, with your Bloomberg brief, Vonnie's back with more. Hey, Vonnie.
Hey, John, thank you. The Senate announcing a bipartisan deal aimed at avoiding a government shutdown this fall. Senate Majority Leader John Thune plans to bring the measure up for a vote this week ahead of the Chamber's scheduled August recess. Jefferies-run fund Point Bonita Capital is reviewing its exposure to commodities trader Radiant World. The review comes following reports of Radiant World allegedly providing invalid invoices and other documents to banks. Radiant World denies the allegations. FIFA President Gianni Infantino wants the Trump administration to help him keep his job. The New York Post reporting that Infantino scheduled private talks with Secretary of State Marco Rubio. The report comes as the FIFA head is under pressure to resign over his bid to sell the World Cup to Josh Kushner's PE firm. And that is your Bloomberg brief. John.
Vonnie, thank you. Thanks for the update. Hard to know how to react to that story.
I think with the meme of Marco Rubio being handed this assignment.
I think he spent a little bit too much time in the States around sort of the epicenter of capital markets and power.
I don't think this ingratiates him with his European friends.
No, not at all.
And I think that UEFA is going to fight back that much harder as a result of potentially Infantino having uncompromised leadership.
The latest on FIFA this morning. Up next on the program, negotiating with Iran.
It was going to be an attack that would have been by far the biggest attack since World War II. When the Allies asked to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal.
And guess what's happening in the commodity market? Crude down, WTI and Brent. Up next, Colonel Wayne Sanders of Bloomberg Intelligence, live from New York City this morning. Good morning.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance. Stocks doing better, up by 0.6 this morning on the S&P 500. 2 days of gains into the weekend, a weekly advance on the S&P, a monthly decline. That monthly decline down 0.13% on the S&P 500 last month. It felt so much worse, and for much of the month, despite this massive churn beneath the surface, we were within 2 to 3% of all-time highs. We are within 2% of record highs this morning.
In some ways, is this a feature or a bug, right? Some people will say, in some ways, this volatility makes it an incredible headache and positioning that much more important to get the positioning right. In other ways, people will say, this speaks to the strength of the U.S. market. You can have lots of little fires in lots of places, but they even each other out, and at the end, you retain the positivity. The real question is, do you see the momentum in the underlying economy? And if that starts cracking, the story changes very significantly, which is why everyone's looking to payrolls Friday.
If I told you, I love that game. If I told you at the start of July, 20% decline in chips, where's the index? Index unchanged might not be the call people would have made.
Yeah, right now people are fleeing from one corner of the tech trade to another, and you can see that with some of the hyperscalers gaining almost same amounts that the chip stocks have lost. The question is, are we just having a ball of money that's rotating around? At what point do people make a decision as to who the winners are going to be? When does that kind of play out? That's why I actually think that the SpaceX release of shares and earnings are going to be really important as a predecessor to what we could potentially get from OpenAI and Anthropic.
They staggered into the lockup. More on that with Sarah Kunst a little bit later. Let's talk about this bond market. We do have an index level headwind coming from fixed income. Yields declining this morning. That's some better news. Down 6 basis points, 423 on 2s, on 10s down 6 as well to 468. The move in Japan, I think, contributes to this. Just removing that threat, that imminent threat of selling more treasuries for now to cash in and buy the Japanese yen in Japan. With dollar yen coming back down to about 156, that coordinated effort, it's very clear that we have a Treasury Secretary in the know who understands what's happening. Keir has a line of sight and is doing his best to keep yields down.
How much is the fact that the finance ministry over in Japan sold some $50 billion worth of treasuries on Thursday alone to support the yen? How much that contributes to the fact that 30-year yields in the U.S. rose to the highest level since 2007? I'm not saying that there's a direct correlation, but you put all the moves from last week, the volatility coming from situational awareness, what we saw from the Federal Reserve, the lack of guidance, some of the hotter-than-expected inflation reads, and then all of a sudden you get this move in the yields, and then the intervention comes. You have to wonder how interconnected
I'm pretty sure Leopold wasn't long treasuries, was he?
No, he wasn't long treasuries.
That's far too vanilla, right?
No, but the U.S. story is an AI story. So
I'm with you.
I think that you can make the argument that it's connected. I mean, also liquidity, and a liquidity draw if you get that, and who else is going to have a fire?
Without a doubt.
Without a doubt. Yeah, I don't think that he's particularly interested.
Let's return to crude. Down 5% this morning, make it 6 on WTI. Back in the 70s on WTI, 79.70. We've got some talks to talk about. That's fun, isn't it? It's Monday morning, so we might as well. Under surveillance this morning, negotiating with Iran.
It was going to be an attack that would have been by far the biggest attack since World War II. When the Allies asked to call it off, you got to sort of say, well, let's see. And the reason they asked is I think there's a deal. We're talking to them in the form of a negotiation. It begins tomorrow afternoon, and we'll see if it's true. I'd love to do that.
So here's the latest this morning. Crude falling as President Donald Trump says talks with Iran will start today. Tehran saying it is not currently negotiating with the United States. Colonel Wayne Sanders of Bloomberg Intelligence joins us now for more. Colonel, welcome back to the program. We've struggled with this now for weeks and months, going back 5 months, struggling to break out of so-called purgatory. Do you see any conditions whatsoever that would stop these talks from shifting back to strikes once again?
Yeah, not really. I think that this is more of the same at this point in time. I think
I think the allies that President Trump's talking about, being able to pull away from the strikes, is a good thing in terms of being able to create some solidarity around the GCC and being able to push that more in terms of a Middle East problem. So I think that part is good. The problem that I run into, though, is that right now, you know, every time that President Trump does this, his threats are now starting to fall a little bit on deaf ears when it comes to that, because he is pulling back. But at the same time, the U.S. can't seem to get to the negotiating table without Iran coming back and striking with additional missiles, right? So neither side seems to be breaking free of this, hey, I don't trust the other concept that they're in right now.
What is the variable, Colonel? What is the metric that's leading the president to one day said talks and the next day said strikes? Is it the price of crude, the stockpiles of ammunition? What do you believe it is?
I think that geopolitical does play a part in this, but I also think it's also military opportunities, talking to the CENTCOM commander, Admiral Cooper, and others as well, and saying, okay, all right, right now we have these on the Joint Integrated Prioritized Target List, the JIPTL, which is, these are the targets that you have available right now. You also have what are called restricted targets, which they could potentially open up, which are a little bit more, obviously, operational risk involved being able to use that, right? So when he starts looking at that and he talks about a strike that's up to, you know, the standards of World War II, is what is going to be the gain at the end? So they will war game this through most likely course of action, most dangerous course of action. They'll do what they call action, counteraction, and reaction. So they'll go through all of this and say, what are we going to get after this? And so at this point in time, I don't know whether or not those military targets are reaching that point where it's going to have the strategic gain that he wants.
Colonel, another way of looking at this is, have all of the likely targets that can be hit through airstrikes already been hit? I mean, what's there left to do in that manner? Or is all of the essential, have all of the targets already been stricken?
Yeah, I think a lot of the military targets have, and obviously restrike, they still obviously follow around additional, you know, whether it's anytime they ever find any missile launchers or anything like that, those are going to be targets of opportunity that they follow around. Those are going to be primary strike targets. But then when you start looking at those higher operational risk targets, they do a center of gravity analysis, and they say, okay, if I hit this bridge, this is going to be the gain that's going to come, but there's also going to be some type of political blowback that could potentially come from that. And you have to start looking at that as well. And that's one of the biggest pieces that they've started to look at. You've heard President Trump talk about whether or not it was going to be some of the power desalination or even the bridges as those areas, but it has to be proportional. You have to be able to say that there was a military benefit to it that was greater than the harm that was going to be caused to the population, and that's one of the hardest pieces to get on the public stage.
Colonel, is there any takeaway as to what the future of war looks like based on this conflict and the one in Ukraine? Is there any kind of takeaway about the modern contours of war?
Yeah, absolutely. I think when you look at drone warfare alone, and then you start looking at counter-drone technology as well as anti-ballistic missile technology, you're seeing a lot of that across defense primes. You're seeing it on the global stage as well. You're seeing it from everybody from MBDA and Thales and others, and BAE systems over in Europe, as well as obviously the defense primes with RTX, Lockheed, Northrop, and everybody here in the United States as well, looking for lower cost munition solutions, right? So what they call LCCMs, lower cost containerized munitions, are one of the things that people are looking at, because people don't want to pay $4 million for a PAC-3 interceptor. They want to look for a shorter answer. Directed energy ends up being another thing right now that a lot of people are looking at, which is high-powered microwaves as well as high-energy lasers. Israel uses something called Iron Beam. We have things like Helios and others. They're going to continue to develop as well.
Colonel, it's good to see you. Catch up and touch base. Colonel Wayne Sanders of Bloomberg Intelligence asked whether we can avoid going back to strikes. It's going to be difficult. Up next on the program, Sarah Kunst of Clio Capital, as SpaceX prepares for its first public earnings report. Live from New York City, you're watching Bloomberg TV.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Within 2% of all-time highs on the S&P 500 this morning. We're positive by 0.6. Last month, dead flat almost on the S&P. On the Nasdaq, anything but. A bounce this morning, up 0.25%. But last month, the Nasdaq 100 down by more than 6%. And that major move in chips contributing to the weakness we've seen in tech in the last 4 weeks.
Yeah, and the idea that you could have a 21% drawdown, which is the most going back to 2008 in the semiconductor space, while also seeing a near flat market gives you a sense of just how much volatility. The question is, how much is the pain there going to end up being the hyperscalers' gain? Maybe it was just a delayed reaction, but the pendulum seems to be swinging back to some of the big hyperscaler names, the Amazons, the Microsoft, the Google. They seem to be benefiting, at least in profitability, in earnings, and now in stock performance.
That's the stock market. Let's talk about the pain of the bond market. 2s, 10s, and 30s. Let's chop up this yield curve and start the front end. The front end, we're down by 5 or 6 basis points. We were down through the week last week as well, just about. 10-year yields a little bit lower this morning too. 30s pulling back to 5.22, but 30s last week were up for a 5th consecutive week. I believe that's the longest such streak going back to October 23. So it's been quite a run of weekly advances for a 30-year bond yield. And how many times have we said, Lisa, at times it has felt like that 30-year piece of this yield curve has become untethered. Last week felt no different, and it felt like the Fed had a role to play as well.
We saw a rapid yield curve steepening. That was the wrong kind of steepening. The Fed came out, didn't give guidance. The market said, we don't believe that you have the will to hike rates in the face of inflation. And as Mark Cabana earlier said, ultimately you had a classic inflation and Fed credibility shock. You can argue that it was something else, that it was tied to just the momentum in the underlying economy, potentially tied to Treasury sales in Japan. Nonetheless, this really does go to the existential angst of the moment. Has the Fed lost control of the long end of the yield curve, and is there the willingness to take back control with some serious words, not only from all the Fed speakers this week, but from Fed Chair Kevin Warsh himself?
We could have a big debate about whether they ever had control over the long end of the yield curve, but they're certainly contributing to the volatility we're now witnessing. A reluctance to even talk about with any clarity what the reaction function is, or the preferred tool to address inflation. Is it weighting? Is it the interest rate? Or is it the balance sheet? We don't know. So if you're in the bond market, where can you push right now? The yield curve, much more comfortable pushing around the 30 than 2s when there's an unwillingness to do anything with the interest rate.
You see bank after bank come out and say, we're neutral duration, we're actually underweight, we're going to the front end of the yield curve because we can understand it. The long end, you just don't know. I mean, if they start introducing the balance sheet, you could potentially see yields go that much higher, let alone if this is a Fed that says we're going to target a different kind of inflation target that potentially is already at 2%, so we don't need to do anything. I mean, there are lots of different parameters of this. The data is going to be that much more important.
Spent the weekend trying to come up with ways of targeting the Japanese yen. Dollar yen this morning pulling back. 4 days of yen strength. A 4-day move of 4% on dollar yen in the yen's favor. Dollar yen down to the mid 150s, away from the 160s. We're down this morning by 0.3% and clear. A very clear and obvious effort to team up with the Japanese. and do something about this Japanese yen weakness?
There was a coordinated statement coming out of the Japanese Finance Ministry and Treasury Secretary Scott Bessent in the United States last night, coming out confirming that they had intervened, and if the first coordinated measure between two countries to intervene in currency since 2011, and they both indicated a willingness to do more. So who is going to bet against that? But for how long will this work unless there is some sort of commensurate action by either the Bank of Japan or potentially the Budgetary Committee in Finance?
Do you remember our currency, your problem? Except this time it's Japan's currency, America's problem. Apparently, based on this willingness, it's never about just friendship. It's always about self-interest too. It's pretty obvious there is some self-interest in all of this.
Couldn't it be friendship?
I wish it was, Bramo. I wish it was.
Between the U.S. and Japan, long-standing allies.
Unfortunately, that's not what finance is about, right?
Can you give me $50 billion, John? Help a friend.
I wish I could, Bramo. I'd like to buy you a dinosaur too.
Thank you. I would like that.
Yeah. But only some people have got the money to do that. Kenny G being one.
Yeah, well, if he wants to bail me out.
Scotty B being another.
Yeah, exactly. They're doing great with memos on their desks.
Okay, 2 hours away from the cash open. Let's get you some single names. Some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with the earnings that we've gotten this morning. Marriott shares are falling 3.4%. While the company did raise its full-year outlook, investors did not get the clean beat they were looking for, with the third quarter guidance coming in a bit light. The stock has already run up some 19% year to date, so expectations were elevated. It's become a pattern this earnings season that the higher the expectations, the harder the market has been on any disappointment. And we saw a slight one with Marriott. Moving on to GameStop, it is a big mover to the downside this morning, down 10.5%, after announcing a plan to exchange about $1.4 billion of convertible debt for stock. The move does help to clean up the balance sheet, which of course is a good thing, but investors are focusing on the dilution this introduces. And of course, for a stock that's been long driven by retail investors, that is hardly ever welcome. And we end with some possible deal news. We are seeing AstraZeneca and Bristol Myers moving in opposite directions as we in the FT report that they have held early stage merger talks, and this could be significant. If a deal ultimately comes together, it would create the world's biggest drug maker by revenue. But as you can see, the market is not convinced, and that is because Astra has one of the industry's strongest pipelines. So investors are questioning why it needs Bristol at all. John?
Yahara, thank you. Thanks for the update. More on that story, of course, throughout this morning on Bloomberg TV. On our radar this morning, President Trump cancelling strikes on Iran and saying new talks are set for today. Tehran still denying it's actively negotiating with the United States. Elsewhere, the US and Japan teaming up to boost the Japanese yen.
We have a good relationship with Japan. We're very strong, very, very strong financially. They wanted a little bit of help, and we're always there for Japan. Japan's been very good to us.
The Japanese currency coming off 4-decade lows following combined efforts in the FX market. The US Treasury Secretary Scott Bessent posting on X, quote, "We will not hesitate to participate in further joint intervention." And finally, Alibaba releasing its biggest AI model yet, Qwen 3.8 Max, the Chinese tech giant, claiming its performance is on par with Anthropic's Fable 5, but at a fraction of the cost. The release boosting Alibaba shares as competition for AI dominance heats up between the US and China.
There are a lot of ways to take this. One could be, what did they do with technology that has been sanctioned from the U.S. into China, whether they used NVIDIA chips that they weren't supposed to, whether they used the training models from OpenAI and Anthropic. I want to take it in another way to this question of open models versus closed models and the debate that is splitting Wall Street right now, splitting Silicon Valley more importantly, where you have some people saying this just shows we need open source in order to compete and flood the zone to compete with China with these cheap models. And then you have the OpenAIs and the Anthropic saying, actually, that's a huge security risk. Look at those models that got out of the box and ate your lunch in a couple of companies that could take on a life of its own. This needs to be controlled. This needs to be regulated. This needs to be closed source. And that is going to be the debate that defines the winners and the losers in the next phase of the AI race.
As you know, Lisa, the debate in Silicon Valley is colored by self-interest.
Oh, you don't say.
Which debate do you think wins in Washington might be the key question?
I'm not sure, because right now you have the likes of Elon Musk siding with the open source crew. You have the likes of Mark Zuckerberg. You have a whole host of CEOs, and on the other side you have the CEOs of OpenAI and Anthropic, who both have their issues with this White House. I don't know, and I don't know which is the right answer. I think it is an open debate. about the reality of both arguments. Both have credibility.
You mentioned Elon Musk. Let's talk about SpaceX facing its next big test. With its first public earnings report due out tomorrow, the stock is down over 30% since its IPO. Sarah Kuntz of Clio Capital writing, we know the headline story we'll hear at earnings. What we don't know is how much of a fire sale we'll see and how much Elon and other large shareholders are willing to buy to stop the bleed. Sarah joins us now for more. Sarah, are you suggesting the beginning of the end of the lockup, this staggered lockup that we're about to see, is more important than the earnings report this week?
I think it absolutely is. You know, we, for the most part, don't know who owns those shares. We don't know who's able to participate in this initial lockup tranche. We do know that that sort of 175, I think, barrier they had to hit to unlock even more. I'm pretty sure that that is not going to happen. But, you know, this is going to be a really fascinating test of who actually wants to hold this and what do they think about the long-term sort of promise of the company.
Sarah, how much of the move that we've seen since the IPO do you think is about front-running some of those headwinds?
I think a lot of the move post-IPO is because people are getting nervous about, one, the AI trade, the macro in general, and two, they're realizing that this might be kind of the end of the line for Elon's ability to sort of construct reality. We know that we're not on Mars, and I think that when you look at the fundamentals of the company, you kind of scratch your head and say, wait, what am I paying $1 trillion plus for?
Well, this goes to the heart of the issue. How much is Elon Musk losing some of his capital in markets in a big way? You point out, we know the headline story we'll hear at earnings. The rockets are having trouble. The stock is sinking. Starlink works pretty well. AI needs improvement. I mean, at a certain point, are you seeing people look at the balance sheet more than they are listening to the words, the hopes, the dreams of CEOs in an era where people are saying, show me the money?
Certainly in general that is happening, but with Elon, you know, we've been 2 years away from self-driving cars with him, and we always will be, right? So there's a problem when you keep telling people things and they don't come true. And so I think he has a bit of a Chicken Little problem at this point, where people just are starting to not believe, no matter how much they like him, that he will deliver what he says when he says it. And then on top of that, a lot of people don't like the guy. They've heard enough, they've seen enough, and they're kind of sick of it. And so I think that sort of mania that took over Tesla for years of believing that he could do, you know, the impossible has really, really cooled.
Sarah, how much does this set a precedent for the likes of OpenAI and Anthropic, or color the potential IPOs that could be coming out later this year?
I think that we've already seen with OpenAI, it's having a huge impact. You know, Sam talks a lot about how he doesn't want to be a public market CEO. You know, there's a lot of hesitation around that IPO, but at the same time, we know they are absolutely bleeding cash, and that private markets are getting a lot less excited about putting more money in. And I think with Anthropic, there's a question mark there too. They seem like they have better margins, like they will go public, but I think everybody's going to slowly be dropping that T, that trillion, and going back to, hey, it's perfectly respectable that IPO is a hundreds of billions valuation.
Is situational awareness a convenient excuse?
I mean, situational awareness is a very interesting peek, I think, into sort of the tech mindset, which is tech is really bad at sort of managing downside risk. We are really good at sort of diamond hands. You put the money in, money printer go burn, number goes up. We are simple investors. And so I think what you're seeing with situational awareness is that there's a lack of it in Silicon Valley. And that is likely to be really tough with things like the SpaceX deal, where the question is, where do you sell? When do you stop backing the founder?
Sarah, that's also the case sometimes on Wall Street as well. And you can see the anticipation building just to buy semis and hardware all over again after the decline of last month. And to Lisa's point, the collapse of that fund, the near blow up of it, has basically told some people that that's a clearing of the decks, that's a clearing event, and you can buy again. What would you tell investors this morning who are looking to buy into that dip, particularly going into earnings season this week with numbers from SanDisk?
You have to look at the individual underlying company and see, is it a dip for that company, right? If something was 10x overvalued and now it's 5x overvalued, that's still 5x overvalued. And so with a lot of these names, they are so different until you get under the hood. You look at, the PE ratio, you look at the profit margins, if they're profitable at all, and where the growth is going to come from. Because for a lot of these companies, growth is coming from this idea that everyone will need more and more expensive memory forever. And I just don't know if that's true.
Sarah, it's good to see you. Thank you. Sarah comes to Clear Capital. Fantastic to catch up with Sarah. Fantastic also to read her notes, which are some of the best that we get, right?
Mazel tov to the happy couple, Leo.
Right. I hope the wedding went better than the fund expansion.
Can you imagine having that as sort of the lead up to your wedding?
Wasn't he going to have breakout panels at the wedding? Did you see that report?
I did not see that report.
There was going to be breakout panels to have discussions about these big themes. I'm not sure if that was a joke or not, but
it was like breakout panels about whether they agreed with the marriage or not.
No, you have the wedding and then you have like a get together and
That would be fantastic.
You and I are not built like that, but some people are built like that, where the wedding is an event to climb the social ladder.
Where you need to have a structure to have a conversation.
Have conversations about business, and that's what the table planning's about.
It's like sport.
Is it?
I think that it's sort of, if it's all consuming, it gives you something to talk about.
Way too much.
Structure to your discussion.
That's way too much. I don't mind if someone's watching the sport under the table at a wedding or something.
Are you kidding me? You think that's acceptable?
I think that's fine.
I have knocked that phone out of one of my children's hands during a wedding.
That's more acceptable to me than talking business.
Depends on the sport.
True.
Depends on the team.
And the event, if it's just like an everyday weekly game, that's nothing. But let's say World Cup final, which is bad scheduling anyway, by the way. But let's say it was. If people had a sneak peek, then that's all right.
There are fantastic articles about disrupting weddings. And
this is coming from a man who banned smartphones at his wedding.
I was about to say, I was like, no way would you be accepting
no photos. You're allowed your phones, no photos.
Yeah.
You're allowed your phones.
Yeah, you'd be okay with somebody watching a sports game instead of your wedding.
Be immersed in the moment.
Yeah.
And then watch the game round the back or something.
Are you against it?
Let's get you an update on news elsewhere this morning with your brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Acting Attorney General Todd Blanche is formally ending the Trump administration's proposed $1.8 billion fund for people claiming they were targeted by political prosecutions. The written order could help break a Senate standoff, threatening his confirmation to lead the Justice Department. KKR is buying a 50% stake in a portfolio of assets from Total Energies valued at $2.1 billion. The stake is the latest in a series of green power deals for KKR. Total Energies is pursuing a strategy of offloading stakes in renewable projects to increase returns. Spider-Man Brand New Day winning the weekend box office. The movie bringing in a global box office haul of $927 million, making it the largest opening weekend for any film this year and the second biggest in Hollywood history. And that is your Bloomberg Brief. John.
Ronnie, thank you. Appreciate the update. Up next on the program, revamping Fed communication.
The silence of Warsh was really quite deafening, and the financial markets, basically said thumbs down.
This lack of trust was revealed in the presser the other day.
The problem wasn't the decision itself, okay? It was the absence of a strategy to achieve the mission.
Neil Dutta of Renmac joins us next, live from New York City. You're watching Bloomberg Surveillance.
How do you see AI changing gaming and game development in the future? Look, I think the biggest thing that I'm thinking about is how do we just make sure it's solving problems. On the game development side, I've gone to a lot of our studios, with big and small, and I'm blown away with how they're using AI in the production pipelines, how they're using it for iteration and prototyping. That's not production ready, there's still work. And so, 30% of game development is software, and so there's the traditional applications that we see in enterprise. At the same time, I do not think AI will replace AAA games. I think it's entirely possible, though, that AI represents a new category of games and a new type of development and enables more people to create and participate. And we'll keep an eye on that, and we'll see how we best serve that.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Stocks this morning up by 0.6% on the S&P, on the Nasdaq up by 0.16. Just confirming there were breakout sessions.
Before a pre-wedding colloquium to discuss big ideas.
So like the welcome event was a breakout session.
Correct. Maybe on love.
I doubt it.
The meaning of marriage.
It might have been.
I think that would have been great.
I'm not sure if that was the intention or not. Let's turn to the bond market. 2s, 10s and 30s. Yields declining this morning across the curve. 10s down to sub 470, sub 430 on 2s. Comfortably below that level just for now. Things can change quickly, of course, in this bond market. We're down 5 to 424. Under surveillance this morning, revamping Fed communication.
The silence of Warsh was really quite deafening, and the financial markets, basically said thumbs down.
The market doesn't know the new rules.
It's clear he's not going to say a lot. This lack of trust was revealed in the presser the other day.
Unfortunately, I thought it was a little bit rocky. The problem wasn't the decision itself. Okay, it was the absence of a strategy to achieve the mission.
So here's the latest this morning. Fed Chair Kevin Warsh weighing reducing the frequency of the central bank's policy meetings. Sources telling us here at Bloomberg that Warsh is discussing the idea of meeting 6 times a year to decide on interest rates. We've got a busy slate of Fed speak ahead following last week's interest rate decision. Neil Dutter of Renmag anticipating that, writing, dissents will only mount with the chair increasingly isolated from the rest of the committee. Eventually, they'll need to move the policy rate this year. Neil joins us now for more. Neil, welcome. Good to see you, buddy. We've been talking about this Wall Street Journal piece that Bramo flagged earlier on this morning. I'm sure you had a look. Lead paragraph. Quit whining about the Federal Reserve. Your clients are paying you a lot to make judgments about risk and returns in real time. It's embarrassing when you complain now that Daddy Fed isn't telling you how to do it. Neil, does that get to the issue or miss the point?
No, that misses the point. Look, it's not about being spoon-fed the next meeting or two. That's not what this is about. This is about trying to first, frankly, have a chair that makes sense when he talks. I mean, this notion that, oh, the market's doing the work for me, therefore I don't have to do anything. So I suppose he should have cut interest rates last month, and then the market would have done all the work for him. It's like, a page out of the Erdogan School of Central Banking and raising rates for people that want to learn to do other things well too. I mean, to borrow from Derek Zoolander. So I think it's a bit ridiculous. I mean, obviously it's coming from the op-ed pages of the Wall Street Journal. I mean, what do you expect? These are sycophants for Kevin Warsh. But, look, this is about trying to lay out a strategy for how you achieve the goal of price stability. That's really what this is about. Look, I mean, don't take my word for it. Look at what the bond market did, right? I mean, longer term interest rates up, broad dollar exchange rate down, term premia higher, inflation expectations up. So this notion that, if the market did the tightening for it, why did inflation expectations go up and the dollar go down? So,
yeah.
it's a bit ridiculous.
Neil, I love Mark Cabana of Bank of America. It's another T-shirt or mug coming. You can't fool the bond, and that's sort of what you're leaning into. Take a look at what long-term bonds did. Do you think that the reaction that we've seen in markets makes it more likely that the Fed has to hike rates to get their credibility back and potentially to wrangle in some control of the long end?
Well, it didn't have to be about credibility, Lisa, but I think now it's become more about credibility. Does anyone really believe that someone like Waller or Williams or Powell or any of these people were enthusiastic about what they saw at the press conference in July? I think they're probably quietly embarrassed by it. So at the margin, I think it's going to embolden the rest of the committee. And as I said, I think the chair will look increasingly isolated from the rest of the committee. And, he had an opportunity to kind of exert some control over the committee by hiking last week. I thought, he probably could have sold him on it. He chose not to. And, as a result, I think he's going to be forced into it in September.
Well, Neil, Jim Bianco had a great phrase over the weekend saying to censor the new forward guidance to the point that you're making, which gives a real question, and you're illuminating it right now, this idea that he's losing control and that Kevin Warsh is ceding control over the Federal Reserve to the other members. How important was it that there were no governor dissents in this meeting, and how much do you think that that is going to change?
No, I think it's going to change. Even if you think about someone like New York Fed President John Williams, right? He supported staying on hold, but if you look at his own views, he's basically telling you that he needs to see core inflation running, at or below 0.2%, give or take, month in and month out between now and, let's say the next few months. The likelihood of that happening based on the last few years of data is very low. There may be good reasons to expect inflation to cool down, but the question is whether it cools down in such a way that it satisfies the word soon. And I don't think that that's likely. So to me, expecting some of these people to vote for a rate hike, I think we're getting much closer to that point than not. And I think also for someone like Governor Waller, frankly, he was more or less right there. Going into the meeting. And as I say, it's really a bet on one sloppy inflation report. And I think if you had to ask me, what are the odds of that happening, I would say pretty high.
Neil, it's good to see you. Neil Data there over on Mac. I think that last point's really important. The backdrop for the bond market right now is pretty unforgiving, and we've seen that in the last week. Unforgiving of mistakes, whether the chairman believes he made one of that news conference or not, is going to be part of the debate until the next news conference. Also, the economic backdrop. I think the conversation we'd have around the table is if it's quite forgiving, a resilient economy that will stand up to some of these higher rates, and certainly has done so far. Neil was making the point that you might have just seen a peak in growth, but maybe not a peak in inflation. And that inflation story is going to stick around and be problematic for the year ahead. And that's stagflation light, in his words. And that's not a forgiving backdrop for the economy either.
The nature of these supply shocks is that they are not one-offs. We have seen that repeatedly, whether it was the pandemic, whether it's the oil shock, whether it's some of the others. What do you do when you have sequential supply shocks that still are coming down the pike potentially? It creates a difficult environment for a Federal Reserve.
Up next on the program, we'll catch up with the IBM Vice Chair, Gary Cohn, Don Rizzo of T. Rowe Price, Nancy Lazare of Piper Sandler, Mike Kontopoulos of Janus Henderson. The third hour of Bloomberg Surveillance just around the corner.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. When you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I
want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise ahead or Gattaca?
Maybe somewhere in the middle.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment. 3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
You up to the minute news whenever and wherever it happens. I'm Haslinda Amin in Mumbai. This is Bloomberg.
All in all, earnings were pretty good across the board.
The beats are being rewarded.
The equity market overall is doing fine.
There's still lots of demand for equities.
The right trade is not to trade. Hold your core positions.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action of scores looks like this. Building on 2 days of gains on the S&P, higher again by 0.5% on the S&P 500. On the NASDAQ, pretty much unchanged, following a rocky month of July for the NASDAQ and chip stocks, down by more than 20% for the semis through the month of July. Into the bond market, 2s, 10s, and 30s. Yields declining across the curve this morning. 2s down by 6 to 423. 10s down by 6, also 30s lower as well. 30s a point of tension in the last week. 5 consecutive weeks of high yield to the very long end of the curve this morning, 522. In the commodity market, crude and Brent declining. Talks, strikes. Back to talks again. Brent down by 5 or 6%, 83 on Brent. WTI around 79. And dollar yen, 4-day move, 4 percentage point decline in the yen's favor. Dollar yen this morning at 156.
I can't keep up with the different once-in-a-lifetime types of moves that we're seeing right now, whether it's the abandonment of forward guidance and what that does to the market, or whether it's what's going on with Japan and the first bilateral currency intervention between the U.S. and another nation going back to 2011, with the U.S. Treasury Secretary Scott Bessent intervening and joining the fight with the Ministry of Finance in Japan to sell down euros, to buy yen in order to stave off some of the declines that we have seen in that currency. All of these things coming together to try to paint this scene. Is this a new world, or the old world where markets used to have some sort of volatility and market making and decision making, or is this something that is profoundly new and potentially crimping growth?
Have we found the author of the journal op-ed?
I think we may have.
Over the weekend, possibly. He's going to deny. Coming up, IBM Vice Chair Gary Cohn. with stocks kicking off the week on a firmer footing. Don Rizzo of T. Rowe Price saying we're past the worst of the unwind in tech, and Nancy Lazare of Piper Sandler saying hyperscalers are slowing hiring to a crawl. We begin this hour with stocks rising and crude falling ahead of a busy first week of August trading. Joining us now, the former NEC director and IBM vice chair, Gary Cohn. Gary, good morning. Good to see you.
Good to see you. Thanks for having me.
You've been following the debate. I want your reaction. You know Kevin Walsh well. What is everyone getting wrong? And I say everyone, I mean the consensus view on their reaction to that news conference last Wednesday.
I'm not going to characterize this as anyone's getting anything wrong or anyone's getting it right. What I'm going to characterize this as, Kevin is a masterful student of the market. Kevin has been at the Fed before. He understands the limited toolbox, but the effective toolbox that the Fed has. What Kevin is doing right now, and I think people don't like this, is Kevin is reverting the Fed to the historic norms of what the Fed did. We, unfortunately, as newscasters or as market makers or as traders, we got spoiled from the 08 period on. From 08 period on, the Fed has been an open box. They've been completely transparent. They have not done anything that you wouldn't know they would do hours or weeks or months before they did it, and the market became addicted to knowing what the Fed was going to do. What Kevin is doing right now is he's trying to get the market off the addiction of me, the Fed chairman and the Fed board, having to tell you what we're going to do. And you, the market, and you participants, you should go and participate however you think it makes sense for you and wherever you think the opportunities are. This is a tough transition. People liked having the answers to the quiz before they took the test.
So there's a markets question. I also think there's an economics question that needs to be addressed. The issue for us, I think, is less about the lack of guidance, less about having the answers before the test, more about you've got an inflation problem, why are you not doing anything about it? Which essentially was the Mike McKee question in the news conference. Why are you waiting? What are you waiting for? Without giving us any real clarity on the preferred tool, why they're waiting, whether they'd carry on waiting, and at the same time telling us to believe them that they'll do something about inflation. I think the economic question is the difficult one to answer.
Look, Chairman Walsh has gone out of his way. I mean, he's literally gone out of his way to tell you he is an inflation fighter, that the stable price mandate and the 2% inflation guide is his bellwether, and he's going there. He has limited tools to get there, as we know. In fact, he has said in the speech, I have two tools to help us get there. I can raise rates, or I can sell down the balance sheet. Those are his two tools. Raising rates, as we know, will affect the overnight rate, the Fed fund, that has very little effect on the economy as a whole. The real effect on the economy is, let's call it in the 5 to 10 year bucket. That's where most people borrow. That's where consumers borrow. That's where credit cards are. That's where student loans are. That's where automobile loans are. That's where mortgages are. Kevin knows that. What he's also telling you is right now, the market is doing its own work in steepening the yield curve. So in less than a year, we have gone from a 2s-10s interest rate curve, inverted about 20 basis points, to positive 40 basis points. We've moved 60 basis points in 2s-10s rates. So Kevin is saying, look, the market is doing my job. They're making the ability to borrow money out on the curve more and more expensive. And it's going to continue to get more expensive. If I raise Fed funds, yes, I can raise Fed funds. I'm not sure that has the effect. I think what he would probably prefer to do is he'd prefer to sell down the balance sheet, which again would put more supply in the market, which would steepen the yield curve, but the market's doing that for him right now. So being in that chair for less than 2 months, or about 2 months, but he happened to come in a funny time where a week and a half after he came in, he had his first meeting. Then 30 days later, he had his second meeting. He then tells you nothing happened in those 30 days. He's sitting here, and I think he's evaluating where he wants to be. He's lucky on the schedule. He doesn't have an August meeting. He does have Jackson Hole. He could tell us what's going on in Jackson Hole. So I think Kevin wanted to probably get through those first 2 meetings, make it clear to the market that he is an inflation fighter, make it clear to everyone who's watching that the market is doing much of what he would have tried to get accomplished early. And he's going to have the month of August, before the September meeting, to come out and deliver a relatively baked plan in his mind. He's not going to give you the baked plan, but he himself will have a highly baked plan.
Do you think that the sell-off in the long end of the yield curve is by design? That what he saw after the Fed meeting, with 30-year rates going to the highest level since 2007, was a good thing?
It's doing Kevin's jobs for him. At the end of the day, if you want to slow down the economy and you want to tamp inflation, you have to make the cost of money more expensive. So if the 30-year rates went up, which they did, and the 10-year rates went up, and the front end of the curve basically stayed the same, which means we had a curve steepener, you are accomplishing what a Fed chair would want to accomplish if you're trying to tamp down inflation and moderate. I don't think it's just Kevin that's doing that. I think Kevin's being very realistic to what the environment is today. He knows that Treasury borrowings are going up every year. He also knows there's this enormous amount of need for debt in the AI compute data center world, where we're talking about potentially another $1 trillion of issuance going on in the market today. The market is finding a home to clear these bonds. It's also raising longer term rates. It's putting more risk premium into the curve. All things that Kevin is probably happy are happening without him having to do anything.
Scott Bessent did something over the weekend, and I wonder how related you see this as, the idea that there was a coordinated intervention in the yen. Some people are speculating it's because the Japanese finance ministry was selling treasuries to finance their unilateral intervention in their currency, and this could potentially help support U.S. yields from going much higher. Do you believe there is any coordination between the two?
Well, we know that the U.S. and Japan coordinate.
No, I mean
no one's denying
the move in the 30-year yields in the U.S. and potentially what happened.
Look, I think there are multiple factors in why the U.S. would have got involved in intervention. Obviously, the rate the yen trades at would force people into transactions where they may be selling U.S. securities to buy at home. It also has to do with trade balances. Remember, we've got an administration that is fixated on trade deficits. So to the extent that foreign products come into the United States below what we think is a market clearing price, or our products are extraordinarily expensive to someone that we would like to sell to, there's a way to try and equal out the trade deficit or trade balance with the country as well. So I don't think it's a single factor model. I think when Scott Bessent gets the phone call from the Bank of Japan, he's evaluating all of these factors. He's evaluating what's going on in supply demand of treasuries from foreigners, what's going on in the trade market, what's going on with the trade deficit specifically with Japan, and each one of those has a different input into the equation to go ahead and move forward.
Knowing Bessent, he might have been the one that made the call. Sort of laser focused on these issues.
Well, he has had experience with that with the Bank of England, so why not bring it over to Japan?
How fragile is the backdrop for markets right now? All these little things going on, tension in Japan, situational awareness, that fund getting into a bit of trouble in the last week too. How fragile do you think the backdrop is?
I don't know if I'd call it fragile. I would say we have as much instability or balls up in the air as we've had. I mean, usually there's one or two driving factors in the market. Today, we've got a myriad of factors. We've got the war going on. We've got the price of oil going on. We've got the major CapEx AI investment going on. And the question is, you've taken some of the largest companies in America that historically have owned intellectual property and were massive free cash flow generators, and then they recirculated that cash into the market, either by buying assets, buying other things, returning it in dividends, buying back shares. You've taken those companies and you've now made them huge asset gatherers, huge asset builders, and they're no longer creating free cash flow. In fact, it's the first time I can remember in the history of an earnings call of some of these largest companies when they're talking about, we will stay positive on free cash flow. It's hard to understand that. These are companies that were producing tens of billions of dollars a quarter in free cash flow. So the market's digesting that. We went through the software scare versus the AI scare. Market's digesting that. We're trying to figure out where all these pieces come together. So there's an enormous amount of instability in the market. At the same time, rates are going up, but the consumer, we know the consumer continues to spend. So even when you look at the GDP numbers, the strongest pieces in there are the consumer spending. Now, we can even go further. We know the consumer is spending, but we also know that's a bit of a bifurcated event. We know that the wealthier consumers in this country are consuming at extraordinary high levels, and we know the low-end consumer is barely getting by. And this is one of the dilemmas that everyone's trying to deal with. And how does this filter through markets? I think all of these pieces of instability are out there. And look, markets can handle one or two pieces of instability. they start to fail when it's 3, 4, and 5, and they really fail when it's 3, 4, and 5, and they're totally out of their control, or the answer is 6 to 12 to 18 months off.
And that's what I'm trying to work out, how close are we? So you've got a massive competition for capital. You articulated that really well. Yeah. You've had a huge terms of trade shock out of the energy market that's hitting Japan when they've already got a fragile backdrop. On top of that, there's evidence of leverage building up in places like South Korea and hedge funds blowing up. And I wanted to go back to the very beginning of this conversation, whether now is a good time to go back to the old world of reducing forward guidance and the hand-holding post-GFC at central banks. How difficult will that mission be?
I don't think it's difficult. Like I said, we've been trained since 2008 to today to expect the Fed to telegraph and forward guide. Prior to 2008, when I was trading for a living and running big trading desks, we did not know when the Fed was going to move. There were surprise meetings after surprise meetings after surprise meetings. You know, the Fed doesn't have to wait for a scheduled meeting to cut or raise interest rates. Now, they have not done it really since I guess they did it in COVID. The last time they did it was 2020. We had a 100 basis point cut on a Sunday evening in COVID, if you remember. But we've now gotten to this point where the market insists not only there be a meeting with a press conference. You can't have actions unless there's a meeting with a press conference. I think the chair is trying to say, no, I have a job to do. We will meet whenever necessary to raise or lower rates. We will meet whenever necessary to do any action we need to do based on what's going on in the environment, not based on the schedule that I put out 18 months in advance.
That's bringing the discipline back to capitalism and financial markets. I'm not averse to that at all. Just trying to work out the consequences of making the switch when you've been feasting on easy money and forward guidance for 15, 16 years and knowing they're always going to be there to have your back and step in whenever there's a problem. And they'll offer you the guidance. And the way you put it, they'll give you the answers to the quiz before you sit the test. Wall Street's feasted on that for years.
They have.
That's why I use the word fragile. How much fragility is in the system that needs to be unwound as we make that transition back to the old world?
I don't think there's as much fragility as you think. Like I said, most of my career trading, I had the opposite world.
Because you had the two-way discipline. You had the discipline.
I had to be disciplined. I had to assume when I went home with a position or I made a price for something, and I ran a big mortgage business for a while, ran a big treasury business for a while, ran a big equities business. I had to assume that the Fed could meet any moment and change policy, and were we trading appropriately? Were we managing risk appropriately? Instead of saying, oh, I don't have to worry about that there's a Fed put, or rates can't change until September something now because there's no Fed meeting. Maybe they'll say something in Jackson Hole, so I'll manage my risk up till the Jackson Hole meeting. I'll wait for that, then I'll manage my risk differently after that. That's not the way markets should work. The markets should manage themselves in a way that anything is possible on any given day.
I hope we go back to that world. I just know that when Lagarde tried that, we're not here to close spreads. Lagarde quickly closed spreads straight afterwards. Right? It's difficult to make the transition.
The question, and I think you're alluding to it, John, how much has the financial market changed and debt built up under the old regime that has to be unwound in a period of a new regime that potentially is much less transparent but allows markets to do their thing?
Did you write the piece, Gary?
I did not write the piece.
Okay.
That said, you know, there are an enormous amount of hedging tools today. So as you see debt move up and you see the private credit markets explode, which has been very helpful, you know, you can hedge your interest rate exposure. You can't hedge your credit exposure as much, but hedging underlying interest rate exposure happens to be one of the most developed markets in the world. You can hedge interest rate exposure in almost virtually every currency that we issue bonds in today. So managing interest rate exposure is not hard. Now, people have historically said, well, I know exactly what the Fed's going to do. I don't need to manage this. That's probably not a good outcome. It's probably a better outcome when people look at their risk and say, my interest rate risk is X. Am I happy with that or not? Not, oh, I don't really care because the Fed's got my back.
Gary, could talk to you all day. Appreciate it.
Always
Thank
a pleasure.
you, sir. Thank you very much. Gary Cohn there, the IBM Vice Chair. Let's give you an update on news worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump says new talks with Iran will begin this afternoon. Trump called off planned attacks on Tehran following appeals from Saudi Arabia and other U.S. allies in the region. He also suggested a deal on reopening the Strait of Hormuz may be close. Tehran denies it's negotiating with the U.S. Federal Reserve Chair Kevin Warsh is considering changing the Fed's meeting schedule. Sources telling us here at Bloomberg, Warsh is thinking about cutting annual policy decisions to 6 from 8 meetings, while reserving 2 gatherings for in-depth discussions of economic issues. AstraZeneca is exploring an acquisition of Bristol-Myers Squibb, a mega deal. Sources telling us here at Bloomberg, discussions are at an early stage. If completed, it would create one of the world's largest drug makers. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next, the Morning Calls Plus, Dominic Rizzo of T. Rowe Price with more key tech earnings just around the corner. Live from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Tech is really bad at sort of managing downside risk. You put the money in, money printer go burn, number goes up. For a lot of these companies, growth is coming from this idea that everyone will need more and more expensive memory forever. And I just don't know if that's true.
Sarah Kunst has her doubts over at Clio Capital. Sarah Kunst there weighing in on tech a little bit earlier on. Let's get you some price action and some morning calls. Equity futures this morning up by 0.5% on the S&P. Our first call from Goldman, adding Applied Materials to its US conviction list, saying it's well positioned to gain market share. Your second call from UBS, downgrading NXP Semiconductors, noting a less compelling growth profile. And finally, Stifel cutting its price target on Tesla, citing a lower valuation based on a sum of its past analysis. That stock is up by 0.2%. More insight into the tech trade this week. We'll get earnings from AMD, SanDisk, and SpaceX. Dominic Rizzo of T. Rowe Price maintaining a bullish outlook, writing, I feel we're past the worst of the momentum unwind. I remain very constructive on AI infrastructure and semiconductors. Dom joins us now for more. Dom, welcome to the program. Where exactly does SpaceX fit in to your outlook?
Well, first off, thanks for having me, guys. It's great to be back here. Look, when I think about SpaceX has the potential to be a Pareto-efficient frontier model. But right now, when you think about where the economics are accruing, all the economics are truly accruing to the frontier labs, OpenAI and Anthropic. You know, when I did the Anthropic round last summer in the global technology strategy, they were just doing $5 billion at ARR. You know, now the rumor is well north of 70 billion. So let's see if they can put together the assets they have, which is an amazing GPU cluster, this Cursor asset, and a very strong model to reach that frontier. But right now, I think the vast majority of the economics are accruing to OpenAI and Anthropic.
So with that in mind, do you think SpaceX pivots more to the rental kind of deals that we saw with Google, with Anthropic? Do you expect to see more of those kind of things?
It's possible. I think that was a short-term dynamic rather than a long-term dynamic. I mean, the thing that was so striking about those deals was that their price was, $40 billion a gigawatt, which is, 2 to 3x the spot market, right? And I think that tells you a few things. But one, I think it tells you what's the ROIC in this business for the application business companies or the hyperscale infrastructure companies. I think is very strong over time. And then two, I think that they believe in the long-term model, but they wanted to make sure that they sign short-term deals where they can pull back that capacity if they needed to.
You mentioned something, Dom. You still think that OpenAI and Anthropic are going to be the beneficiaries, perhaps, of some of the areas where SpaceX wants to get involved. I wonder if some of the developments over in China and sort of the preeminence of the open source models is undermining some of the prospects for the likes of OpenAI and Anthropic, and if we're seeing the financial benefit increasingly consolidated to the hyperscalers and to perhaps a lesser extent in the future in semiconductors. How do you take that narrative? Where do you take that?
Absolutely. Well, first of all, I think you raise a really good point. Open source is like wonderful for the chip stocks, right? NVIDIA in many ways is the absolute king of open source. These models are extremely large, right? The Kimi K3 model out of Moonshot, 2.7 trillion parameters. They recommend that you use 64 different accelerators to run it. So I think open source is an unequivocal good for the chip companies. Now, the question is, what does open source do for frontier economics? And what we've actually seen is the cost curve at the leading edge, right? Like if you look at the difference of cost per million tokens of, say, Kimi K3 versus GPT Sol, it's actually increasing, right? And if you look at cost per task per completion, it's very strong for ChatGPT. But I think there's so many things that go into it rather than just cost economics of the tokens, right? It's applications, it's distribution, it's actually performance, right? What's the difference between an average lawyer and the best lawyer in the world, 20, 30, 40x? I think that's true for the frontier models as well. It's very hard to price incremental intelligence, but I think incremental intelligence is extremely high. The other thing you mentioned is ROIC for the hyperscalers. I do think the hyperscalers have a place of delivering these open source models to enterprises all around the world. And I think what we've seen this earnings season is a resounding endorsement of high ROIC on this investment, right? Satya Nadella tweeting and the Morgan Stanley piece citing 30% ROICs. Jassy talking about on their call that for the shortest life cycle stuff, the data center chips and the network and the servicing, that they get payback in 2 to 3 years and that the useful life is 5 to 6 years. And then finally, we've seen accelerating growth out of all the hyperscalers. AWS, 37%, Microsoft Azure, 43%, Google Cloud, 82%. I think these guys are going to keep spending, and I actually think we may actually see accelerating CapEx growth next year.
So, Dom, can I ask you for a pick, a single name, something you like after the beaten up names we saw last month were dominated in the chip sector? What do you like now?
My biggest bet for a long time has been AMD. And why do I like AMD? Number one is CPU inferencing, right? So Intel's talked about this, that if we go from a training world, the ratio of GPUs to CPUs is 8 to 1. In an inference world, it's maybe 1 to 1. It may actually be 2 to 1 in favor of CPUs. At their AI Intelligence Day just the other week, AMD took their CPU TAM up from 120 billion just a few months ago to 220 billion. And then finally, I think their accelerator, the MI355, is very strong.
Dom, appreciate it. Dom Rizzo there of T. Rowe Price. That stock down last month by 18%, in line with the decline we saw across chips. Up next, Nancy Lazar of Piper Sandler.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is open interest.
Only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
One hour out from the opening bell. Stocks this morning doing okay, up by 0.5 on the S&P, on the NASDAQ up by 0.2. Great conversation with Gary Cohn a little bit earlier this hour on getting back to the old world, pre-GFC. Very little central bank guidance, very little central bank dependence in this market. Can we return to that world, or is this market just very different?
Yeah, how dependent is this market on interest rates having a certain degree of stability? And Gary Cohn was saying, well, they can hedge that interest rate exposure with interest rate swaps and other manners. There's an entire market to do so, and so ultimately it just will cause market participants to be more careful. That said, the market has changed a lot since the financial crisis.
Massively.
With the amount of debt that's been incurred, with the amount of corporate and government debt, not only the trading strategies that have emerged and the technology, you put all this together and you asked a great question. Are we in a world that has fragilities emerging that will fundamentally have that much more fragility baked in during this period of pretty dramatic transformation?
Will that transition come with consequences, and what would those consequences be? So what's changed? We can talk about it. You mentioned a few dynamics. Debt to GDP ratios are much higher now. As sovereigns, much, much higher. Deficits are so much bigger than they were. The wealth channel has become increasingly important, particularly in an economy like the US economy, becoming more dependent on what happens with financial markets and the value of stock markets. Are you willing to make that transition back to the old world if the consequences are that some of the things that we've become dependent on start to be upset? Equity markets start to correct. You're going to tolerate that. If you start to see yields rise at the long end, the Treasury starts to knock the door and complain. Are you going to tolerate that? They're all things that are going to be really difficult to do. Can you take the balance sheet back to anywhere near the kind of size that it was pre-JFC? You're going to tolerate the consequences of that. They're big questions.
Yeah, are you potentially going to slow the economy much more than you otherwise would with allowing the long end to do its own thing and to go higher in response to what they're doing or not doing at the front end? I will say how the AI build-out interferes with this as well, because if you want to support the infrastructure build-out of some of these companies, do you also need a certain degree of stability, or is it completely independent of the interest rate policy, even at yields north of 5% in the long end?
I understand the nostalgia and the romance to want to go back to that world. I'd like to go back towards that world as well. Two-way risk, market discipline, real capitalism. Because the complaints that you hear about capitalism today, you're not complaining about capitalism, you're complaining about something very different. Capitalism has been absolutely butchered after GFC. You're complaining about something different. Making that transition will be difficult.
It reminds me of people who say we once had mortgage rates of 15%,
right,
and we still bought houses, and it was fine. And in fact, it was easier to buy houses.
Bought houses for a bag of beans.
You bought houses for $25,000, so it wasn't the same kind of thing. Now house prices are elevated because of where interest rates and mortgage rates have been. How do you right-size that?
with difficulty. And let's see if it is the ultimate objective and an objective they'll stick with. Equity futures right now in the S&P, as I say, positive by 0.5 on the S&P. On the NASDAQ, doing okay as well, up a few tenths of 1%. With some market movers, some morning movers, some single names ahead of the open. Yahara has more. Hey, Yahara.
Hi, John. The historic U.S. cattle shortage continues to be a problem for Tyson Foods. Shares are falling 3% after the company cut its full-year profit outlook as high cattle costs continue to squeeze its beef business, which of course is its biggest business. We have seen signs that the industry could improve with imports from Mexico set to resume soon, but we are still months away from seeing any of that actually filtering through to meat packers like Tyson. Meanwhile, we are seeing AMC shares rallying up nearly 6% in the pre-market after the theater chain posted the biggest weekend in its history. More than 10 million moviegoers turned out, fueled by the opening of the new Spider-Man movie, which delivered the second biggest opening weekend ever. If you're curious, the first was Avengers Endgame back in 2019. And back then, a bucket of popcorn was much cheaper than it is now. But even now, moviegoers are still spending while they're going, since AMC also set all-time records in concession revenue. And we end on the memory chip stocks. They are picking up right where July left off, in the red after a roller coaster month for this sector. Some of it may be the Alibaba news with its unveiling its biggest model yet and underscoring this idea that you could do just as much with much less. John?
Yahara, thank you. Thanks for this morning. Given how much Spider-Man grossed at the movies, it's amazing how little I saw of it. I had no idea it was even out. Maybe that says something about my algo right now that I just saw. I saw tons of complaints about the Odyssey.
Yeah.
Right? But very little about Spider-Man being out at theatres near you.
It shows how people are truly in segregated areas. Although I actually am interested in this movie. I like the Into the Spider-Verse movie, and evidently we took a look at tickets, and they're all sold out. It's similar.
Oh, you're trying to go?
Well, I wasn't. I was trying to get them for my kid.
You watched the Odyssey yet?
I haven't, but I'm going to watch it this week.
All right. Let me know.
I've heard mixed things, but
I've seen the complaints, and then I've heard people say they enjoyed it.
I love the story, though. I loved it, so I'm very excited.
You should have a look at the podcast with the Chinese interviewer and Nolan. I saw a few clips of that over the weekend, and they get really deep into philosophy and stuff like that. It's an interesting exchange. You might enjoy that. You might enjoy that. All right. Busy week ahead for the U.S. economy, culminating with payrolls on Friday. Michael McKee joins us now for more. Good morning, Mike.
Good morning, John. I'm going to put the Fed forward first for the week because everybody wants to know what they're going to do after we didn't get a whole lot of hints from the new chairman, Kevin Warsh, last week. You had a great interview with Mark Cabana this morning on this subject, and I think a lot of people are going to be following his lead and saying the bond market is not going to be happy unless they get more information. The problem is most of the Fed speakers this week are non-voters, and some of them, we already know their opinions. Williams out this morning on the tape, as people in the markets like to say. Tomorrow we get Jeff Schmidt, who's in favor of raising rates, but he's not a voter. We do get Lisa Cook on Wednesday. She's a voter. Mary Daly, Musalam was out Friday already. Barkin, not a voter either. Bowman on Saturday, but you can't trade then. So we'll keep an eye on what these people have to say, but it may not add to the stock of information. Since we last talked on Friday, though, we've gotten a lot more information. Williams this morning, as I mentioned in an interview with Reuters, saying that inflation is going to be falling in the second half and it'll hit 2% in 2028, something he has said before. Alberto Musalam telling us on Friday he would support a rate increase. And then the story of the weekend, Kevin Warsh is suggesting 6 meetings a year instead of 8, and only 4 of those would be around changing monetary policy. So the August 19th Fed minutes could be very, very interesting. And I finally throw in there Scott Bessent saying that the Fed should increase its foreign and international monetary authorities repo facilities. So the Fed could provide more liquidity in dollars to the markets without having to take currency risk. As far as the economic data, it is all kind of one-sided to the inflation side of the Fed mandate because we get a lot of jobs numbers and the Fed's not particularly worried about jobs. We get ISM manufacturing later today. We'll look at the prices numbers on that. JOLTS on Tuesday, ADP and ISM services on Wednesday both have employment employment issues with them, employment data, claims on Thursday, and July jobs on Friday. That's always considered a big one, but if we don't get much of a change and we see the unemployment rate unchanged, then people are immediately going to shift their focus to the CPI, PPI, and other inflation reports that we get coming up this month.
Mike McKee, thank you, buddy. As always, looking ahead to payrolls and a whole lot more. 80K, the estimate in our survey for this coming Friday. Nancy Lazar of Piper Sandler taking note of slowing trends in the labour market, writing the tech capex productivity link is playing out in real time in big tech, with many such companies slowing hiring to accrual. Nancy joins us now for more. Nancy, that's one sector that has a big role to play in this economy, for sure, without a doubt. For the broader economy, for the labour market right now, Nancy, are we on course for a decent 80 this Friday, or do you see some vulnerabilities building?
No, I think we are on track for continued increases in the labor market in payroll employment. Unemployment claims, right, are the clearest signal. So even though some of the large tech companies aren't hiring, maybe even firing, on balance, claims are down over 8% on a year-over-year basis. That means the labor market is actually accelerating. And so I think obviously these monthly payroll numbers can be very, very volatile. And as Fed Chair Warsh has suggested, payroll numbers are good after the third time they're reported. So we're seeing gradual improvement in payroll. Why? Company corporate revenues are up double digit. They're up 10, 12% on a year-over-year basis. And so companies have the wherewithal to hiring, and they are. And tech companies are hiring in the good side of the economy, the trade side of the economy. There was an article last week highlighting how you are seeing lots of trade type jobs being put in place because of the build out of the data centers. Meta is putting in place a free trade program to train people to build things, and so there is indeed jobs being created because of tech. It's not all one-sided, but bottom line is broadly, yes, the labor market is clearly in an improving trend, reflecting the strength we have in corporate profits and corporate revenues.
What's more important for you to get a forward look on the economy, Nancy, over the next 6 months? What we see out of the labor market with non-farm payrolls and potentially even jolts, or what we hear out of the Fed officials who are going to be speaking this week following the Fed meeting on Wednesday?
The most thing that's going to be most important over the next 3 to 6 months is the continued health of corporate America. The Fed is we would argue somewhat behind the curve. By that I mean they're supportive of growth. The Fed is still stimulative for growth. It's a reason why employment is going to continue to increase, because Fed funds are 3.6% on average. Nominal GDP growth is 6.5%. The cost of capital is low, and that's going to be a major force keeping the labor market moving ahead.
At what point will the 10-year and 30-year yield going significantly higher to some of the highest rates that we've seen since 2007 potentially constrain some of the corporate strength that we're seeing?
We really don't see that for at least another year. We use a 2-year change in the 10-year yield, and it's up about 50 basis points on that metric. It's still historically not up a lot. It's not the level that drives economic activity. Think of it's the interest rate momentum. It's the change in interest rates that drive economic momentum. And as of now, I ran a simple ISM model over the weekend, and it's the 2-year change that drives the ISM. And based on that model, it's likely to continue to be over 50 through 2027. So not really until 2028, and that's ridiculous. I can't forecast that far out. But the bond yield is not yet restrictive to the economy because there is so much liquidity, money growth, bank loan growth, government spending is picking up. That's all reflected in this healthy nominal GDP, strong corporate revenue. So we don't see bond yields as a headwind to the economy for the next 12 to 18 months.
And Nancy, it's pretty obvious at this point that the Fed is changing style. Communication is different. Yeah. We had a conversation earlier in the hour with Gary Cohn about transitioning back to the pre-GFC world. Less guidance, less hand-holding. How smooth do you think that effort will turn out to be?
It's probably going to be bumpy. But historically, Fed tightening cycles or changes in Fed policies are always bumpy. I've done this chart for probably 30 years. Every increase in interest rates, every change in Fed policy always creates financial strains. We saw it in the 60s, in the 70s, in the 80s under Volcker, again in the 90s under Greenspan. We've had several changes in the regime of the Fed. I remember when we switched to targeting money supply in the late 70s, early 1980s. That was a very volatile time, but at the end of the day, the goal was always to lower inflation. And that is what is really key to not necessarily the high-income consumer, but the lower to middle-income consumer. And so the trade-off of ingrained inflation for a sustained period of time because of a Fed that's potentially behind the curve is actually the worst-case scenario for that lower to middle-income consumer. So I'm excited about the path that we're going down, focusing on a change in Fed policy. Lisa, as you said earlier, one of the reasons we have high house prices is because the Fed held rates too low for too long. We've had 3 housing bubbles over the past 30 years because of exactly that. The Fed kept rates too low for too long. And so time will cure the high price levels. Time will help cure the high house price levels through engineering a healthy job market, allowing affordability to improve because incomes improve.
That's the goal, Nancy. We all hope you're right. Nancy Lazada of Piper Sandler on the US economy. Let's give you an update on news worldwide with your Bloomberg brief. Fonnie Quinn has more. Hey, Fonnie.
Hey, John, thank you. The Senate announcing a bipartisan deal aimed at avoiding a government shutdown this fall. Senate Majority Leader John Thune plans to bring the measure up for a vote this week ahead of the chamber's scheduled August recess. Hackers are draining Bitcoin from cold card wallets after a software flaw made some generated seed phrases predictable. The ongoing attack has hit roughly 5,000 wallets and stolen about $110 million, shaking trust in devices marketed as crypto's safest storage. Pressure is mounting on FIFA President Gianni Infantino after plans to privatize the federation's commercial arm fell apart. UEFA, Europe's football governing body, says it has lost confidence in FIFA's leadership. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day and the week ahead. Plus, Mike Contopoulos of Janice Henderson on why inflation complacency is the biggest risk to markets.
The frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you
up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
From 08 period on, the Fed has been an open box. They've been completely transparent, and the market became addicted to knowing what the Fed was going to do. What Kevin is doing right now is he's trying to get the market off the addiction of me, the Fed chairman, and the Fed board, having to tell you what we're going to do. This is a tough transition. People liked having the answers to the quiz before they took the test.
Gary Cohn was great a little bit earlier. Now IBM vice chair, a man who knows something about financial markets. I think a lot of people agree with him. In fact, I think for most people on Wall Street, I can find this many people who think that's exactly what the Federal Reserve should do. And then you start to talk about whether they're willing to pay the price, take the pain to do it. Then the group gets a little bit smaller and smaller and smaller.
I also think there's a question of method, how you get there. And ultimately, that's going to be what the Fed is deciding. Do you give some sort of indication of any kind of reaction function? Because you still don't have to hold the hands. There's not going to be the same kind of Fed put. Maybe moving to 6 meetings and then having 2 to discuss some sort of bigger concept wouldn't be the worst. Big themes, you know?
Big thinking stuff.
Let's talk about the Mets.
Debates we've never had before.
I mean, to me, it might not be a bad idea. All of these things are on the table. I look forward to Jackson Hole.
Huge economic issues at Jackson Hole once a year.
Inflation.
Right? Just inflation, the drivers of inflation, things we've not thought much about.
I know. I haven't
in the
even,
last
hasn't crossed my mind.
5 years. Equity futures right now in the S&P. Stop it. Positive by 0.6. On the Nasdaq, up by 0.2 as we count you down to the cash open. This is your week ahead. It looks like this. 9:45 Eastern Time, so PMI data. Get some ISMs through the week as well. Look out for that. On Tuesday, lots of Fed speak, jobs data and results from SpaceX and AMD. On Wednesday, the labor market data continues. We'll get ADP data, plus more Fed speak from Cook and Daly. Thursday, the Fed's Musalem speaking, and another round of jobless claims before we get the July payrolls report this coming Friday. In the meantime, stocks rising, oil falling, Treasury yields retreating from their highest levels in months going into the opening bell. Mike Ontopoulos of Janus Henderson writing, the biggest risk to markets remains complacency about inflation and Fed action. Lower oil prices will help, but inflation is broadening and the Fed remains too easy. Mike joins us now for more. Mike, good morning.
Good morning.
Does the Fed see it the same way?
You know, it seems as though there are some concerns, certainly. I don't think we've heard, the Fed completely back away from the inflation risks out there, and I think that's actually been refreshing and something that, has certainly eased some concern from